Here we go. The Fall Summit 2024. I'm Lex, your host. Our theme today, adapting trading strategies to major market events. Can anyone think of a major market event? I think the elections coming up could be one. You never know. So we're going to listen to these great speakers today. I think we've got 6 to 7 to 8 and a panel. And they're going to tell us about how they deal with these situations. It's a great day, full of information. I'm not going to talk long here now. We do have a couple house cleaning items. Let me bring on my co-host, Molly Morris. Molly, where are you at?
Hello, everyone.
It's gonna how be a good
day. Kind of feel like there's a Jamiroquai vibe going. We're going to have a fun day. It's going to be great.
I agree. So we're not going to take too much time here. Let me do the cahoots things first. Couple house cleaning items. Comment as much as you want. Just keep it respectful. No swear words or anything like that. Keep it clean. Challenge these people to answer your questions because they're very good and they're happy to have them. So just put those in the comments. For the cahoots, you ready for this, Mal? 1 o'clock Eastern time today. We're going to be running that quiz again. Grand prize, $1,000 into your trading account. Ooh. Second place, $500. In third place, some kind of swag bag plus a year free of Tradier Pro.
That's big.
And what we're going to do this year, what we noticed is there's a game pin that you can use if you're on a cell phone watching this. Okay. If you have a cell phone on your computer, you can take a QR code. So let me show that real quick. And you can start signing up now. So I'm going to show this after every speaker up until the 1 o'clock hour. Copy that code down. Go to www.kahoot.it, and you can pump that code in. You're going to ask for a name and an email and give yourself a screen name. And once the quiz goes live, I will start it, and you can start answering questions. It's automatically computed based on speed and accuracy. Oh, we have our first person sign up. EJ, that boy, Mike. You're getting it. Very good.
You are.
All right, we'll leave this up for about 30 more seconds, and then we'll move along. So sign up. They'll come in after every speaker. Okay, we want to have a lot of players in this. So be prepared for that. Okay, Molly, you ready to roll?
Let's go. And that code is 907940.
That's right.
You need it.
At www.kahoot.it. We will show that often. All right, we're going to go back to us. Let's get ready for speaker number 1.
Ooh, I love this one. This is one of my favorites.
Dan Raju to start us off, the CEO of Tradier. He's going to give us the kind of the state of the market, state of the union sort of intro. So let's get him out here and get started. Welcome to the Summit 2024. Here we go.
Here we go.
Hi, everyone. Can you guys hear me? Hello? Can you guys hear me? Hey, so anyway, thank you, everyone. Thanks for taking the time. I know it's a very, very important day for you folks particularly because of so much that's happening in the market today, right? It's an important day. The Fed is speaking. I'm traveling. I'm sitting in a hotel down south. By the way, I cannot beat Max and Molly on the way they present the show and the backgrounds included. So anyway, thank you so much. I wanted to welcome everyone. Can you guys get the slides on? So I wanted to welcome everyone to the Tradier Summit sponsored by CBOE. What I'll try to do today. What I'll try to do is to talk about what's on people's mind and what is important, what traders are thinking is important for them today. I'll try my best to set the context for what's happening in the market. What are people thinking about? And I think that will set the stage for why we are having this important summit today. So once again, thank you. Thanks for joining and welcome everyone. So let's go to the next slide. What's on people's minds today, right? We at Tradier we're one of those unique operations where we strive our best to basically stay as close to the trader as humanly possible. We have a great network of community leaders, influencers, educators, and platforms, all of which do one thing. They keep us close to the trader. And we get a tremendous pulse of what's happening in the market. And what are the traders thinking about? A few thoughts of what I have been able to gather talking to that ecosystem of ours is number one, inflation. Inflation is top and center in people's minds. I guess it's top and center on active traders' minds, obviously. It impacts the way they think about their securities. It impacts the way they invest their money. It impacts the way they think about the markets every morning. So that's the number one thing that we see is front and center in people's minds is inflation. The second thing that they're all thinking about is recession. Now I think people do not, majority of the traders and the educators and the partners don't believe that we are getting into a recession, and have been over time, over the last quarter or so, have been building up confidence in the way the Fed is handling it, and much less in the early part of the year. But I think most people are expecting some kind of a rate cut, either to be announced or setting the stage for that today. But that being said, recession is certainly front and center. And I know many of you folks are taking such an important part of the day, particularly with the Fed announcement today, to come and speak to us. So I do appreciate you guys taking it. And recession is important. I think Lex and Molly will try to do the best as the news comes up to keep you posted. One more important thing, if I take a look at the actual activity and then what educators are giving us feedback about, AI, artificial intelligence, is certainly the way they trade, the securities they invest, there's tremendous amount of what we call a subscription understanding, sometimes clear understanding, sometimes unclear suspicion, but still everything around AI and tech in general has a tremendous amount of interest and momentum in the market. That's what we hear every day. And the fourth important, I was trying to list a lot more, but I thought let me force myself to come up with 4 of them. And the next thing that I see is of tremendous value is that the trend towards options, people employing sophisticated instruments like options have graduated from the equity trading world and are using options as a mainstream instrument. That continues. Now, you go through months where that volume keeps on changing, but at the end of the day, if you think on a quarterly basis, there is tremendous amount of interest still in the growth of the options. People are adopting options, and we are trying to play a critical role in letting people get into that instrument in a most responsible, knowledgeable, and a content-driven way. I'm sure there are a few other players in the market who are trying to do that, but that is still front and center in their minds. A few of you folks had asked me to comment about zero DTEs. I think the flare with which people are approaching zero DTEs, I see it a little bit of flattening out in the last month or so, but still there is a tremendous amount of opportunity and growth in people engaging in short-term options. So I think, why is all this important? I think it's a responsibility of folks, all the speakers, all the educators, all the innovators, and all the traders who are today attending, and in the market in general. I think it's important for us to know that we need to provide this, what we call as focus areas, or these focus areas, great amount of tools, good amount of content, and responsible enough education so that we can help people navigate through this. And that's one of the reasons, the foundational stone of why we started the Tradier Hub and these events. And I hope we'll try our best to do it today and going forward. But there's a tremendous amount. We should match these interest points with the delivery of tools, content, and education. Can we go to the next slide? A few other points that I think are super, super important is, I think there is a fundamental shift. I know this is about upcoming events in the market, and elections being at the center of it. And obviously what's happening today with the Fed is another an important event. I think what I notice is that there is a fundamental shift in the way people consume content. This top-down, delivery of content and news, the way traders used to get that for decades, is being completely disrupted by a horizontal accumulation of content that comes with a filter. It comes with a filter of community leaders. I think community leaders whether it is, podcasters, whether it's content creators, whether it is, responsible handles and all kinds of, I think leaders seem to become the source of news. And that comes with a level of context creation and filtering out noise in some case, but always comes with a version of what the community leaders context about the event is. So the journey that traders go through, where they take content and they process it to create context, comes with the context and an association that the community leader has. So I see people getting a side effect or an effect of content coming in through social media is the fact that it comes with a lot of context created by the source. Once again, like I said, if you take a look at the trading volume in the market today, majority of the traders, majority of the volume that we see in the market today are complex orders. I think people have a lot of which was institutional. I see that completely adopted on the retail side. People have strategies to cap their downside risk. So let's not underestimate the potential. I think the idea of traders who are kind of basically, finding their way around the market is kind of long been replaced by a tremendous growth, empowerment, content, education, tools, technology, and to sometimes even gamification. And the sophistication that it has driven, I think we are seeing a tremendous growth of complex orders in the market. And so what is important is there's a huge demand for education. I've been in this industry, I would say this time for 18 years. I've never seen more demand for education than ever before, right? There's a tremendous opportunity for us. It's a big part of why we do the hub. It's a big part of why we try to bring the best to come and present themselves. So I see a tremendous opportunity for us to do even better. Last thing is, short-term options. I still see that 60% of the volume we do today still has basically, expirations of less than a week. So I think short-term options are still important for us, for traders. And I think there's tremendous amount of innovation, tools, and capabilities that I think the market can deliver. So on the whole, right, we are at a great time where for the first time, I think the traditional vertical brokerage model of the brokerage firms coming and telling you, we know who you are, we know what you want, and we'll deliver it to you, is being replaced from a broker-centric model to a trader-centric model, where the trader is at the center of knowing what he wants, demanding what he wants, and we're trying our best through the initiatives like the hub to deliver deliver that. And by the way, delivery of and distribution of trading capability is not about providing an application. It is about combining that. It's about providing that capability along with the partnership, along with value, and most importantly, content. And that's how we believe in it. It is that mission of ours that Lex and the team had started earlier, and the product team at Tradier, the technology teams at Tradier, the ops folks at Tradier have all embarked on this journey to create the hub. The idea was to build a community to bring traders and the best tools and leaders together, right? In a way to help people filter out the noise and get the best education. And today, I wanted to thank everyone who's attending this event as a part of the Tradier Hub, CBOE for sponsoring events and partnerships with us. I mean, today we have over 50 monthly live shows occurring. More and more people coming and watching that every day. More importantly, giving our leaders and traders tremendous amount of feedback of what they care for and sometimes what they just don't care for. We have millions of followers who are basically get to our content on a daily basis, and we are trying to do as many recorded shows as we can, trying to accommodate the tremendous boom in growth in that sector, and including this event. We enjoy doing these events. We spend a lot of time. It gets us closer to the trader. And once again, I wanted to thank everyone for taking the time. I hope I set the stage for today. And I can never match what Max and Molly do on a daily basis, but I tried my best. So, and once again, thank you and welcome to the Tradier Summit sponsored by CBOE.
The world is evolving, and you are different. Choice, that has always been ours. You can chase the trend or choose to trade with purpose. It's time to find the signal through the noise We'll meet you at the beginning.
Catch the options quiz by Kahoot to win great prizes. First place, $1,000 into your Tradier account. Second place, a year's free subscription to Tradier Pro. And third place, a Tradier Hub swag bag. Hello, Mal.
Hey, you guys. Dan, that's not fair. How do we follow that? That is
was
just
great.
not fair. Well done, Dan.
Thank
And
you
by the
for,
way,
yes.
amazing slides and artwork today. That's from Ty. So way to go. Really, really amazing job.
Look at our background.
I know.
It's so cool.
Incredible.
All right, we got to get moving, but I'm going to show that thing again. We're going to introduce Todd Bubba Horowitz in a second. He's my man. So Todd has been, he's like me, a little background like me. We're in the Chicago area on the trading floors in Chicago, SIBO, CME. He's got a long history there. I think if you add our time in the industry together, it's over 100 years or something like that. That's because he's so old. Just kidding. Just kidding. He's awesome. He's a good buddy of mine. We're going to get Todd out here in a second. Let me share my screen one more time. Look at all the people signing up.
Look at that. You have literally run for your money. Go
That's
grab
right.
that one.
We're going to show a banner when Molly and I come on with the information. But what I'm finding is if you go to www.kahoot.it, it's going to ask you for a PIN code right there. That's the way to sign up. Just type that in, 907-940, and we will be ready to roll. So don't forget that. We'll put a banner up every so often. All right, Mal, let's get Bubba out here. Bubba, you're the man, and here we go with Bubba Todd Horowitz.
All right.
What's up, everybody? Welcome, and it's great to be here as part of the Tradier event, and I get to be a time slot hit because I get to follow Dan Raju and, of course, Lex and Molly. So what could be a better spot, me and Banya from Seinfeld? But we got a lot to go over today, and of course, there's a lot of things going on in the market, and I think the first big thing is this afternoon. The markets have already priced in a 25 basis rate cut. I think that the markets will sell off of that, and if it's 50, it gets worse, and if the Democratic senators who sent in and wanted 75, I think it gets even worse than that. But we'll see. Again, we don't make predictions, we make trades, so let's go to it and get started. Let me find my sharing, and I think that should share my screen, right? Is my screen sharing? There we go. So today we're going to talk about using synthetics, but I'm also going to share with you some ideas about yourself, because a big part of trading is recognizing and understanding who you are, okay? And understanding what you're trying to do. And one of the things I always ask everybody is, what are your goals? What are you trying to accomplish when you start to trade? And I think that that's important to understand because, you know, we all hear these promises out there that you can turn 5,000 into 5 million. And we all know that's a crock, okay? We know that trading is hard. It is a grind. It is a job that can make a lot of money, but you got to treat it like a business. So you have to establish goals that go along with what you're trying to get done, okay? And the goals, don't make goals that are unattainable, because you make steps of goals, because every time you reach one, you have a little bit of a celebration. It's good for your positive mental attitude. It's good for the psychology of trading, because those are all things that affect you. I can give you all the tools, but if you can't get in that thing between your ears, then you have a much bigger problem. So I think that you have to be prepared for that. And of course, one of the things that I always ask everybody is, do you want to make money or do you want to be right? And of course, amateurs seem to always want to be right, while professionals like Lex and myself, we want to make money. I'm not interested in if I'm right or not. I'm interested in cash, okay? Because in my opinion, life comes down to two things. One is money. The other is up to you, okay? But it always comes down to two things. And I think that if you go back to the days of Richard Dennis, if you've ever heard the name of the turtle traders, I used to trade with Richard on the CBOE. It's always amazing to me that most traders erroneously believe that they must forecast the future to make money trading. Virtually all trading services forecast because that is what the subscribers want, plain and simple. But we do not forecast anything for one simple reason. We cannot, and you can't either. It is learning to understand how the markets work, how the markets function, understanding the phases of the market as you're trading. And when you can do that, it makes this business a lot easier and a lot more palatable. Now, of course, I'm sure you'll see this later. I'm not making any recommendations. I'm going to share with you some types of trading, but whatever you get from today is not a promise that you're going to make money tomorrow. Okay, so that's the standard disclaimer that, again, I'll share things with you. I'll give you some thoughts of what I'm thinking. But at the end of the day, I am not asking you, nor should you act on anything I do until you make sure that you understand, that you recognize what I'm saying, which also means you stay away from the TV news and you stay away from all the BS out there, because you'll drive yourself crazy trying to follow news items on the TV set, because you've got two different sites of news. You've got one that reads from the right, one that reads from the left. So just be careful about that. And of course, in trading, you're going to have drawdowns. I don't care how good of a trader you are. I don't care how disciplined that you are. There are drawdowns. They happen. They are a part of the business. Now, if you learn to understand when you go through a drawdown period, that is actually advantageous to you, the trader. Okay? Because if you're good at what you do and you learn to understand what your win rate is and what your percentage is, then sometimes when you have the bigger drawdown, as you see here, this might be a time to add on. Now, that would be counterintuitive to a lot of you that, well, why would I add on into a losing streak? Well, one of the reasons that you might add into a losing streak is because you know what your net probability is over time. So the probability of this reversing in your favor is pretty high. So it's something to think about. I'm not telling you to run out and do it tomorrow, but it is something that I use every single day. Okay. And anytime I go through a drawdown, I'm looking for a spot to add on, because I know what my win rate is. And that's one thing you want to learn, what yours is. Okay. Now, again, I am Todd Bubba Horwitz. I've been doing this for 46 years. This is actually my 46th year. I started out at the CBOE. And in fact, I go back to the days they didn't even have put options. So you had to learn how to create a synthetic put. But I do a lot of financial commentary for many networks. I still trade every day. I teach. And of course, when I give out recommendations, I trade everything that goes out of my office. I'm participating right with you. Okay. I have no interest. My interest and goals are simple with yours. And that is simply, let's make money together. Let's learn this together, because education is very important. And believe it or not, after 46 years, I'm still learning, and I try to learn something new every day about markets, that I can figure out new ways to use the option market and other markets to create trades. And if you can learn that, and if you can put your mind to that, and if you remember a cool hand loop, get your mind right, okay, then you have a chance to put yourself in a position to always be profitable over a period of time. And I think it's important to understand. But everything that you need to be great is already inside of you. It is getting through the mental side. Stop waiting for someone or something to light your fire. You have the match. Okay. And again, I'm going to say it again. Trading is hard. There's nobody handing out $100 bills on a street corner. Okay. You have to put in the effort to make yourself a good trader. And any of you who are in business or entrepreneurs, you know that even if you're doing very well, it wasn't easy. So you have to take the time to learn and to educate yourself, and go to other educators to find out what's good and what might not be good. So today we're going to talk about algorithmic trading, false hope and secret indicators, competition, mechanical trading, probability, rules, and examples. And again, we're looking at things that we always want to be better. Okay. So again, we always hear about these false promises. Are you tired of it? Okay. You have to look at yourself and look in the mirror and say, hey, I can do this. Okay. I can become a good trader. Okay. Because it doesn't take a genius. It doesn't take a Harvard degree or anything. What it takes is hard work and the willingness to study, with the willingness to learn and understand how markets function. Because many of you who trade with me during the day, every day on Tuesdays and Thursdays when I'm doing it live, we're looking at these short-term charts and we're looking for opportunities, okay, based on the short term. And there are all different kinds of time frames. But one thing you always want to remember about a market, okay, is all charts are the same. All patterns are going to repeat themselves. The only difference is the time frame. But remember that if you're trading on a short time frame, The long time frame doesn't necessarily have to change. Okay. Markets always have to resolve themselves from the shortest time frame into the longest time frame. So a downtrend cannot start until it starts in like a 1 minute, then a 5 minute, and so on. So if you remember that always, because you got to keep your opinion out of the market, you have to focus on what the market is telling you. And again, if we go back to this real quick, if I look at this chart, okay, the market is telling me right now that there's not much to do. But if I were looking to do something, I would have been looking to buy potentially the euro currency. It doesn't matter what the product is, but there's a reason why we look for these things. Okay. And the charts are the greatest roadmap and the greatest indicator if you learn to understand them and use them. But the first thing you have to do is look in the mirror, because that's your true competition. Okay. Trading is a competitive business. We are trading against others. Okay. We can all make money, but you have to keep that little thing in between your ears out of the way. So look in the mirror, especially when you go into a little bit of a losing streak, because the secret is in between your ears. That's the real secret, is to be able to function and put yourself in the best position. Okay. And I think that you have to look at probability. That is what we are trading. It's a probability model. Options are a probability model, which is indicated through the implied volatility and through everything else that you do. Okay. I think that if you learn to understand the probability side and the probability rate, you will put yourself in a better position. Okay. That's why you have to look purely at the math, okay, of the market. You have to look at the math of the options model, because the options, the implied volatility, if you've watched news, if you've watched TV, okay, you see that markets say that they say on TV, you'll have a commentator say, buy cheap options. There is no such thing as a cheap options. Remember this, options are always fairly priced unless they are expensive, okay? Because there's a market maker on the other side. And if you think that a market maker is going to give away something cheap, you're wrong, okay? But they do get expensive. And as you saw about 6 weeks ago on a Monday, okay, we saw an expansion in volatility where we went from 0 to 66%. And of course, it collapsed. If you were buying options up here, you were getting killed, because there was no way that the markets are going to maintain that type of volatility. So remember that. And of course, professional traders use rule-based trading system. And that's what you need to do if you really want to make money, is to be rule-based. Okay. And that means that if you're looking at a chart, okay, if it gives you an indication that it's going to go higher, that's a rule that you're setting for yourself, that you want to become a buyer. Okay. Or if it looks like it's going to go down, you want to become a seller. Okay. Trading decisions should be made as unemotionally as possible. Okay. These are things that are very important that you're looking for. And as a retail trader, which we all are now, versus a floor trader, which I was, okay, a floor trader, you can scalp, you can do all kinds of things. It's hard to make money trying to scalp into markets now because of the lack of movement, the lack of opportunity, versus you need to be able to find and be with the trend. So when you're trading, price is everything, okay? Ignore the news. The news is old, okay? This is not 1980 when I started, when we had two little 12-inch LED screens that 50 traders were standing around trying to look at and read the news. Now the news is already out. For example, today's rate cut is already priced in. The only thing we don't know is what the rate cut's going to be. Buy something when it breaks out of range. You sell it when the trend changes. Okay. Don't get out before the trend changes. Let the markets work for you. Okay. Stick to your system. So we talk about synthetics. Now, options, being derivatives, are very flexible, and you can do a lot of things with the options. As I mentioned earlier, I started trading before they had put options. Okay. The exchange did not have put options in the original. Okay. So what you look for is you had to learn how to create to get short the market without just shorting the stock, because one of the big things we always have to worry about is the risk that we are taking, the exposure of risk that you put yourself in markets. So if you learn how to create synthetic positions, you are actually going to learn how to create, let's say, a synthetic call, which would be cheaper than the actual call you would buy on the board, or a synthetic put, which would be cheaper than actually buying a put. Now, when you think about it, we used to call them risk reversals. Okay. When I was on the floor trading, we would be able to, a true risk reversal is you buy a call, you sell a put, you're actually long the stock. Okay. And as a floor trader, that was a good trade. Okay. We didn't have to worry about the margin. It's not like being a retail trader. But so what we had to do is we had to create, okay, a synthetic long position and a synthetic short position that also took into account the amount of margin that people had to use. Okay. So we added a wing to it. Many of you might recognize the term broken wing butterfly. We added, if we wanted to be long, instead of selling the naked put, we would sell a put spread. Okay. If we were going to be short, we would sell a call spread. And you'll see how all these works as I show you some examples. But remember, try and look at your weaknesses and convert them into strength. That's success. Okay. And these are things that you have to learn as you go forward. So I always ask the question, why buy stock when you can create a synthetic stock position? Because I can create and control leverage, okay? Because as you know, options are leverage, but you also have to be careful at how much leverage you create. You have to be careful at what you're trying to do, because one thing about leverage, leverage is a double-edged sword. The good news is that you can leverage smaller money into bigger positions, and if it goes in your favor, you can make a lot. However, on the converse side, you can lose a lot, right? If you're getting too over leveraged the amount of capital you have, and this is a capital-driven business, you cannot put yourself in that position. But what you can do is you can cut down the risk and exposure you're taking by learning to use the synthetic. So synthetic long stock in our world is you buy a call, you sell the put, you buy the at the money call, you sell the at the money put, and you buy a put below to determine A, your margin requirement, and B, the risk you're willing to take on the trade. So if you look at a platform and you look at a trade, and I'm going to show some examples, but just real quickly here, if we look at let's say the spider, for example, okay. So if I go and pull up the spider and we'll go to the 27th since it's almost expiration. So I'm going to look at the at the money, which is the 563. So I'm going to create and I'm going to buy a collar synthetic reversal, and then I'm going to buy a put $5 below. Okay. So now I've created, this is the equivalent to a synthetic stock. Okay. It's not quite the full delta, but it is the equivalent to synthetic stock. Now I know, looking at this trade, my maximum risk to the downside is the risk between the spread and the amount of debit that I'm paying, which is $844, but I'm controlling $55,000 or $56,000 worth of stock. Okay. Now, again, the other thing you want to look at is I'm paying $346, which is the same as buying the 563 call for $538. So which is better, paying $364 or $347 or paying $535 for the same thing? Which is a better opportunity? Okay. So you got to think about that. Okay. It's a better opportunity to create. Okay. Now there's a little bit more risk to my trade, but again, my upside is greater. I start collecting faster. Okay. And if it sits, I've taken care of and eliminated a lot of the time decay. Okay. So that's something to keep in mind and remember when you're making trades, because you can create all the synthetic longs you want. And remember, the margin requirement on this trade is only $800 versus if I bought the stock, it's $56,000. Okay. And of course, synthetic short stock, okay, is the opposite, right? So we would take that same position we just created and we would reverse the call to be a short, the put to be a long, okay? And now we would change this put to a call and change the strike from 558 to 568. So now I've created a synthetic short. So now I'm short the stock for the same risk, basically $887. Okay. I've now created the 563 put, which if I bought it on the board by itself, it'd be $630 versus I'm buying it for $387. So again, I asked you, which is a better way? Is it better to buy the naked option, or is it better to create the synthetic? Okay, that's something that you have to keep in mind at all times, because again, I'm saving $3 on the trade to begin with. So I'm already $300 ahead of the game before I start. Okay, and that is the ability to create synthetic longs and synthetic shorts. Now, typically, you would go out a week or so. Okay, that's usually the best, because we also want to combine in what we call the delta roll. Okay, so we take the probabilities. Okay, we don't have to be right every time, but if we take the probability, then we have the opportunity to roll our long option. And we use, for example, here is that same SPY trade, which I did yesterday, so it was at 562. But we use that same theory, okay, of using a 80 to 50 delta roll. So when my long option reaches 80 deltas, I'm going to roll it back to 50 deltas. I'm going to capture some of the profit and still stay in the trade. I know that my short put spread is worthless, and I'm going to continue to play the call. But in the meantime, I'm taking money off of the table, and I'm ready to rock and roll. Okay, and I can continue to do that each and every week. And of course, the reason we do them weekly is because the delta and the gamma change faster, so it allows me the opportunity to roll out and take more profit on a more frequent pace. Okay, and of course, you can do this with any stock that's liquid, obviously preferably ones that have weekly options. But here's an example of the SPY, and when I did it yesterday, it was long. The risk was, the margin cost or the risk was $851 or 1.6%. Okay, so think about that. I'm leveraging $50,000 to $56,000 at 1.6%. Versus now, you want to do GLD. Okay, it's a little bit cheaper stock. It's a little bit less risk because, of course, there's a little bit less volatility. A lot of these things will depend on the volatility. But again, you are always in the business of creating stock, okay, long or short, okay. And there's another way to synthetics that you can use, which is if you have the capital and you wanted to create a synthetic put, you can short the stock and buy the call, okay. Or a synthetic long is you can buy the stock and buy the put. So there's ways to create synthetic opportunities which take less capital. They give you a higher edge when you start your trade, okay, because you're building right into that trade, and you're saving off the top $200 to $300 to $400 right off the top of it, because you're creating an option that's on the board, okay, and in theory you could sell that option and lock in that profit, okay. But again, that's what you're looking at, and here's a for example of a synthetic short in the Qs, okay, which again cost is $695. Okay, you're representing $47,300. And of course, if we look at it right now, if we were wanted to be short, we can just simply look at the Qs. Yeah, go out to the 27th because again, we're a little bit too close. The stock is trading at 473. We'll use the 474 at the money. Okay, so we want to create a short. So now I got to buy the extra call up at 479. Now, this is also something you want to keep in mind. The distance and the width of the spread that you're using, you can change. I use $5 because I like to be in the opportunity if we get a huge move that my extra put comes into play or my extra call comes into play, and I can kind of navigate with that. Okay. But if you wanted to cut the cost down and you were very confident, okay, that you were going to have, you could actually use, let's say the 480, okay, as your long call. You could go farther. You could use the 484. You're just reducing your overall cost, okay, as you trade it, okay, and that is something that you want to look at, okay, because you can now create. Let me just change this. This needs to be a put. There you go, okay, and this needs to be a call. There you go. So you can lower the amount of risk that you have to take or of cost that you have to lay out by going farther in width. And for those of you who create or sell naked puts, I think you're better off selling wide spreads because, again, They cost less, the margin is less, and the opportunity to make money is higher. Okay, again, these are all high probability opportunities if you are identifying the overall chart, if you are identifying the read that you are seeing in the market. Okay, so if you're looking, you can see that we are pushing up against very overbought conditions, which is, again, is why I think that you'll probably see some selling this afternoon. But again, I wouldn't recommend anybody setting up positions into the Fed numbers because the action gets a little bit wild. But again, using the use of synthetics will always save you a great deal of money, because if I look at this trade, I have created the 470 put for $3.09, and the 470 put here is 721. So is it better to pay the 721 or is it better to pay the 309? Okay. Those are things that you always have to ask yourself. Those are questions that will come to you as you work. And of course, one more to look at, and that would be the IWM. And again, it doesn't matter. These were not based on direction. These were just based on giving you an idea of how to create this trade. Because again, you want to remember the ability to roll it up or roll it down, depending on which side you are. But you know your risk when you put the trade on. You know the amount that you're representing, and you know how to capture profits in the middle of a trade by rolling up when it gets to, when your long call or your long put gets to 80 delta. You know to capitalize and roll it back to 50 delta and take some of that money off the table. I think that's a big thing that many of us don't do. And it also keeps you in the market. You know, I'm not a big fan of those who want to set price targets, because I don't know how high or how low something can go. So why not adjust and use a position that allows me to continue to let the market go in my favor while also capturing profit at the same time? Something to think about when you're out there trading and doing your thing. These are things you want to think about as you go forward, because it's important that you always put yourself in the best opportunity. And you can start to do, there's ratio trades that you can start to create using the same types of models. Okay. And you can put yourself in a neutral position that can benefit from either side of the market by creating a synthetic position. And this is a lot of people that don't understand that the biggest thing you have to do in options trading is cut down your cost to start with. And of course, you get a big benefit from that from Tradier because of their cost. And you get a big benefit if you learn how to put the proper trades on, because again, all trades are not created equal. And I'm not a big fan of buying naked options, because I don't think you can ever truly overcome the cost to buy them. There's only one thing that makes it possible to achieve, and that is the fear of failure. So you have to be willing to learn these trades. You have to be willing to make these trades. And I think this is where you put yourself in the position. Okay, so as I started out with, and I hear my music playing, which means they're going to ask you some questions. Okay, what are your goals? Okay, do you want to make money? Or do you want to be right? And certainly, as a member of the CBOE, my badge from 1980, and being a member of the CME and the old Board of Trade, again, your goal here is to make money. Your goal is to be in business. Your goal is to trade and learn. And I hope that you learn from the rest of these people that are presenting today, because everybody's got some good things to say. I know most of them. And I think that if you put yourself in the best position, then you have the greatest opportunity to have the greatest life and make the greatest amount of money. And again, a lot of this has been brought to you by Tradier, because they made trading itself very affordable to do a lot of these intricate and fancy trades, because you don't have to worry about cost. So if you have any questions, I'm here to answer. And I know that Alex and Molly are here to talk to me. So fire away, guys.
Hey.
Bubba, is that really your trading jacket?
It really is my trading jacket.
We did a full circle there.
That's really my trading jacket too.
I'm on a screen with the Titans. These are two amazing market makers, and this doesn't ever happen. So thank you. I feel honored.
Yeah, that was great, Bubba. So, let's have a few questions. I think we got a few minutes here.
I know, but I know somebody asked, what the hell am I doing here? So
And by the way, I encourage the audience to put your questions in the comments, and we can actually show them. I'm going to give you an example. So this isn't a question, but it's something that telling everyone that the hub, you can get this recording at hub.tradier.com. So anyway, put your questions in there for Bubba right now while we're chatting with him over the next couple minutes. So interestingly, you and I come from the market making community, right? And you made a point during your talk about, I'll just call it edge for lack of a better word, edge for market makers versus edge for retail traders, right? And you and I know what the edge is for market makers. You can't have that as a retail person at all. You don't have the ability to buy the bid and sell the offer like you and I did back in the day. You created an edge scenario, right? And that's
correct.
Okay.
I created an edge because we don't get the same edge you and I got, right? We bought the bid, we sold the offer. And everybody thinks when they put an order in and they go, oh, I bought the bid. Well, you can bet your sweet potatoes that if you bought the bid, it'll become the offer shortly. Okay?
That's right.
Okay.
Well, I've had that.
What's that?
I said I've had that before. I've had a retail person tell me, I buy the bid. I said, no, you buy the bid when it becomes the offer.
Exactly right. I mean, people don't recognize that, but you and I do because we did it. That's what we did every day.
Yeah.
Okay.
Yeah.
And again, so you have to create an edge into the market itself. And right. I think you can do that by using some of the synthetic models, because the edge we're creating is we're paying less for the same thing everybody else is paying more for.
Right.
It then gives you more alternatives if you need to adjust. It gives you better ways to adjust those trades versus just holding on to them. Like you buy a long call and it goes against you, you're getting killed on time decay and you're getting killed on the position, and it's harder to get it back versus you use the synthetic. I still have the credit from the put spread that I collected, and I'm not worried as much about time because I have much more time to make the trade work.
Right. So we do have some questions from the audience, but let me ask another one here while you said that. So you're essentially using that in the long synthetic, which means buying the call, selling the put, and you have a protective put beneath it, right? So
right, the protective put is to protect against the margin that it costs, because of course not everybody's got $56,000 laying around.
That's right. So now what happens is you've stopped yourself out. You have a put spread, like you said, and you're using that credit on that put spread to finance that long call, as it were, right?
Correct.
So someone asked, I think you said it, when do you roll that call? I think you said 80 delta. Was that accurate?
Yes.
Okay. So when
I roll it 80 back to 50.
Okay. So you're selling that 80 delta call that was previously the same strike as the short put up to the 50 delta. Now you've got this 50 delta. Do you ever roll that put spread back up? Ever? Probably not.
I don't roll it up during the continuation of a trade. I'll reposition it the next week, but I don't want to add risk to the trade. I want to take profit from the trade. And then if I'm going to reposition the same thing for the following week, then I'll redo the entire trade for the next week. But I don't like to typically roll the put spread up because I don't want to add risk to an ongoing winning trade.
It makes sense. Okay. Ready for this, Bubba?
Mm-hmm.
Can you see that?
Yep, I do. I have two. And if you want one of my books, you can email me at bubba@bubbatrading.com. I'll be happy to send you a PDF file of my books. I've written two, Bubba's Guide to Trading Options and Bubba's Guide to Trading Weekly Options.
All right.
I've written, and one's on Amazon, which I'd rather give it to you for free than you buy it from Amazon. So just bubbatrading.com.
All right. How long did it take you to write that book?
What's that?
How long did it take you to write that book?
About a year.
Yeah. See, I'm trying to write a book too. It's taking me too long. I mean,
it's a lot of work because, one of the funny things that I always tell people when I teach is that I'm teaching you to what's happening right now. I can't account for what's going to happen tomorrow.
Right.
Okay? I have to be able to teach you for the conditions of the market today. Okay. Versus the conditions of the market 6 months ago have nothing to do with it. And I can't look forward. I have to teach you with what's happening now. So when you're writing a book, you have to try to account for all these different scenarios, because we've all seen the story. A company comes out with great earnings and the markets explode and the stock's going crazy in the morning. But the truth is they already priced everything in. And by the afternoon, that stock is getting clobbered.
Right.
I think one of the greatest things about you is that you're a true mentor. And I think, also being a market maker and having the tertiary effects on options and just knowing that, I think when you, under the pressure of trading and sticking to that discipline, you reveal a lot about your personality. And I think you guide people through that. And I just love that about you. It's really incredible.
I appreciate it. Well, again, I think one of the hardest things that everybody has to remember. I put the email in the chat box, by the way.
Okay.
I think one of the things you have to remember is you can't get emotional about this business. Okay?
Right.
If any of you watch the movie Wall Street, Gordon Gekko says in the beginning, you can't get emotional at stocks. But how did he lose all of his money? He got emotional at the end. You have to let it go. Again, Lex, have you ever had a losing day?
Oh God, yeah, more than winning days, probably.
I mean, have you ever made a bad trade? Have you ever made a mistake? We've all done it. Listen,
Yeah.
Nobody's ever not done it. So don't let me tell you that it doesn't happen. The hardest part is to deal with between your ears. That's the hard part. And if you can deal with that, then you're putting yourself in a much better position to be successful. That's what it comes down to. It's a mental game. I would say trading is probably 90% mental.
Right.
Oof.
I agree. Let's go to another question real quick. We got a lot of questions, so let me put another one up. Here, see this one, Bubba?
What rule do you do to determine short versus long synthetics? Well, it's not necessarily a rule. It's actually if I'm looking at the chart and the markets indicate to me that we're either at resistance or we're overbought and I'm looking for a short position, then I will use the short side of the market. Okay. What I'm looking for is I'm looking to catch the overall trend. I'm not trying to guess which way the market's going. I'm watching the chart, and the chart, if you look at, there's different phases in the market, and to sum it down into three simple markets trading consolidation. They break out to a trend one way or the other, and then usually they blow off. So what I'm looking for is that when they're either at the top end of consolidation, I'm looking to possibly create a short position. If they're at the bottom end, I'm looking to create a long position. But if they break out to a trend, then I want to jump on that trend with them. Because again, I want to be with the market in the path of least resistance.
Got it. Okay. Ready for another?
Yeah.
You got a lot.
You go all day, but
I know you can. I know. Except when it's time for, the cocktail hour, you want to go to bed. I get it.
That's true. That's true.
All right. Well, here you go. I think you just said it, but I just did that one, didn't I?
Yes, you did.
Okay, wake up, Lex. Go ahead.
Can you share why you use weeklies versus longer? Yes, I can absolutely share that.
Okay.
When you're using the strategies that I'm using, you have there's two defaults there. A, if I go longer, the extra put or extra call I'm buying is going to be much more expensive. Okay. So it makes it much harder to make money, and that cost grows exponentially over time. Number one. Number two, the ability to roll. If you ever looked at the volatility chart and you look at, let's say, you open up one that's got, let's say, 14 options on it. Okay.
Right.
In the near term, the top to bottom delta calendar will be, let's say, from 80 down to 10, versus if I go out 3 weeks, the delta spread will be from 60 to 40. So I want that ability for that delta to get to 80 so that I can roll and lock in the profit. That's why I use the shorter term option.
Okay. And you like these weeklies, right?
I love weeklies.
Okay. Do you ever?
It's almost the greatest invention other than dailies.
Do you ever use the SPX for this stuff? Because that's more of a macro sort of direction as opposed
I haven't used the SPX because I have a little bit of trouble with the liquidity, especially if I have other people trading with me.
Yep.
I mean, they're liquid, but not that great. And of course, the XSP, which more people can trade, which is the smaller version, the mini version.
Yep.
I have no problem trading the SPY, and I think it's easier. It's much more liquid than anything else. And of course, because of our cost to trade here, it's so inexpensive that it really doesn't matter. But the SPY, it works. Listen, I've done it with the S&P, futures as well.
Okay.
The strategy that I'm giving you can be used on anything. The biggest thing I can warn anybody is make sure you understand the risk and the amount of leverage that you are taking. Okay. Because you can leverage up a lot of money with a little, but that puts you in the poorhouse faster than puts you in money. So just be careful. Make sure you recognize, like, one S&P is $56,000 worth of leverage.
Seems like a lot. Not for you, though. All right, here's another one. Ready?
I just think that we get spoiled and we make mistakes, and if it goes your way right away, it's very exciting to have the profits you make when you're leveraged too high.
Right.
But of course, everybody forgets about the other side, which is the losses. And I don't think that anybody should ever leverage, depending on the trade, but 2 or 3 to 1 is about the max you can do. Now, I carry some trades. One of my portfolios is leveraged at 11 to 1. But I have the cash. If I have to come up with it, I have the capital to go back and get it and put it in if I need it. But I don't recommend that. I think that 2 to 3 to 1, and you got to learn to feel the thrill of victory and the agony of defeat. Okay. Again, It's not that easy, and this is hard work. Again, I'll say it again. Trading is hard.
Yeah, it is. So you said something about cost. I'm going to give you a layup that I hope you get the right answer here. Okay, you ready?
Yeah.
Which retail broker provides the best complex options trading execution, please?
Tradier.
Oh my God.
Listen, I got to tell you something. Now, I've been with Tradier longer than you.
That's
Okay.
you might be right. You're right.
I am right. I was with Tradier from the very beginning. Okay. And Dan Raju and me had lunch together in New Jersey, I think I'm going to say 10 years ago.
Okay.
And they're by far the best broker. They are by far the best customer service. Okay. And again, I always hear, people bitching and whining. There's a little bit of problem. Something goes down. But Tradier has always answered and they've always responded. Yeah. And again, how can you beat the price?
Yeah, no, I agree. One thing I'd also add too is, in this, that question was about execution quality a little bit. So my opinion, and you tell me where I'm wrong here, Bubba, is that all these brokers, all the ones that we know about, the big guys, us, everybody, we're all using pretty much the same managed routes. It's hitting the same market maker community. You know why? Because the market maker community is now about 10 people deep, and it's not people anymore, it's institutions.
Right.
So they're going to the same people. Now, I've heard that sometimes fills are better here versus there. That's almost impossible to be uniform because anyone who's sending order flow has an execution quality that has to be met. And if some market maker's not meeting it, they're going to go on the bottom of the wheel. That has nothing to do with any one of us brokers. That's the routing mechanism.
That's a crock. Okay.
Yeah.
Look, maybe one day I'll get 4 or 5 cents better here.
Yep.
Somewhere, but over time, it all adds up to be the same thing because everybody's doing the same thing. They're all going into the same thing. And It might be a matter of you might have put your order in 10 seconds later than I did. Okay. Again, if you're going to worry about the 3 or 4 cents on one fill over thousands of fills, then you're probably not in the right business. This is a business that I can't worry about that little stuff because it's all going to be different.
Right.
And if I'm always shopping to get the best possible fill, I've never had a bad fill through Tradier. Listen, I have brokerage accounts at Thinkorswim and Schwab and others. But again, when it comes down to it, 99% of my trade, and I trade a lot, goes through Tradier because I get the best fills, I get the best service, and the cheapest cost to execute. So where else am I going?
And you get to talk to me once in a while when you.
I love to talk to you.
All right, question. What's your favorite setup for FOMC days? And the answer might be none.
Actually, I do. I have a trade that I do love for FOMC days, and that is a weighted double diagonal in the indexes. Okay. In other words, it's a trade that is neutral going in, but if it explodes up or down, I've got an extra put and I've got an extra call that I can get paid off on. Plus the fact that if I get paid off, I get to keep the trade and start to play with it and sell dailies against it going forward for as long as I put the later date expiration on, which I have on right now. I have on that position in the Qs, I have that position in the SPY, and I have that position in the IWM.
And what's your anticipation for today? What's going to happen today?
I think they're going to crush them. Okay. I think that the 25 basis points is already accounted for. Anything more would send fear to the market because I think we are in a recession. And I think there's a lot of problems out there. And if the Senate, which sent Chair Powell a letter to try to get 75 basis points, I think the market would collapse at 75 basis points. Mm-hmm. That's an opinion. Don't trade off of that. That's just my opinion.
Fine print.
And then we have time for one more, Bubba. Let me get this, and I'm gonna help you answer this because I know what you're gonna say. Does your broker have a tool to analyze the risk of your trade? Yes,
they do have it, but can I say one thing here?
Oh God, don't cut on the.
One more. Can I say one more thing?
Okay, go ahead.
Okay, you really should learn how to assess the risk by yourself. Okay, tools are great, but at the end, you'll become a much better trader if you can identify the risk. I'm going to just say, Lex and myself, when we traded on the floor, we had no charts. We had to keep track of our positions. We had to keep track of our own delta. We didn't have any of the sophisticated tools. And somehow we managed to make it for a long time. And I think if you learn as a trader, retail-wise, how to track your own risk, okay, you'll know exactly what it is. It will make you a better trader. It will make you a more efficient trader. And you will make more money in the long run.
And by the way, for the relevancy of that, as just an analogy, I'm getting my pilot's license and they teach you if your instruments go out, you need to know how to do it. Same with sailing. If your instruments go out, you've got to make sure that you can rule with start. And so when we talk about data integrity that's about to come on with quantum computing and AI, it's really important to make sure you keep your eye on your stuff.
That's why you're the best, Molly.
Molly.
The
California girl, they're talking about
the brain of the operation is here.
She's the brains, all right. That's for sure. All right, Bubba, guess what time it is? It's time to say goodnight.
Time for me to say goodbye.
Time for you to say goodbye. We're going to miss you, baby. Good job. Way to go.
Thank you, everybody. I appreciate it. Have a great day.
And it's Bubba something. Where's your Bubba at BubbaTrading.com. Send him an email. Bother the heck out of him.
That's okay. I'll answer every one of them.
All right.
Amazing mentor, this one, you guys.
Yeah, that's right. All right. See you, Bubba. Take care.
Bro. Appreciate it, guys. Have a great day. Enjoy the thing.
Thank you. All right, Ma, we're going to get ready for... That was cool.
That was cool.
So that last screen for everybody. Yeah, that's where you can find Bubba in his live trading room. So, and I think it was Tuesdays and Thursdays.
And he's a blast, by the way. It's really fun to watch, Bubba. It's really fun to watch.
Yeah, he's great. All right, guess what? I got to show another cahoots, folks.
Oh my gosh!
If everyone were in this room, don't forget we got to sign you up. Kahoot.it. That's our PIN number. This quiz is going to go at 1 Eastern time. All right, so keep signing up. I'm watching. We need to get hundreds of people signed up on this thing. So have at it, right? Molly, by the way, presenters and you and I are not allowed to play.
I was going to ask, are we allowed to play?
We can play, we just can't win. So if we win, it doesn't count. Okay? All right. Next up, Ed Tom of SIBO. Now, this guy's really, really smart. Not to say that Bub is not smart, but Ed is, I'm going to have him say his title, because SIBO has these really long titles. They're very intricate. I love them. We're going to talk a lot about volatility, VIX, and anticipated market events. So I think Ed and I are going to do a combo together. He and I are going to chat a little bit. He's the brains behind the operation. Trust me. I'm just going to play Ed McMahon. And I know for all the people on here are way younger, they don't know who Ed McMahon is. So I'm going to be the dumb sidekick here. So let's get ready for Ed from SIBO. You ready, Mal?
Here we go, Ed.
Let's do it. Hello, Ed. How's everything?
Hey, Lex. How you doing? You are way too humble. You're one of the smartest guys I've met so far. So 35 years of industry.
Not at all. Not at all. I appreciate that. Thank you. So good to see you. We were having a little technical issue. You think we've gotten beyond that, I hope?
Yeah, I hope so.
Okay.
Yeah. So what's going to happen is that your team backstage is going to flash the slides so it doesn't tax my computer.
All right.
So yeah, I think we'll run it like that.
Okay, that's great. So I'm going to have them do that when they're ready to send those slides up. Have at it. Let's get to it. So Ed, you drive the bus and I'll chime in. How's that sound?
Sounds good. Yeah.
All right.
All right. So just by way of introduction, my name's Ed Tom. I'm a senior director at SIBO within the Derivatives Market Intelligence Group. All right. So let's get on.
Okay.
Next. All right. So I think to start off with, what we're going to do is just kind of like a little recap of the markets since COVID. So basically, we're just going to try to understand how we got to where we are right now. All right. So next slide. All right. So since COVID, the markets have rallied 22%, and that's amidst an increasingly stable market. So the way that we measure the stability of the market is using the VIX, and the numbers that you typically see for VIX, the normal VIX levels around 18 to 20. So what you've seen in this graph over here, back in 2022, VIX was averaging a little bit high, 26, right? But over the last 3 years, you've seen it decline, right? So from 26 to 17, and this year, VIX has averaged around 14. So just to kind of get everyone's bearings, the lowest level of VIX historically is somewhere around 11 to 12. So 14 is pretty low. All right. So what that basically is signaling is an increasingly stable environment, very good for the markets. So we have a graph all the way up to the upper right where we kind of map out the relationship between VIX and S&P, and what you're seeing is like an inverse relationship, right? So VIX as VIX declines, then you see S&P rise, and vice versa. Like when you see VIX pop, that's negative for the market, and you start to see S&P decline.
Yeah. So let me jump in here, Ed, if I can. We talked about this a little bit. Does VIX ever go up when the market goes up, when the S&P goes up, the SPX? I've seen that. I mean, I guess I should answer the own question, but I don't know why. I've seen it go up on occasion when the S&P goes up. What's going on there, do you think?
Yeah, so that's a fairly unusual situation. So I would say about 85% of the time you see that inverse relationship, right? And then maybe about 15% of the time, we see situations where the market's grinding higher and kind of like hitting that resistance level, so breaking new records, right? And then volatility traders at that point are saying like, I know the market's going up, but like I don't feel good about this. So what I'm going to do is I'm going to buy some more puts to protect my downside, to kind of lock in those gains, right? So those are the times when you see VIX go up and the markets go up. And then there are very rare situations where what options traders are not buying are puts, but they're rather buying calls. So what they're saying is that, like, the market's going up, I'm going to lever into this rally, so I'm going to buy more calls, right? And that in turn pushes up the price of volatility, which is reflected in the high levels of VIX.
Got it. Okay, cool.
Okay. All right. Next slide. All right, so the five main catalysts that the option markets are dealing with right now. It's the upcoming autumnal seasonality, Q3 earnings, U.S. presidential elections, the interest rate landscape, and year-end positioning. All right, next slide. And so on the right-hand side, I've listed the indicators from the option markets that kind of reflect these risks, right? So for the seasonality aspect, we're going to delve into the volatility and vol land surface. For Q3 earnings, we're going to look at skew and implied distributions. For U.S. presidential elections, we're going to take a look at the implied volatility term structure. For interest rates, we're going to look at the market correlation structure. And for year-end flow, we're going to take a look at put call over interest.
Okay, let me jump in here. So I'm not sure everyone understands vols and some of these terms. Let's just define a few of these. So what do we mean by vol?
So vol is basically the stability of volatility. So basically, the interesting thing is that it almost doesn't matter what the absolute level of volatility is, as long as it's fairly stable, right? So right now, like we're in an environment where VIX is travels somewhere between 17 and 20 or so, which is considered like a little bit high, right? But that's okay as long as the traders have taken that into account, right? But it's the whippiness of VIX and volatility that kind of drives a lot of the uncertainty. So a good example of an environment where you can have like high VIX, but yet stable vol is the run up to the tech bubble. So basically from 1998 to 2000, where we had increasing levels of NASDAQ, and during the entire time, VIX is around 40. But for those 2 years, the markets were rallying, right? So,
okay. So you ready for my analogy of vols for the folks? I'm going to put this in my Ed McMahon terms. So I had a pro golfer explain this to me once, a real professional. He said, and he had no idea what vol was, nor was it even pertinent. But this is my analogy for folks. think about a professional golfer. Okay, they're very good. They have a very low handicap, and they tend to shoot around the same number all the time. They don't vary very much from a 68 generally. A real pro, right? They're right around 68 all the time. They might shoot 70, they might shoot 65 once in a while, but it's really, really tight around their mean 68. Whereas someone like myself who stinks at golf, have a high handicap, I could shoot literally an 80, but I could shoot 120 too on any given day. That's a high vol of vols. I've got a wide spread there, right? Does that make any sense at all? Am I on target there?
I love that, because as a high handicapper myself, like that really speaks to me. So, Alexa, that's a perfect analogy. That's great.
All right.
Yeah.
All right. What's the next one here? Skew and implied distribution. Oh, go back there. There you go.
Okay. All right. So what skew is? It basically is the measure of the demand for puts versus the demand for calls. So basically, there are two terms that we use. When there's a higher demand for puts versus calls, we say that skew is steep or high, right? Skew is high. And when there's a relative demand for calls versus puts, then we say skew is flat, or we say that skew is low.
Okay. Again, back when I first entered the business, which was in the 87 crash, right around there. So that's a long time ago. There was actually no skew back then. It was probably inverted the other way. So that was the first time that the market making community who sets prices said, wait a minute, downside velocity is way, way higher than upside velocity. And we're going to make you pay for these puts a little bit more to own them. So they created this skew thing. The skew then is what delta option do we typically measure, do you think, to see how steep a skew is? From what put to what call would you say, roughly?
Yeah, so roughly 25, 30 delta. And basically what that means in real world terms is that, when we say 30 delta, we mean that there's a 30% probability that the option is exercised, roughly.
Okay. Yeah. Okay, so we compared those two. And we had functions in the trading days where we would have a definition of that relationship of that 25, 30 delta. And we would code it so that we could move that skew and see when it's flatter and when it's steeper. We hardly ever see, that skew invert today. Occasionally we do though, right, Ed? We saw it in GME a little bit, some of the single name stocks, and I think we saw it somewhere else. I can't remember. Do you remember? I forget where.
Yeah, pretty much like anytime you're evaluating like a high growth stocks, very popular stocks, like even NVIDIA, right? So where the risk is to the upside as much as to the downside. Right? Okay. That's when you see like more demand for calls relative to puts, and skew flattens. Got it. But at the index level, it generally for U.S. indices like the S&P, you see a downward sloping skew, meaning that that there's more demand for puts. Right. Now that's not true of Asian markets. So in Asia, like there's a tendency to take a much more positive view. So that basically they're playing for a run up. So in that for like let's say the Korean markets, for some of the Chinese markets. You actually see a relatively flat skew. Got it. Okay, good. All right. Anything else on this slide, Ed? No, I think we'll walk through the different concepts as we discuss. Perfect. Let's go to the next one. All right. So I think this is something that everyone knows and feels like. As we go into the August months, September, October. There's just a high degree of volatility. And I just kind of want to like quantify this. So the graph on the left-hand side is just to kind of like prove that, yes, indeed, September, October really is more volatile, has more drawdowns than the other months, right? So there's two patterns that you're seeing. The first pattern is that like in the summer months, like you basically see like less, basically greater stability, less big shocks, right? And then obviously, like as we run into September, October, then that's what we evidence like a higher degree of large drawdowns, right? And the way that I'm measuring large drawdown is like a 2% one-day move in the markets, right? So I think a fairly fair question to ask is, okay, well, what if like we as we progress into September, October, what if we see the market correct, let's say 15%, right?
Mm-hmm.
And the reason why I picked 15% is that, okay, well, that's essentially a correction back to the beginning of year levels. And keep in mind that when I say the beginning of year levels, that's essentially the high of the S&P basically throughout history, right? So that's the highest point of that the S&P has realized up until 2024, right? So so the question is, okay, well, is the market prepared for that?
Yeah, I would think if that were going to be the case, I would think we'd see higher VIX right now. I don't know. I mean, am I wrong about that? I mean, VIX being 14, I think you said on average this year, and where it is now, I don't even know where it is now. I don't have it in front of me. It doesn't seem very scared to me.
Yeah, right. So basically, the way that the options are, the VIX futures are pricing, it's not basically taking account like it's not pricing in like a very high probability of the market correcting to 15.
Okay.
But I mean, like at the same time, like as we'll discuss a little bit later, like we saw like last month a 1-day move of S&P down 5%.
Yep.
So yeah, like three of those days, and we're down to 15, right? So
that's right. Yep.
So we're just trying to do a thought experiment, like like how resilient are the equity markets at this point, right?
Yep. So VIX is 19 right now from Joshua. Let me put that out there. There you go. Thank you, Joshua. Appreciate it. Real quick, while I'm looking at it, Randall, which definition would you like repeated? Sorry. Just type it in there and we'll get to it. Okay. Do we need to go to the next slide?
Yep.
Okay.
Okay. All right. So we're just going to discuss a little bit of how the option markets are priced in for resilience. Okay. Next slide. Okay. All right. So basically, like these two slides kind of like show like how volatility traders kind of position for the upcoming seasonality. So these are two graphs. So one is of volatility, and the second one is of vol like by month, right? And I think the takeaway is that like in both cases, volatility traders are positioned for higher levels of volatility in September, October, both for VIX, which is basically the proxy for S&P options, and for vol, which is the proxy for VIX options.
Okay.
Okay. All right. Next.
Wow.
All right. Yeah. So basically, like, okay, as you recall, like we said, okay, well, over the last 4 years, we've seen a decline in VIX levels, and from a seasonal perspective, volatility traders generally tend to basically have a very complacent view of risk in the summer months, right? And then later on, as we get out of Labor Day and head into Q3, then they start adjusting the volatility surface, like raising the price of risk, right?
Mm-hmm.
So what happened on August 5th? August 5th was the date of the yen carry unwind, right? And as you recall, that was a day where pre-open, the Nikkei dropped 12%. The S&P responded pre-open by dropping 5%, and VIX surged from 23 to 65, right? So basically, what that kind of means is that, like, okay, well, the option markets, we're kind of expecting like daily moves of 1.5% at most, right? And that 5% decline pre-open was basically a 3 standard deviation move, right?
Right.
So traders were really caught flat-footed with that move.
So what is I know some folks aren't going to know what the yen carry unwind is. Tell us a little bit about that trade. What happened here to cause this event?
Yeah, so basically, the yen carry unwind is basically like the result of a trade where traders are looking to kind of like fund their positions using basically cheap interest rates, which basically is represented by the yen. So so the yen basically has declined for the last 14 years straight due to their interest rate policy, right? So the Japanese interest rates were near zero. So what they did was they said, okay, well, let me short the yen because that goes down reliably. And what I'll do is I'll take those funds and buy something that goes up, aka U.S. stocks. So so the yen carry trade basically says, okay, well, I'm going to use my short yen to fund a position in S&P or Nasdaq.
Okay. And then the unwind part of is what causes doing the opposite of that, to close that down.
Exactly right. Yeah.
Okay.
So basically, as when the BOJ said, like, you know what, we're going to start raising interest rates after 14 years, right? At that point, traders said, whoops, like, so my funding is actually going to increase. It may not be worthwhile to carry this position anymore. So I'm going to take it off. So what I'm going to do is I'm going to buy back my short yen and sell the S&P.
And then you're saying your graph here shows that we went from a VIX 23 up to 65 during this time. Is that accurate?
Yeah, and that's a overnight move.
Right. So yeah, I was going to say one point to remember too, from my market making days is that, we make markets on the other side of this, right? So we're making bids and offers. Anytime that a market maker or a market making firm has an influx of demand for something, the price is going to change rapidly, right? They're not going to stay and sit there and keep selling the investing public puts at the same level, right? Makes sense. I'm going to raise my offer. I'm going to raise it again. I'm going to raise it again until I find some equilibrium. And if I don't find equilibrium, it's just going to keep going up, right? Even the really, really wealthy businesses today that are making markets have a finite limit at some point. They have a risk threshold. So it's important to know that. And for you retail folks who trade illiquid things, that concept is worse because the market maker in that illiquid stock, it's probably just them making the markets. They have nowhere to lean. So it's going to see a lot more flightiness, and that vol all of a sudden gets crazy, right? So, just be careful of that sort of thing. Sorry.
Yeah, no, it's totally right. So the interesting thing about that effect, I mean, like we could have this full discussion on that in and of itself, but what happened was that generally, like when there's panic globally, and it doesn't matter that this originated from Japan. Generally, what people do to kind of protect themselves is they run to the most liquid asset, which is S&P. So in this case, the most liquid protection is S&P options.
Right. Okay.
All right, next. Okay. All right. So over here, we're going to discuss the takeaway from that. So as you recall, we discussed that. Okay, well, generally, what volatility traders do, like during the summertime, they're relatively complacent. They price in low levels of risk, and then as we head into September, October, then basically they raise the price of risk. Okay. So the graph on the left hand side, we're basically putting some granularity to that statement, right? So rather than mapping out the levels of implied volatility by month, what we kind of do is we kind of zoom in and say okay, well, what does it look week by week, right? And the two colors to kind of focus on are orange and red. So those are the months of September, October, right? And what we're seeing is that volatility traders start raising the price of risk starting the third week of September on average, right? And that just happens to coincide with the beginning of Q3 earnings season. So Q3 earnings start basically the second week of October. So what they generally do is they say, okay, well, as we come out Labor Day, I still have a couple of weeks to kind of raise my vol surface, right? So by the third week, I'll get ahead of the game and raise my vol surface, and then 2 weeks later we're going to hit Q3 earnings, right? So generally that's the pattern that what happens, right? So because of the August 5th unwind, and we recall that the volatility traders were caught flat-footed. They essentially marked up and accelerated their pricing of the volatility surface. So they said, you know what, that shock was so huge. Rather than bringing down the price of risk over the next 3 weeks until we hit the third week of September, I'm going to keep it at these fairly high levels just in case something happens, right? So the graph on the right-hand side, it basically shows the change in the vol surface before and after August 5th. So recall that after August 5th, a few days later, we basically the markets basically normalized, right? But the volatility markets did not. So what we're seeing over here is that skew has steepened and the level of volatility has risen per the market makers.
So can you see when I shake my mouse on the screen here? I don't know if you can.
I don't.
Oh, sorry. Okay, so that arrow in the middle on the right-hand graph, that's the vol surface going higher at large.
Yes.
But you can also see the steepness of that curve too. So it's flipping that left side of the curve, that put side of the curve is starting to steepen itself on top of the whole curve moving up, right?
Yes, okay. Exactly. Yeah.
And that came from that August 5th yen carry unwind. That was
right.
That problem. Okay.
Yeah, that's the aftermath. That was the takeaway. The takeaway was that, you know what, even though markets are more normalized, I'm still going to keep the price of risk fairly high, and therefore the price of optionality high. Okay.
Right.
All right. Next.
Yep.
Okay. All right. So basically, we had our first test of this brand new vol surface the first week we came back from Labor Day. So as you recall, the first week of Labor Day, during that week, the S&P declined 4.25%, right? So based off of bad job numbers and some questioning as to whether the AI rally was over, right? So so basically, what we're looking over here, this graph, what this graph shows is that for a 4.5 down market scenario, what did the volatility market expect the VIX to be, right? And according to the skew, we'll expect it to be around 22, which is pretty much exactly where it ended up after that 4.25% decline. So that's good. So that means that the markets really are prepared for a fairly decent sized drawdown. So it doesn't need to kind of reprice. It doesn't need to shock. Given 1, 2, even maybe 3% rally decline in S&P.
Yeah. Okay. Great.
All right. Next
slide.
Okay. All right. So we're going to step into Q3 earnings a little bit. So basically, the first report is essentially the second week of October, right? And what we kind of focus on when we take a look at earnings are two things: the volatility and the correlation structure. So over here, I use the term dispersion. So dispersion just basically it means the opposite of high correlation. So high dispersion means low correlation, right? And there are two things that are really important to long short stock traders as to kind of be able to monetize their ideas. The ideal environment is one where we have low levels of correlation or high levels of dispersion and fairly moderate levels of volatility. And the reason why that is because think of a situation where the stocks are fairly highly correlated, right? Let's say pick two stocks. Let's say Home Depot and Lowe's, right? When stocks are highly correlated, even if you pick the right stock to outperform, they're not going to move very far away from each other, right? So basically, this spread is going to be fairly tight. So what that means is that, rather than taking time to kind of pick stocks, for the most part, all stocks within the sector are pretty much going to move in line with the sector, right? but when dispersion increases, well, then you start getting like widening in the performance differentials, right? And therefore, a high dispersion, low correlation environment is very good for stock pickers. It's very good to kind of like monetize ideas, right?
Yeah.
And what we're seeing on the graphs over here on the far right is that we're entering a level, a situation where we've come off from very low levels of correlation, very high levels of dispersion, and that's beginning to moderate. So I think the takeaway is that it's going to be a little bit more difficult environment in Q3 for long short stock pickers to kind of like be able to monetize nominal profits.
Okay. It does high dispersion or low dispersion for that matter, can VIX signal any of that at all, or not really?
So VIX is only one part of the equation for when we take a look at dispersion or correlation. The other side of the equation is single stock volatilities, right?
Okay.
So basically, what correlation is the interplay between VIX and the individual single stock volatilities, right? And the way that we measure that is on Bloomberg, there's an index COR1M. And basically that essentially is the VIX for correlation, and then DSPX is essentially the VIX for dispersion.
Okay, good. And that's a product from you guys, right? From SIBO, the DSPX.
That's right. Yeah.
Okay, doesn't trade yet. It's a cash value, right? It shows it doesn't. You can't trade DSPX yet. Is that right?
That's right. Yeah. So it's a market indicator in the same way that VIX is a market indicator.
Okay.
All right.
Got it.
All right. Next
slide.
Okay. All right. So the one cool thing about options that like it prices in views for where volatility traders think that any particular stock is going, and that's particularly important going to earnings. So the two things that we kind of focus on as we go into earnings is where we think that any particular stock is going to move. Is it going to move up or down, right? And how large is that move going to be, right? So over here, I have a graph of the Mag 7, the earnings report date, and the current expectations that are built into the volatility surface for upcoming earnings. And now keep in mind that this is going to change, right, as we progress into earnings, right? But I just wanted to kind of like show that this is something that's priced in for like any liquid stock within the option market.
Yeah. So let me make a comment here too. So you list the Mag 7 down here, Tesla on down, and NVIDIA, right? Earnings date, option implied move. So one of the there's a little formula that the market makers use. I won't go over that now, but that's how we get to this number. In the old days, I'm sure you have a fancier version of it now, Ed, but we had a very basic one that got us to the ballpark of what the expected move was for earnings. And there's another one that isn't nearly as close, but again, like dropping grenades, you just get close and you'll do some damage. I like to look at the money straddle of that earnings month in question, right? Whatever that straddle adds up to be, let's say it's 27 points, right? You can figure a plus or minus move of about $27. Market makers are already pricing that in. Now it's not exact. I want to stress that there is a formula that makes it more exact, but again, we're sheckling a little bit on that. Now my question is, I can get to the first three columns. How do I get to skew bias? Ed, how do we know negative versus positive?
So basically, like as you recall, like we track how the skew evolves over time. So basically, like we take a look at essentially the spread between the demand for puts versus demand for calls in a volatility space, right? And how that progresses over the last. Well, we look at it over the last year, right? But for earnings, we want to take a look at like how that spread progresses over the last few weeks, right, coming into earnings, right, and then that's how we kind of determine the skew bias, right.
Okay, so if puts get steeper, I mean, if the put calls get steeper, meaning puts get higher, that's considered negative.
Yes,
Okay.
Exactly right. Yeah.
Okay.
And it's interesting that you mentioned the straddle, because the graph on the right where we show the probability distribution for NVIDIA, that's how we create that.
Oh, good. Okay.
Yeah. So basically, we string together like flies,
Nice.
to build out that probability
Perfect.
distribution. Okay.
Awesome.
All right.
Okay. Good.
All right. Next. Okay. All right. Yep. So obviously, like we're going to discuss a little bit about like how the aftermarket is going to price in the presidential elections. So I would say, like, there are times when the option market doesn't really care, either way, like, whether which party wins. And if that's the case, then basically we see like a fairly like well-behaved, smooth term structure. But in this case, what we're seeing is a very large kink in the term structure. And what I mean by kink is that, see the little hump over there for November. So what that means is that, like, the VIX options are pricing in a higher degree of risk for basically the election day event, right? So the amount of volatility that we're seeing priced into the VIX term structure is an extra like 2.5 vol points. So what that means is that, like, the option market believes that, like, the outcome of the presidential election is going to add significantly more volatility to that day's or that week's of trading for options.
Okay, so they are pricing a little bit of some uncertainty here, right? A little bit.
Yeah. So like, well, what's interesting is that, like, usually, like, this kink ends like the day after election day, right? But in this case, what we're seeing is that, like, we're seeing this kink persist for the weeks following election day, which basically means that the option markets are not just looking at the after effects of who wins, but rather they're also pricing the possibility of a contested election, which adds further volatility.
Interesting. Okay.
Yeah.
Good.
Okay.
Good to know. Yep.
All right. Next. Okay. All right. So now we're going to discuss a little bit about the market correlation term structure, and specifically, like, the way that other asset classes kind of like impart volatility and uncertainty into the equity markets. So we're going to start off by looking at those bubbles on the right hand side. So I just want to quickly convey what the significance of the correlation structure is. We have in blue, like, a bubble representing equity volatility, right? So basically, like, it's meant to convey the size of equity volatility, right? And then we have another bubble in gray, like, some other markets. So let's call it interest rates, right? So we have interest rate volatility, and the graph on the bubbles on the top right. What it's showing is a situation where there's a low level of correlation between, like, equities and that other asset class. So when the other asset classes faces increased risk, because there's not a whole lot of correlation between equities and that other asset class, equity markets kind of ignore that, and you see that the bubble on the far right shows that, okay, well, the equity markets volatility is the same, even though we've seen an increase in the other asset class volatility. Okay.
Got it.
But as correlation increases, you're starting to see, like, a transference of volatility contagion. So what happens is that, like, as another asset class correlation becomes higher with equity volatility, it starts to inject higher degrees of volatility into equities, and then you're starting to see basically that's when you see, like, VIX explode, right? So that's basically like a long way of saying that, okay, well, what we're on the lookout for is whether there's any other catalyst on the horizon that could potentially, like, fuel additional volatility into equities, right? And what this matrix has shown is that, well, yeah, you know what, the common theme throughout the asset classes is that the equity markets are on the lookout for interest rate linked concerns, right?
Mm-hmm.
And if you go to the next slide,
Mm-hmm.
this is when we kind of drill down into like each specific relationship. And the main takeaway is that not only are the equity markets concerned about interest rate assets, but they're also like very concerned with increased correlation between equities and FX, equities and oil, equities and copper. So bear in mind that those are all economically sensitive, economic linked assets, right? So what this is saying is that like the equity markets are very concerned about economic growth.
So the vol markets focus mainly on that group of markets itself. That's gold, FX, oil, and copper, typically, right?
Yeah. Well, actually, if it tries to focus on like a suite of like 12 different assets, because if you look at like the last, let's say, I don't know, 20 years, like the global financial crisis was basically a result of contagion from CDS markets. Then you had the European sovereign debt crisis, basically like a contagion from the sovereign debt markets, right? We always have injections of volatility from oil, right? And now we're looking at interest rates and FX.
Right. Okay. I'm gonna let you go through the rest, Ed, because I want to get to a few questions from the audience, and I see we're getting close to time. So let's.
Okay. All right. I'll be quick. All right. So next slide. All right. So basically over here we're kind of evaluating the possibility of a hard landing scenario. So what this chart shows is basically like how the equity markets performs after a major Fed pivot, where we went from a scenario where we have high levels of interest rates to basically a pivot to like an easing of interest rates. And we basically see two scenarios where we see a potential a hard landing scenario. And what that kind of translates, what we're looking over here is like, okay, well, how did the VIX behave, right? And what we see is that like, well, in 2007, we saw a scenario where the VIX basically like increased 6 VIX points or 6 vol points persistently. So the basically like the gist of that is that, okay, well, you know what, if we went from a situation where the markets are trading around 18 VIX to like a situation where we're persistently in a high 20s, low 30s VIX environment, that essentially it gets us to a point where we could retrace that down to like down 15%.
Okay.
Good. All right. Next. Okay. And finally, to kind of close, we kind of look at year-end positioning, right? So that's always interesting. And what we're doing over here is we're looking at the amount of puts and calls being bought, and specifically like the way we kind of look at that is by reflecting upon the skew surface. And the graph on the far right, what this is showing is that like we're seeing like high levels of demand for out of the money puts and out of the money calls, which is fairly unusual. It's either one or the other, right? So the explanation for that is that like, okay, well, I can understand why we have increased demand for puts, because portfolio managers generally buy puts when there's something to protect, and that we're up about 18% now. So what portfolio managers are willing to do is spend a little premium to protect a good deal of that run up in S&P. At the same time, like that, they're also positioning for a possibility that the market continues to rally, right? And so that's why they're also buying like upside calls. But that's particularly important for portfolio managers that need to beta chase. Basically, what that means is that like they're portfolio managers that have underperformed the rally, and at this point they're looking to kind of leverage their upside position, right, to try to catch up, right? So basically that's the end result of what we're seeing, right? So and this slide basically is just a summary of everything we went over. We believe that the equity market's going to September, October. It is more resilient. It's going to be a little more difficult for long short stock pickers to kind of like monetize their ideas because of the higher correlation, lower dispersion environment. We're seeing. Oh, we have a slide. Sorry.
That's okay. We'll just talk about.
Yeah, we're basically seeing increased levels of concern for the U.S. presidential elections, and particularly we're seeing the option market price in the possibility of a contested election. We're basically seeing increase a correlation term structure that says there's going to be an additional focus on economically sensitive assets from the non-equity space, and finally, like how investors are positioning themselves is to protect themselves, to kind of like capture what they've already made, but also like lever into any potential rally going to year end.
Perfect. Awesome. Well, thanks so much for that, Ed. That was really fascinating and interesting. That's a major analysis. I love it. Let's do a couple of questions. I see we're just a little bit over here. We'll go fast. Let me show them on the screen for you. That's a comment. Hold on. Here we go. Is correlation analogous to alpha?
The correlation environment is not an analogous to alpha, but basically it plays a part in determining alpha. So basically, like alpha basically is the size of alpha is determined by two things. One is correlation, the second one is volatility. Basically, like high levels of correlation within the environment means that there's low potential for alpha, right? And when volatility is low in that same environment, that means that the amount of dollar amount that you can actually capture is going to be fairly tiny, right? So that's why we actually need a moderate level of volatility in order to produce like a significant degree of material dollar alpha.
Right. Okay, perfect. And then does this also relate to bonds? I guess this for Scott means the correlation vol effects.
It does, yeah. So basically, like, yeah. So basically, we use CDS and interest rates as a proxy for bonds. But yes, it does.
Okay. And this was asked a long time ago when I was talking about pricing, but from Mike. What's the dominant force in option pricing? Black-Scholes, mathematical model, or supply and demand? So I'll take this one, I guess, and you can add on to it. When I talked about that part of it, so we all use a pricing model on the option market making side, right? Some use Black-Scholes, but it was refined more. So Cox-Rubinstein came around, and then what we all did at our firm is we created our own. So we blended a lot of things. So some were good for European model exercise options, some were good for American. We kind of blended it into being good for everything. To answer your question, while the model exists for theoretical value, we still use supply and demand to move our markets, but everything that is related around like options had to behave essentially the same. And that's what the model does for you. It tells you what theoretical pricing is, right? The answer to the question is a little bit of both. We're moving markets, but we're moving into a spot and everything's moving up. So you typically will not see a sawtooth in a curve because that will put things out of line all around it. The combos get out of line, the butterflies get out of line, the boxes get out of line. So everything has to kind of move in sync. Okay. And I know that's complicated. We'll do maybe a show on that on the Brew about that concept, Mike, but thanks for that question. Ed, thanks for coming on. I mean, that was just awesome. I really appreciate it. You did a great job. I really enjoyed it. And we're going to see how it plays out right into the fall and near that election.
Yeah. Let's keep in touch, Lex.
For sure.
Yeah. Thanks for having me on the show.
Okay. Have a great day. Thank you.
Okay. Bye.
Bye. Tradier now has futures. Trade S&P futures and options nearly 24/7. We have low margin requirements, no pattern day trading rules, and preferential tax treatment. Day trade margin is incredible at just $1,000 for the E-minis and $100 for the micro S&P futures. Trade on your favorite Tradier platform as well as your favorite third-party platform. And with commissions as low as 75 cents for E-minis and 35 cents for the micros, you can't afford to miss it. Tradier futures. Sign up today. Oh, hi, Mal. That wasn't me live, by the way. That was tape.
Wow, that was amazing.
Wasn't that great?
That was incredible. That was incredible. That is like a replay.
Yeah, that was
He's
good. That was good. Thanks, Ed. Moving along. In a second, we're gonna have Scott Martin from Trade Tool for Profit come on.
Whew.
He's going to talk about mitigating unknown event risk with 1 DTE credit spreads. So this will be very interesting as well. But you know what I have to do first, because it's coming soon and I don't see enough signups yet, is we have to go back to here. Come on, people, you can do it. Go use that QR code and make sure you go to www.kahoot.it. Use that number right there, that pin. Start signing up, because after Scott's presentation, we're going to run the quiz. It's very fun. It's easy. It costs you nothing, and you can win something. It's so good, right, Mom?
Yeah, you can win $1,000. So that's either a weekend trip for someone or a bottle of wine for you. We know how you roll, Lex.
Oh, geez, that's a good point. Yeah, I love my wine. All right, so let's bring it on. We're going to bring Scott on before the break here. He's going to talk to us about unknown event risk with 1 DTE credit spreads. Scott, here you come.
Morning. Good morning. Can you hear me okay? Can you hear me now? Yes, sir.
I'll jump in real quick and I'm going to jump out. We can hear you. You're ready to roll, okay?
Great. Thank you.
Right.
Thank you. So great. Thank you for having me on, Molly. Good to see you as well. Always fun to be part of these events, and hope you guys get great viewership out of it today and great education for everyone as well. So I'm going to start by sharing my screen, knowing that we have a limited time, and take you through what I have. So let me start by doing that. So let me present here and then go to the share screen. There we go. Allow, select the screen to share. Okay, where are we here? Studio and allow should be okay from here. Excellent. Okay, so if somebody could still tell me they see my screen okay, that would be great. Appreciate it. Everybody's good. All right, so we're going to talk about adapting strategies a little bit differently today from perhaps some of the things that you've talked about before. I'm going to go ahead and stop the camera here so I won't distract you at all, but otherwise keep you engaged into the presentation. So at Trade Tool for Profit, one of the things we look to do, since we're in such short-term trades, is to, at all costs, if we can, avoid the news. Today is a perfect example with the Fed coming out in the next hour or so, or 2 hours from now, whatever that's going to be. There's a whole range of outcomes that can happen, and then outcomes that happen from those outcomes as well. And so while a lot of people see that historically it's bullish if interest rates are cut, and while that tends to be true, yesterday also marked historically a day where it's the worst time to get into new bullish trades for at least a 10-day to 2-week period. So we take a lot of different things into consideration, and I'll explain the type of trades that we do, why we do them, and then I'll spend some time saying, okay, what do you do with the rest of your portfolio that are not involved in these type of trades? So as Lex indicated, we do 1 DTE. So 1 day out, basically a 48-hour trade, almost 24 hours. And while there can be different outcomes, the best outcome for all of our subscribers is that they are just going to expire. So when you talk about avoiding unknown news risk, the reality is we know the news risk is coming up. The unknown part is how is the market going to react to it? And if you're an intermediate to long-term investor or trader, you can probably have some time to be able to put up with the ups and downs in the markets that come with these news events. But when you're in a very short-term time frame, 1 or 2 days, it just doesn't work that way. So I'm going to show you how we take advantage of it by sidestepping actually the news itself. We are big believers, and you've probably heard before that, sometimes the best trade is no trade at all. We believe that you win as an investor over time or a trader by sidestepping the most difficult times and trade normally when things are most clear. And so that's kind of what we're going to be focused on a little bit. Little disclaimers, we get started at Trade Tool for Profit. We don't make recommendations. We are newsletter trade publishers. So you should always be aware of the risks in any trade. There's going to be losses along the way. Just because a strategy works at one time doesn't mean it's always going to be suitable in the future. So it's kind of a three-pronged approach that we take here. We are Trade Tool for Profit. So what our team does is we research and analyze and ultimately publish these one-day out trades. We always have eyes on the trade from opening to close in every single day of the market. So we monitor those trades that are published and we adjust them based upon what we see in the market. Again, sometimes the best adjustment is no adjustment at all, and we expire for full credit. We use only high probability trades. I'll talk about that as we get into the presentation a little bit. It is advanced options, so there's a little bit more defined risk versus just a traditional directional trade. And we believe the diversification of ETFs helps protect subscribers from, the types of news that come out that can create havoc in a single stock. So what we do is we publish the trades in a master account several times a week. We usually do one trade per ETF. So the way that our system works is that our subscribers, after they sign up with us, they sign into a position with a company called Global Auto Trade. So they're the highway to take us over to Tradier. And at Global Auto Trade, they are an RIA, and they are also the auto trade expert. So what happens is not only is the trade executed for the subscriber automatically once we publish it, which makes it pretty effortless on the end of the subscriber, but we also use something called auto positioning, and that's been kind of our secret sauce as we're going forward. What that means is that we think that investors should never put more than, let's say, 20% maximum of their entire investing portfolio into any trade strategy, and that includes ours. So let's say somebody had $100,000 of an investing portfolio. We would suggest to follow our trades. You never open an account of more than $20,000. It can be higher than that, but the point is that we only want it to be 20% of your overall investing money that you have. So when we distribute the signals, and let's say in this example, somebody has $20,000, auto positioning suggests this. You should position your account, and we strongly suggest that no more than 50% of the money that you have in the account. So if you have a $20,000 account and you auto position your account at 50%, that means $10,000, half of the 20 will always be safe in cash. The other 10,000 are going to be dedicated to the trades that we produce. The great thing about auto positioning is it automatically is going to define the number of contracts that are represented based upon the money that you're allocating. So let's say that you have a $20,000 account. You decided that you're going to auto position at 50%. It means $10,000 goes into the trades. Well, that 10,000 is distributed evenly between the trades that are out there. And let's just say in the trades, that means that you have 15 contracts that are traded in one or more trades that day. Well, 3 weeks later, let's say your account has grown from 20,000 to 23,000 or 25,000. Well, if you're still positioned at 50%, you now have more money that is going to be distributed to trades. So the auto positioning also helps with what we call auto compounding. And that's the way to grow your portfolio, even if you trade around news risk events. So that if you had started, let's say, with 15 contracts, perhaps 3 to 6 weeks later, you're up to 18 contracts. And a month up to that, you're up to maybe 20 or 22 contracts. Now, you have to be able to control that on your side. We'll show you how to do that as well, because we kind of share the responsibility of the risk for you. At Trade Tool for Profit, remember that's the number 4, Trade Tool for Profit, we control the trade risk, but the user, your end, you're going to control what we call the portfolio risk and what percentage you're going to allocate toward the trade. So once it goes from our master publishing account over to Global Auto Trade, it is then executed in your Tradier account. you will get one or more signals that tell you that a trade has been executed, and you can certainly go in and look at it anytime. But the seamless part is you don't have to do a thing. That's the beautiful part about auto trading, and what Tradier has worked out is it allows you to participate in the trade without actively doing anything at all. So you can have your busy day, whether you're at work or trading on your own, and this is happening behind the scenes, and you will always be identified through an email when that happens as well. So the first thing you need to do to be able to be successful here is to recognize the economic events that are going to be coming out. Folks, we also look at dividends. We certainly take earnings in consideration, all the geopolitical events and rumors that might be out there. But remember, this is a very short-dated trade of just 2 days. And so we want to take the economic events into account. As I mentioned, I think earlier, we don't have any trades on right now. We are sidestepping the Fed news, letting the market digest that a little bit. And we can certainly put on trades tomorrow if we decide to do that. And the value behind that is through the auto allocation and the auto compounding is you can still have your portfolio grow even when you sit out of very short-term news events. So as I mentioned earlier, we only do high probability trades. We will only enter our trades if we have a very long defined checkoff list of rules that we use. And if it doesn't pass those rules, quite frankly, we don't go into the trade. But the trade has to have a probability of succeeding at a 90% or higher. We won't go into a 2-day trade if it is less than a 90% probability. The great part about that is their defined risk. We currently do a $2 spread. So your defined risk is $2 less the credit that you bring in, of course. I mentioned that we only use liquid ETFs. I'll talk about that more in just a moment, but we believe that type of diversification can protect you from the news that comes out about any single individual stock. We talked about considering auto trading through that RIA and then into Tradier. Again, it's a 3-pronged event that ultimately has the money in your account that ever you're allocating directed towards the trades that we publish. The great way, is compounding the results. I mentioned that earlier. I'm going to show you, I think, a pretty significant slide in just a moment. I believe it was Albert Einstein that says compounding is the 8th wonder of the world, right? Commonly understood, but seldom practiced. So we have that as a common practice in the way that we grow potential accounts out there for subscribers. And the great thing, it's done behind the scenes and done for you automatically. We always help our subscribers remember the risk involved, keeping in mind that compounding is amazing when it works for you. But if there's a loss, which, there are always going to be losses in the market, it could work against you as well. So I'm going to talk about how to modify that risk and adjust down, so to speak, so you don't have as much at risk as your portfolio grows. So that's called controlling your portfolio risk as well. The great thing, because of the relationship we have with Tradier, it allows our joint subscribers, they can do this in margin accounts and retirement accounts, joint accounts, business accounts, et cetera, et cetera. We have many, many subscribers that have more than one account at Tradier that follow the newsletter published trades that we put out. So let's talk for just a minute about the power of compounding. I think by now everybody understands the power behind it, but I just want to give you a real life indication of what that looks like. We actually began offering this strategy in September of 2022, so 2 years ago this month. And so I'm going to highlight 2 lines as I go through this slide rather quickly. The green line that shows the portfolio growth, and the red line, which is actually the allocation. So on the left-hand side, I am circling $50,000. So the example here is going to be if someone opened an account with $50,000, but then position their account at 50% allocation, that would be down here with the red line at about 25,000. You don't see the 25 there, but this represents the 25,000. So only 50% of your account is actually at risk in the market, but compounding is doing the heavy lifting. So this is all of the fees that are charged by our partnerships and through us as well. Probably doesn't, the insignificant regulatory fees, I don't think are covered in here, but all other fees are as well. And you'll see that starting in September, if somebody had an account of $50,000, again, with only half of that at risk, you can see that about 6 months later, that account had already doubled. So the value of the account had gone from $50,000 to $107,000. Again, down here, we had half that risked the entire time. So one of the things that we like to encourage our subscribers to do is take some money off the table along the way. If you started with $50,000 and your account literally has doubled in 6 months, again, this is after all fees, why not take some of the money off the table so you are reducing your overall principal? Because we believe once you put your principal, so to speak, back in your pocket, I don't love the idea of the phrase playing on the house's money, but it does allow you to at least feel safe no matter what happens. Black swan events be damned. Your original allocation that you wanted to put into these type of trades is back safe. Now, remember, you can't just take money off the table. There's consequences if you're in retirement accounts. So you want to consult your attorney, whoever you use to be able to do those kinds of things. Now, recognize that nobody makes money on every single trade, and there's going to be drawbacks like you see here. Now, this shows in March of 2023, we had a drawdown. Now, obviously, folks that have started with us in, let's say, January or February don't like the idea of an early drawdown. It's the people that were with us longer that you can see certainly rebound from that. So it is a long-term view of a short-term trade that we ask our subscribers to take a look at, meaning with all the ups and downs in the market, what do things look like a year later or 2 years later in terms of your success? Recognize with a drawdown shown here in March of last year and another one here in December of last year, we still have pretty much tripled the original principal, not quite 2 years later that you see from somebody that started with this. Now, some people start with less than that. Some people start with more than that. But once again, strong reminder, we encourage you to never put into our strategy or any strategy more than 20% of your entire investing portfolio. So we'd love to see you take money out along the way. If you're in a retirement account, what you do is you reduce your percentage. So if you're at 50%, maybe you go down to 40% or 30% so you can obviously preserve that capital. That's the biggest focus we have at Trade Tool for Profit is preserving that capital. And we want you to do that over a period of time. Again, we control the trade risk. You control the portfolio risk. And obviously, I presented these slides to Tradier back in late July, so we have to update the slides going into the end of this year as well. So let's go live in the site just so I can show you a little example of what we do and how we do it on our website. So I'm going to go back here. Let's see. I'm going to go just a little bit here. I guess I have to go further ahead in this particular case. There it is. Okay. So here is the methodology. This is our trade site, Trade Tool, the number 4 Profit. And again, just to highlight the big things that we use for what we call the methodology, right? We only use high probability trades. We think it's important to stay diversified in the different equity positions. We do that obviously by using the ETFs. We have trades that are predefined risk and reward and have very active monitoring. The team monitors this from open to close. Every tick the market is open, literally. And the auto trade execution gives you that seamless way to be able at least invest a portion of your portfolio. We have a very experienced trade team. You can go in and look at our team on our website if you'd like. So our approach is quite simple. By doing the $2 spreads, 1 DTE, we're able to kind of spread out the predefined range, right? So we might have a thesis on what direction the market goes, but as long as it stays within a range, the market doesn't have to move at all or could actually go against what our thesis would be, and we still have the ability to either exit the trade if we are wrong, again, looking at preserving capital, or sometimes we extend the trade so that it goes for a little bit longer, give us more time for the trade to move into a profitable position. The goal is just to provide supplemental income for a lifetime, whether it's going to be in a margin account or a retirement account or a combination of all of those. That's certainly up to the subscriber. I mentioned that we diversify using ETFs. We primarily trade the S&P 500, gives you access to the largest 500 publicly traded companies in the U.S. The NASDAQ 100, which is the QQQ, of course, that is more technology driven. We don't do the Russell as frequently. Sometimes we trade the Russell, the IWM, or the Diamonds ETF. It doesn't have the same expiration cycle as the two we trade most frequently, the SPY and the QQQ. Again, through auto trading and our agreements with both Global and Tradier, it gives you a great opportunity to be able to do a lot of this as part of your overall portfolio investing, and not just saying I'm all in and putting everything into one particular strategy. So back to the presentation. I think I just have actually one slide to lead us back into the website here. So the question becomes, after the trade breaks, if we are publishing trades after that, which we typically are after the market has digested the news, if we suggest to you, remember, we're not licensed, so you do whatever you want with your money, but since we believe in diversification and we suggest that no more than 20% of anyone's portfolio should be directed towards our trades or any trades strategy for that matter, the question is what to do with the other 80%. So what I'm going to show you now are the tools that are also available to subscribers that help look at the market in very specific ways and determine the best stock or stocks that might be good for stock or option investment and trading. So whether it's a short-term investing in options or more intermediate to long-term with stocks, our tools have a very unique perspective to be able to help you determine what are the best things to use to be able to actually put the rest of your portfolio into play. So we'll go into that right now, and I'm actually going to go on to the login portion of Trade Tool for Profit, where you click the word launch. And this brings up the different tools that are available to our subscribers. We have free webinars from time to time, so you can cross out those if you don't want to see them anymore, or you can sign up for them and attend them for free. Just a great way to further educate investors. So this is a look that I like having on what I call my homepage of Trade Tool for Profit. These are the actual tools, because Trade Tool for Profit is a trade publisher, which I've already explained in our 1DTE credit spreads. These are the tools available for people that want to trade other stocks and options within their portfolio, and we think give a lot of investors a leg up on what to do. Following a plan is really important. So let's go through and look at the different areas of the website and how they are of value. So we'll bring up a very common stock that everybody's aware of, NVIDIA. Notice there are 4 boxes here. We call these 4 boxes the score. I'll be going over these very briefly as I go through this before I turn you back over to Lex. So the first box, the word technical pops up. So this allows you to look at graphs, right? You can set up the graphs wherever you want. VWAP, we've got, obviously, you can see the dividends show if they pay. We have the earnings dates on here as well. You can go and set up whatever indicators you want on there at all. You can save all these different ones so you can have multiple screens to look at. You can even set up green and red arrows as breakouts happen for different things that you want to take a look at. If you're like me and you like to extend the chart a little bit, I'll extend it by 30 days. So you can see what it would look like if you were to start drawing technical lines beyond that point. You always have the ability to do that as well. And this will allow you to go and look at any period of time that you want. And also from here, you can go to many, many other areas, which we're going to take you through right now. Now, this is the chart. You see the word chart where I have my red circle. It's also the same thing you would get when you click the very first of the score here, the 4 boxes in the score, which is technicals. The second one, you can see it pops up here and it says inner circle. So it really doesn't matter which place you go. If you're already into a stock chart, by clicking inner circle, this gives you some very unique information. All of this information is updated daily. But what a lot of our subscribers like to look at in depth is 2 things. The first one is institutions, right? It has been suggested that institutional money controls up to 80% of the money in the market. It's often referred to as big money. So what is big money doing? Well, in this case, in NVIDIA, it would look different for every stock. You can see that the ownership is quite high, green being good, red being not so good, and yellow being kind of in between. So at the same time, the institutions are buying NVIDIA, you can see Insider Score said they're selling. And I'm going to show you a way that we can drill down deeper into both institutions and insiders. You can see Jensen Huang, I think, is the CEO, and he's been selling most recently. So it all depends on how you value that type of information to be able to go into other investments, or if you want to tighten stops on current investments, things like that. This just allows you to go a little bit deeper. We also have something called the key ratio, which is the third box of the score called valuation. That actually lines up with the key ratio box that we have here. This information is tended to updated on a quarterly basis when companies report earnings, so it's very valuable, but it's not daily, timely updated like the other areas of the tools on the site here. So it tells you where the industry ranks are, both in the valuation and in the profitability of the company and all the different areas, whether it's the price book, the enterprise value, all of that is on there. Again, dig as deep as you want. I'm just giving you a very high level overview of what this looks like. If you are a stock investor, not an option trader, but a stock investor, fundamentals are going to be important to you. So it doesn't matter what stock you have up here. If you click on fundamentals, it gives you, the four areas that people like to look at: the earnings, the price projection based upon where the stock is expected to go, the dividends and where the industry rank of those dividends are, and ultimately what a lot of people like to look at is the profitability. You can see here you can control the time frame of the profitability that you want to see, but if you're an intermediate to long-term investor, you like to see that profit growing over time. That's certainly what this kind of represents on NVIDIA. So lots of information for you to take in just to be a much more informed investor before you actually do your investing or trading. There's also, excuse me, if you want to dig a little bit deeper into institutional ownership or insider trading for that matter, I'm going to go up to the research box in the upper right. And when you click institutions, again, this happens to be NVIDIA, but you can see what the main institutions out there, the biggest ones. Here's what Vanguard and the holding they have in NVIDIA. You can see it's their third largest holding here, but if you go down to Morgan Stanley, it might look different. Well, in this case, it's their third as well. So this is updated all the time, so you can drill down and see exactly who the institutions are and what they're doing. And if you have that inside trader want in your thesis to determine what you want to do, you can actually go in and click on individuals' names within that company. This happens to be Berkshire Hathaway, and see what people are doing. The KKR group has pretty large ownership and so forth, and see what they're doing from an insider trading perspective. So all these just available at your fingertips if this information you find helpful to you. But the bottom line is, even if you wanted to, you could go, let's see, if I go back one to where the institutions were. In most cases, you'll see the phone number of that institution for the overachievers that are out there. You can even contact that, what I call the big money institutional out there, and ask specific questions as an investor if you have that particular question. Now I'm going to go back to what I call the home page, which I use as market. I will show you as I go back there that you can customize your home page to look however you want. So if you prefer to go to something that you want to see that way, you certainly can. I'm just going to go back to market so you can look at what we call the score, the four boxes that you see here. If you're bullish, you like the color green. If you're bearish, you prefer the color red. If it's kind of in transition, that is what you see from the yellow. So obviously, if you're at a bullish, you can see Met Financial. I'll take a look at that chart. So this is in the insurance industry. It has very strong fundamentals, very good financials. The big money and insider buying or trading looks good. So there's a lot of things to like about what you see here. And that's why we want you to have just a quick snapshot of the score on every publicly traded stock, so you can do your own research and make your decision. Do I like this? Do I not like this? And perhaps improve the probability of your own individual investments as well. So I already talked a little bit about insider trading and institutions. And then the question becomes, what if you are interested in trading something? Well, the beautiful thing about us is that you can actually use your trade tool for profit account, and you can link it directly to Tradier. And you can trade directly to Tradier. You can also use our paper money account if you are testing different strategies as well. So you just click on the word options. We happen to be on MetLife, so it's bringing up all the option chains for MetLife. If you were to go out, let's say a month, I'll click on October 18th and just click OK. It brings you up whatever you're going to trade. So I will just make up a trade here and say that I'm going to do $2.50 wide credit spread here. I'm going to put the number 10 and hit enter. So you can see that it brings that first leg of the trade up here as a buy. And let's say I'm going to sell, so I'm going to minus the 10 that you see here. And when I hit enter, it's the entire trade up in the right-hand corner. If you then want to trade that in your real money Tradier account or in a paper trade account, you would click the word trade. And if you don't want to, you would simply get off the screen and move on. If you wanted to trade it, you click the word trade, and it actually brings you on to the different accounts that you might have. Notice that it loads up the trade automatically. It has the quantity predetermined to 10. You can change that to whatever you want. Obviously, you can go down here and change it to a net credit or debit, whatever you're looking for. But the nice part about it is it allows you to be able to go in and use it as a paper trade or as a Tradier trade. And let me show you what I mean here. For our newer subscribers that want to link their Tradier account, in the lower left-hand box, once you get onto your account information here, you click the little plus key that you see at the very left hand. That allows you to start and open new accounts for you to trade. So notice under brokerage account here, you would choose Tradier. And once you link your Tradier account, if you find a trade on our tools and you actually want to make that trade through our system, it will be executed in your Tradier account. So it just saves you a step in having to go back to your Tradier and write down all the information before you trade it. It's all seamless and logged together here. If you want to trade in a virtual account, you can see it says virtual there. You can do that as well. You can have multiple accounts, and there's two ways of getting to these accounts, either in the bottom left-hand corner if you click on it, or in the upper half where it says portfolio, click the word account. It brings it up on the full screen, and you can look at whatever you want within that account as well. So if you want to say, okay, how have I been able to do in an account like this? How's my performance? Well, then you would go to the portfolio journal, right? And so you can look back at history of the success of your trades. This allows you to go back and whether they're paper trades, depending on what account you select, whether paper trades or real money trades, you can certainly look back. You can change it to a graph look versus the tag that I have here. You can actually go in and look at the different areas of time as well. So it walks you through everything. We have a great video system in the Help Center that I'll end with in just a moment that'll help you understand exactly what to do. So as I'm wrapping up here, there's two things I want to finish with. One of the things that people love these days is searches and also AI, right? So we're looking at AI. So I'm going to go over, let's see here, to see the activity table. Let's see, research. Okay. All right, portfolio, order status. Okay, and scans. Well, let me start with scans. People love the fact that we have bullish and bearish scans that are already predetermined for you. If you're very bullish, for instance, you could go to this one that says scores all green. That means they have 4 boxes, and you get generally all green boxes. One's probably going to be turning in the next 24 hours. So perhaps if you're bullish, you're considering only the ones that have all of the best fundamentals, technicals, valuation, and chart outlook as well. You can save these for yourself. If you're bullish or bearish, you can click on the bear bull outlook and start looking through these, even if you're stagnant or appreciate volatility. Notice there's different chart patterns that we've put together, and it tells you the number of stocks or option trades you might want to be looking at. The feature gives you all kinds of excellent things that you can look at for different types of trade suggestions on both stocks and options. Again, these are just ways to evaluate the different things in your portfolio you may want to trade. The last thing I want to show you is on the activity. Let's see if I can go to. Don't want to see. You can certainly set alerts in there as well on the account. Well, let's see the order status here. Let me go back to the last thing, which is going to be probably in the gains. Let's see, activity, the order status. I showed you a little bit of what you're looking at there. I think back to the home page is the best way to be able to look at this. Okay. So again, if you were to click on a stock, let's say we're back on Meta, for instance. If you go to the activity button that you see here, we have something brand new that everybody's going to love. It's the AI analysis. So we like to think we're a little ahead of the time here. It takes just a second to load because of the demand of all the information that comes in. I want to kind of disclaim the fact that this is still in beta testing right now. This happens to be looking at MetLife, but it gives you the strengths of MetLife based upon the industry it's in, as well as the weaknesses. Kind of gives you the overall summary of what it looks like in that particular industry as well, and maybe other stocks you could consider if you're interested in that. If you think the health insurance is going to be a strong industry group, Berkshire Hathaway, Progressive, Chubb, or some other ones you might want to take a look at. So lots of things you can look at that I won't have an opportunity to get to today for a time standpoint. I really respect what the team is doing with Lex and Tradier. So last thing I would tell you, if you do have any, if you want more information on what we do and how we do it, go to our website, Trade Tool for Profits, the number 4, and just click on the Contact Us tab. You can enter your information there. We'll be happy to send you free performance reports. There's no obligation to do this at all. Just click on a calendar invitation. Our executive vice president does presentations several times a week. You can bring friends and family if you'd like, and we'll link them all together, give you a 45-minute overview of what we do. Nothing is off limits during that time. Ask whatever question you want. Again, there's no obligation there either. We just want to make sure that before you start considering a strategy shift, that you know all of the potential consequences that are out there for you. So with that, I'm going to stop sharing at this time and turn it back over to Lex. Lex, if you can see and hear me, hopefully you're going to be, or Molly in there too, at a point where the transition goes back to you guys shortly without the Q&A in there as well.
Well, the gang's all here. Thanks, Scott. That was terrific. Really enjoyed it.
Amazing, Scott.
Thank you.
Great.
Yep, a lot of great information there. So let's go through a few questions. We have a minute or two. I'll pop them up on the screen, and some of these, which is good, I kind of take some notes.
Yes.
But the folks are asking the same questions I wanted to ask, so that's
perfect.
All right, number 1, anything on this? What is the minimum portfolio size required for sign up with Trade Tool for Profit?
It is a great question, and the easy answer is historically we have had no minimum sizes. That being stated, because of some day trading rules, if we might have to modify the trade right after we get into it, we like to see 25 to 30 as the best. Remember, if you're positioning that at only 50%, it's not all in at any one time, but that allows us, if we have to modify the trade on the same day, which is actually quite rare, if you're over that $25,000 threshold, you don't get caught in any day trading pings that most traders, or excuse me, most of the brokers have on.
Yeah. Okay. So that's going to lead to this, which I think could be the same answer. I'm not sure, but that's my thought. Why use 1 DT versus 0 DT? So I'm assuming you put this on the day of 0 on the next one, so that it's an overnight kind of thing. Is that accurate or not?
Yeah, that's exactly right. So it's a very similar answer. It's a very great question, John. The reality is we found that giving the trade a little bit more time to be able to move in a profitable direction if we're wrong has been very successful for us over the years. I mean, we have a tremendous success rate. We also want to exit the trade earlier if for some reason something happens very quickly, like it did last December on us. So we want to minimize the losses. Our goal is to have a maximum profit, and they're only small profits, right? But they compound over time, and that's why the accounts continue to grow. But we want to have a maximum profit if we can get it, some profit, break even, and then the smallest loss possible. We just want to avoid maximum risk, and that extra time allows us some time to be able to manage that better.
Okay. And then I think you mentioned, I could be wrong about this, but correct me. Your subscribers, they can do things manually if they'd like, or they can do it automatically if they'd like. Is that accurate or not?
That's correct, or a combination of both. So we and that's why I wanted to try to highlight both. I appreciate you clarifying that. So most of our subscribers go through Auto Trade and Tradier, but obviously since we say, hey, Don't put all your eggs in one basket. If you have other money in your portfolio, use our tools to be able to identify the best things that are out there. And yes, you can link it right to your Tradier account and trade right off of our site as well.
Sure. And what percentage would you say do it manually versus do it automatically? Do you have a statistic?
Yeah, I would tell you probably only 15% do both. There's a lot of people that just love the no effort on their point required. So we have a lot of people that just might own stocks through mutual funds and things like that, through their 401ks or what have you, but just use our auto trade only to get a little bit more exposure in the market.
Perfect. All right, let's grab one more before we go. Say goodbye. Are you holding your credit spreads deep into the 0 DTE period, almost expiration, or something else?
It's a great question, and the answer is we like it to go to expiration. So on the day of expiration, we send out a note to all subscribers what we are expecting to do. And the best note a subscriber can get is that we typically have a 96, 97, 98% probability of the trade to go in our favor. So at that point, we're going to let it expire. We make sure everybody's always aware of what assignment risk means, although we've never had it go to assignment before. So we will republish something if we trade later that day, but we attempt to make that decision early in the day so our subscribers know what our intentions are. But we're watching it literally tick by tick. So if anything happens, they'll get a secondary communication as well.
Perfect. All right, Scott.
And I will just say, I've looked at your historical performance and it has teeth. It's the real deal. Almost sounds too good to be true, but it's the real deal.
Remember, it compounds on the way down, just like on the way up. So we feel people aren't overexposed and take some money off along the way.
Yeah.
Right. The rule of 72 is how quickly can you lose half your money as well.
That's a good way. I hadn't heard it put that way before.
That's good. And before we go, also, is you made a great point very early on in your talk, and it was sometimes the best trade is the no trade, right? And I can't stress that enough. When I travel and talk to audiences, I always stress that sometimes you just sit on your hands. It's the best thing in the world.
It's people forget that cash is a position, right? Yeah. Just like owning anything is a position, cash a position. And if you're going to preserve capital, like I said earlier, we believe that you'll win over time if you sidestep some of the more difficult times that are coming up.
Right.
But again, with the compounding happening, it allows you to make up for any trade differentiation you thought you might have missed. But that's only if you're crossing your fingers and hope that you're right. Don't trade by hope.
All right, Scott. Well, great. Thank you so much for participating in this summit. You did an awesome job. Trade Tool for Profit. That's TT4P, right? And is it TT4P.com?
It is. It is. Yeah.
You don't want to get something up here when you head out. All right. Thank you very much.
And Scott, we'll talk soon. I'm gonna give you. I miss hanging out with you, so I'm gonna give you a call this week. Let's hang out.
Please do. Always around. Actually, I am taking some time off on Friday. If you get me tomorrow, I'll be there. Otherwise, Molly. So I appreciate that. You guys do a great service by putting this summit together. So to you guys and Dan and the whole team, congratulations. Sure appreciate you involved.
Thank you. Scott. Have a great day.
You as well.
Thank you. All right. There's a lot of noise and opinions about trading and investing, and it's always at your fingertips. Also, trading today is digital, and having a trading idea is crucial. We hope to deliver substance to help our community make good trading decisions and make good investing decisions. The Hub will serve as that haven for knowledge and collaboration. Guess what time it is? Do you know? It's quiz. Time for this.
Is the quiz.
This is the actual quiz. So now what I'm going to do is I'm going to let folks sign up. Now, I know folks are watching on X and they're watching on YouTube. Maybe they're on their phones and they can't take a picture of the QR code. Go to www.kahoot.it and punch in that number and you're in the game. This is a no-brainer. It's a little quiz. It's free. You have a chance to win some bucks, and it's fun. It is, and I want to see how the percentages go. There are 15 questions. Okay, so we're gonna run this in. I'm gonna let it go 5 minutes here. So we're gonna take a break. I'm gonna leave this up. Molly's gonna go powder. I'm gonna go powder, and grab a glass of water. And in, let's call it 5-ish minutes, we're gonna actually run this quiz. What do you say, Molly?
Here we go. Come on. No whammies. No whammies.
Come on, we want a lot here, so we're gonna step back. All right, we'll be back in 5. All right. Here we go, Mal. You ready? Are you playing, Mal?
I am.
Okay.
I mean,
all right.
I'm
gonna hit the start button, everybody. So if you're not signed up, here we go. I'm breathing. I'm giving you a chance. The last push.
These are quick, so we know you have AI up, but we don't know if you can get into it that quick.
Well, they're all time. Wait till you see this thing. Very cool. All right, we're getting a little last minute surge here. Let's let it go for a second here. Come on now. Keep going. 30 seconds, and I'm hitting the start button.
I'm putting my money on JH, maybe Joey P.
I'm really not counting 30 seconds. I sort of am. All right. I want to hear, there's going to be controversy over the answers, I think. Your answer on the app. Yes. So what's going to happen is it's going to pop up on your screen, and you're going to pick the right answer real fast. And this machine is going to take care of who's winning. It's going to show the top 5 or so as we go. And it'll change every question based on your speed and your accuracy. All right. So I want to see someone get 100%. All right. Here we go. Hitting the start button. Can we see that? Oh, fun. Here it goes. So you just picked the right answer there. Come on, faster.
And Lex, maybe read the question so we all.
What is a short iron condor? What is a short iron condor strategy in options trading? Right? So the 13% got it correct. It is a combination of a bull put spread and a bear call spread. We can argue later. Here we go. This is where we are. Look at that. Those are the points. Nap is in first by a couple points.
Ooh.
Ready? Question number 2. What is the primary risk of a credit spread? Limited to the difference between the strikes less the net premium received. All right, let's see how it looks. Uh-oh.
Hey.
Good job, Gary. Gary and Marcos, very nicely done. Here we go. Question number 3. What does char mean in options trading? What? Ooh, this is a tough one.
Extra points if you have a joke on this one.
All right, look at this. Not many people got this. The rate of change of delta with the respect of the passage of time. It's like delta decay. All right, let's see what happened. That was a tough one. Ooh, very good. Isabel is the highest climber, up 21 spaces. Here we go. Question number 4. What is this trade that combines long stock on a strike with short synthetic stock on a different strike? I might have said that wrong. I couldn't see it. It was behind the camera. Okay, a box. So two spreads. A call spread and a put spread, opposite of one another, same strikes, but forms that box. Let's see how we look.
Ooh.
Very good.
You've done that.
Crazy. In a collar strategy, what are the 2 option components that protect the downside risk? C, or I guess that's B. B is the right answer. Good one. A lot of people got that. Selling a call and buying a put. That's the collar. You're protecting long stock in that example. All right, let's see how we look. All right, hanging in there. They'll get easier. Don't worry. Which strategy involves buying a lower strike call and selling a higher strike call? Buying a lower strike call, selling a higher strike call is a bull call spread. It's a debit spread, right? Let's see what happens. All right, very good, very good. Answer streak number 3 for a few players. Moving along, 7.
Eric, quite ahead.
What does in the money mean for a call option? And the answer is option strike price is below the current market price of the underlying stock. So the strike price of the call is less than the current market price of the stock. That's in the money for that call. Let's see how we did.
Oh, yeah,
ooh, we had a big jump. Holy cow.
Jump.
Huge jump from MineForge. I love it. Number 8. What is the main purpose of a covered call strategy? We could argue this one, but this is kind of a right answer. A more right answer than others. Right, Ma?
We got this.
To generate additional income from the underlying asset. What that means there is you own stock, you sell that call to generate a little income and protect a little bit to the downside on that stock ownership. Oh man, we got a barn burner here. Come on, someone jump up. I want to see it. Number 9. What does the Greek term row represent in options trading?
Oh, is a good one. Those answers fly in.
They're coming in. A lot of people got it right. The sensitivity of the options price to change in interest rates. That's row. Not super valuable to the retail person. They tend not to go out too much in time with their trades, but it still exists, the row, especially in the higher interest rate environment.
I love the Greeks.
You love the Greeks. Okay. Next question. What are we on? 10. It's total of 16. What are leaps in options trading? Options that expire in more than 1 year. That's called a leap. Good one. A lot of people got that one. That must have been an easy one. Let's see how it plays out. All right. Someone's got to catch MineForge. Running away with it. Number 11. What does contango mean in VIX futures? Who wrote these questions?
Ooh, I like this one. Contango is that name for that great drink. Doesn't it sound like a great drink?
I had that last night.
Yeah.
When longer-term VIX futures are priced higher than near-term contracts. So it's kind of that curve that goes like this on the screen. I probably did it opposite when you look at it. That's what contango means. Let's see how we look here. Wow.
And these are all gamer tags, so we'll meet you on Xbox later. Just saying.
That's right. Number 12. What is a synthetic position in options trading?
Careful of those.
A combo of options and or the underlying asset, which equals another position. So what it means, by the way, they only give you so many characters in each answer, so you got to have to cut things out. So that means that you're using a stock and an option to make the synthetic of the opposite side. So if you buy a call and sell stock, that's the same as the long put on the opposite strike, on the same strike on the put side. Okay.
Huge leverage.
Huge leverage. Let's see how that one did. Ooh, we had a big move up. Gary moved up there. Pretty good. All right, here we go. 13. True or false? Buying a stock on margin means borrowing money from your broker to purchase the stock. These go true or false is going to go fast. The only 2 choices. True. Yo. Next one. Uh-oh. I think MineForge is running away with it. 14. Got 2 more. A few more. Stock price is always an accurate reflection of the company's value. False. Not always true. I'm going to move fast here. I see the time. I'm hustling.
MineForge has already planned his vacation.
Oh, my God. He's killing it. He or she's
Gary,
killing it. I'm not sure who it is.
Come on, Gary.
Short selling.
Oh, I like that. I like these images.
Yeah. Thanks, Dolly. True. Short selling is the practice of selling a stock you do not own in hopes of buying it back at a lower price. That is accurate. That's true. All right. Oh, a big move. A big move. Here we go. What do you have? One more? All right. Last question, I think. Ready? Be ready.
For the win.
Which ingredient is never found on a traditional Chicago hot dog? Ketchup. You never put ketchup on a Chicago style hot dog.
That's
if
like
you
using
do,
what
you get kicked out.
It's like using wasabi in it on your sushi.
That's
Don't
right.
tell the sous chef.
All right, let's see how it did. Third place. Second place.
Hey guys.
First place. Gator caught up. Holy.
All right.
Cow. All right, here's the deal.
Tight.
So I think they asked you to put your email on there. Send an email, you three, to hello@tradier.com. I think we have your emails anyhow, so not a problem. But that was fun. I know some people said that's too hard for beginners. It was a little hard in the beginning. I get it. And other people said I want more. I want more time to answer it. So that was good though. Very
And by
well
the way,
done.
even if you had one right question and that's all you had, you're in the game. You're actually looking at trading. I mean, it's a huge deal. It's only upswing from here.
That's right. Very good. All right, we got to hustle because we're a little over time, Mal. Next up, we have two folks. These two guys are awesome. I love them. Dylan and Ben from PeakBot. They're going to talk about trading bots again, and are they effective during major market events? So let's let them get right to it. These guys are terrific too. They're really smart. They've got a great product. So let's let them just bang away on this. Ready, guys? Here we go.
Hello, everyone. How we doing? Hopefully the audio is okay. Lex, Molly, thank you so much for having us. We're really excited to be here as a part of the Tradier Options Summit. Ben, I'm Dylan Del Rosso, co-founder of PeakBot, joined by my co-founder, Ben. And I always like to say co-host, Ben, because of course we're on the Tradier Hub a couple times a week. We're very excited to talk to you. I can give a very brief intro on what PeakBot is, and then of course we want to get into exactly what Lex just said. Do trading bots work during major market events? So we'll get into that. But for anybody who's not familiar, Ben and I co-founded PeakBot over 4 years ago, and we are an automated trading platform for the everyday retail trader. Our bread and butter is options trading, specifically selling options to collect premiums. So that's what we do. Of course, we're integrated with our great partners here at Tradier. We tell all of our customers, if you're not on Tradier Pro, I don't know what you're doing. So we're very excited to get into it. Ben, I'm going to kick it to you just to introduce yourself briefly, and then I'll do the same.
Cool. Thanks, Dylan, and thanks, Lex and Molly, for that great intro. And shout out to Gator for the comeback there. That was awesome. Came in at the last second for the win. Stick around because we will be giving away something at some point during this presentation. I won't reveal when, but it'll be obvious when it pops up. So yeah, a little background on myself. I've been a retail trader for over a decade now. Same with Dylan. We tried to balance trading while working our full-time jobs, and we one day just realized, like, hey, this isn't working. Like, how can we compete in a market that's open from 9:30 to 4 p.m. when we're working at 9 to 5, right? The market hours just don't allow for us to really be successful. So we wanted to build a product that was made for the everyday individual. And what that boiled down to was automation tools for the retail trader. Algorithms have been available for decades now. We'll get into some of the history in just a minute. But we thought, hey, it's now time to bring these tools to the retail trader. So let's go ahead and get the slides up on the screen, and we'll dive right in. So hope you enjoy our banner screen here. We did use AI to make, and I see Tradier has also used AI to make a lot of the images on screen too. So big fans of that. There is a mind trick in this screen. Dylan, you pointed it out. the AI wrote the word work twice. But if you read through this, do trading bots work during major market events? You don't really notice it.
You didn't notice. You had no idea. In fact, we didn't notice for a while until it made it to this slide, and we were like, oh boy, let's leave it. Let's go with it. Yeah, DALL-E, ChatGPT inspired throughout this entire presentation. So we're going to answer this question. We're going to go through a lot of different things about having the right bot provider, what types of strategies are proper to automate in certain market conditions, these events, what unexpected versus expected events, and how to manage your automated portfolio. We're going to get into it. So I'm going to hand it over to Ben, and I believe we can get started.
Yeah, so for anybody that tunes into our shows either Mondays or Fridays on the Tradier Hub, we open up the week 8:30 a.m. Eastern Monday mornings. Dylan and I, we've got a lot to talk about. Then we review a bunch of stock picks that we've made, options picks. And then on Friday, we'll kind of round out the week, kind of see how everything went, make some picks for the next week, and so on. So if you are around 8:30 a.m. Eastern Monday mornings, join us on the Tradier Hub, as well as Friday at 11:55 a.m. Eastern on the Tradier Hub. So every once in a while, we'll do a fun fact. The fun fact for today revolves around, of course, algorithmic trading. And this dates all the way back to the 40s and 50s, where Richard Donchian, he's the man that's credited with the foundations for algorithmic trading, not necessarily the automated execution itself, but rather developing rules-based systems for trading. And Bubba actually talked about this a lot on his segment earlier today. Following a rules-based system, bringing emotion and taking emotion out of the trading process is really key to being a successful trader. So again, this dates all the way back to the 40s and 50s. But if we fast forward a couple of decades, we can, and it's debated on, who was the first person or group to really develop the first trading bot, right? So we just went ahead and we went with this group from Morgan Stanley. In 1971, they created an automated trading system, called it a trading bot, and it was developed to help them execute large orders in the market. So this was technically the first trading bot all the way back in 1971. So, that's like 50 years ago. But this stuff has been around for a while. It makes you think, why isn't this available widely, or why isn't it widely known to the retail trader yet? That's a problem that Dylan and I are looking to solve here. So that's our fun fact for the day.
And Richard Donchian looks like he's straight out of Mission Impossible, thanks to...
Yeah, we're like Terminator. I feel like that's like Terminator type vibes there. And if you wanted to use the Donchian channels while trading too, you can go onto your Tradier account and then filter for the Donchian channels. It looks kind of like the Bollinger Band channel. Yeah. I'd imagine it's very similar. I didn't do too much research into what the channels represent. I just got heavily distracted by this awesome image that AI spit out of Richard Donchian.
And hopefully we're saying that right, Donchian.
Yeah. Hopefully that's how you say his name.
Excellent.
But there we go, Dylan.
So really appreciate that. What's nice about the fun fact is it shares, how long automated trading has been around. And we say it all the time. Wall Street and a lot of hedge funds and institutional trading has been using algorithms for decades. So what you need to know about the automated trading industry for the retail trader is that, first of all, there is no household name for automated trading. And let it be very clear at PeakBot here, that is our goal. So there are different categories of trading bot providers in this industry. Just to name a few, black box, right? So that is where we would fall. However, we kind of like to categorize ourselves as a clear box. Really what that means is we are providing you with a pre-built strategy. It has its logic and all the parameters set. You're not necessarily going in and selecting your strike prices, your deltas or expirations. It's all set for you. It's going to follow the same rules-based system every single time. What you do is you pick your stock. We like to call it clear box because all of the information on our automated strategies is fully transparent. You can see everything on our website. If you wanted to trade it manually, you can. In fact, we have an alerts service for that, which is another category here. I'm sure a lot of people tuned in here today are very familiar with options alert providers, signal providers. That is all powered by an algorithm that is looking to generate an alert for a trade. What we've done with our core offering at PeakBot is take that next step and actually execute the trade on your behalf through Tradier.
Yeah, let us know in the comments. And I posted a comment just now. Let us know in the comments if you've experimented with any trading bots in the past. Curious to hear what your experience was.
Yeah, absolutely. Because there's a lot of platforms out there. But there's the build your own bot category. A lot of those out there. It's nice because you can, set your own custom strategy essentially. However, it does become really easy to code an unsuccessful bot, even if it looks successful in back testing, etc. So got to be careful there. And then, of course, robo-advisors. There's some huge names in this industry for robo-advisors. Essentially, the difference there is you don't have much sight into what your money's doing. You're essentially handing over cash. You're saying, this is my risk level, invest it. So those are the different types of automated trading available to retail traders. A couple of reasons why PeakBot stands out. And we say this on our live show, and this is what our customers love about the platform. Easy to use, above all else, easy to use, right? It's very easy to get lost in a lot of these trading platforms. We wanted to make it so simple. So my dad, who knows nothing about the stock market, can go and make 30% last year and didn't look at his account one time. There's others who are way more active, but it's a set it and forget it mindset. Affordable, PeakBot, we start our subscriptions at $29 a month. The idea is that you pay for that in your first trade with the premium you collected, right? And then, of course, full transparency. We are one of the only platforms who share a full list of our traders' results and our strategies. You can track that in your account as well as with your broker. And again, we share all the details of our strategies in case you want to trade it manually. So we're going to get more into this, but I want to also draw attention to the right-hand side. You can see the little image here. This is a PeakBot account on mobile. Of course, we are a web-based app as well, but very mobile-friendly, super simple to automate a trade with PeakBot. Select the bot you want to use, right? One of our pre-built strategies, the wheel, iron condor, credit spread strategies that roll contracts, take profits. We got it all. Select your bot, pick your stock from our watch list, which is curated, and then add the stock and get going. So we're going to talk more about our first experience together at PeakBot with a major market event. And it was a fun one. It was GameStop and AMC rally. And, my personal experience was less chaotic than most because we at the time actually had a momentum-based strategy, swing trading bot, and this GME stuff just started to rumble. And I automated GameStop in my PeakBot portfolio, and I was in a sales meeting at my full-time job at the time, and or a marketing meeting, and I got a buzz in my pocket that PeakBot just got me out. I only made 40% on GameStop, which some people laugh at me.
40%.
Yes, they're like, oh, who boring, who cares? However, I didn't have to stop my life, and be all caught up in this trade and what's happening and so tuned into the market. It just happened automatically for me, and I was on to the next trade. So we're going to talk about things like that unexpected market event as we go further here.
Cool. And it's a really, when you dig into that story, it's really great to just step back and realize that you didn't have to do anything in that moment. Before GME started to crash back down, the bot was able to get you out. Now, was that designed? Not necessarily. And, that was at the very, very beginning of when we started automating for ourselves, right? I think there was a lot of luck involved in the whole GME and AMC rally. I had a similar experience in AMC where the bot got me into a position, got me out. I had no idea. I looked at my account and I made somewhere north of 100% on the trade. And I was like, wow, this is really cool stuff. Again, I think we got lucky there. The bot wasn't necessarily designed for that, but that leads us into this next point. Really, really important as trading tools become more widespread and more used, and trading bots, make their way into mainstream markets. It is really, really, really important, and I can't stress this enough, to know your bot. Know what your bot is built to do. Can you modify your bot? Will the bot turn off during earnings? What rules does it follow? there's a bot, or there was a bot at least, maybe it still exists, I don't know. There was a bot that just followed Nancy Pelosi's trades. So that bot was built just to follow whatever Nancy Pelosi was trading. Does your bot have AI built in? Is it going to adapt its strategy as market conditions change, right? So knowing your bot is really, really important because you want to know what it's going to do during different types of events. And we're going to dig further into unexpected events and expected events. And you'll hear that common theme of you really need to know what your bot is going to do, because the bot's only going to do what the bot's going to do. I know that sounds kind of silly, but you got to imagine that, you know, you're talking to a fifth grader, maybe even younger, call it a second grader. They're likely going to follow your instructions, you know, only to what you tell them to do. The bot's not going to know any different from what you tell it to do. So if a bot's not designed to handle an unexpected event, like, you know, the outbreak of a war, and that's going to cause, you know, uncertainty in the market, a pandemic. We saw what happened during COVID, how the market dropped. That was actually one of our trivia questions a couple of weeks ago. That was the shortest bear market in history. I think it was like 88 days long. Yeah. And like the GameStop rally, the multiple rallies that GameStop had. How is your bot going to handle those types of events? And then there are expected events, which bots could be more easily built around, like earnings. We know earnings are going to come around every quarter. FOMC, we got FOMC today. Jerome Powell is going to take the podium after 2 o'clock today. And then elections, huge election coming up in 60 days now, a little less than 60 days at this point. How is that going to impact the market? So let's start to unpack these events just a little bit and talk through, you know, what your bot can and can't do during those times. So Dylan, I'll kick it to you to talk through unexpected market events.
Yeah, thank you, Ben. So when you think unexpected market events, as some of these that we've covered, and you can see on screen here, the COVID pandemic, the first GameStop rally, of course, the infamous market crash of 2008. These are, you got to be thinking about playing defense. Now, most people, of course, in its name, they don't know that they don't know that these things are going to happen. It's completely unexpected. It happens all of a sudden, and you don't know how to react or how the market's going to continue to react. So what's important is, if you did know that this was coming, they'll probably make a movie about it, first of all, right? As we know. But when you talk about unexpected market events, bots cannot be designed for these things to happen. But what you can do when trading with a bot, if you're working with the right bot provider, is make sure that the proper risk management practices and logic is built into your strategy, right? Not very fun to be bullish through that COVID pandemic. Depending upon what side of the GameStop rally you were on, you were either really happy or very devastated. And you got to make sure that your bot can get you out, like it did with Ben and I on GameStop and AMC. So just keep in mind that when you're trading in these types of events and you recognize it happening, make sure that, of course, the golden rule, you're diversified, right? We should be very clear that trading one bot isn't just the answer either, right? There's one bot is only going to be built for to have success in a certain market condition. We want to make sure that you're trading with as many bots as humanly possible on as many stocks or contracts as possible to make sure that when events happen like this, that you're directional, you're able to withstand any crazy volatility in the market. So when it comes to trading with bots in unexpected marketing events, it's really about playing defense. When we get more into the expected market events, you can start to play offense as well with your strategies as well as defense. So, Ben, I'm not sure if there's anything I missed on that slide. If so, feel free to jump in, but I'll hand it to you.
Yeah, no, all good. And you bring up a good point. Like, risk management is key, especially through these unexpected market events. You know, a lot of people are thinking there's potentially a recession coming up. One day the market might just snap. You know, is your bot built to handle something like that? But sure, let's move over and focus on expected market events now. And again, throughout the day today, we're talking about how can we be profitable through certain market events? You know, what types of strategies exist in certain market events? FOMC is today. I'm sure there are a lot of opinions on different strategies to trade through FOMC days. At PeakBot, we are automating, as Dylan mentioned, selling strategies for options. So option selling strategies. There's not really much upside for us as option sellers to enter into a high volatility period, other than collecting more premium than we normally would. But we're exposing ourselves to more risk, at least than I would like to have, and I'm sure than Dylan would like to have too. By the way, nothing we say here is financial advice. We're not financial advisors. Got to get that somewhere. Bubba did have a disclaimer screen, which was great. I was joking around in the comments that he needs a non-financial advice hat. We need a not financial advice hat too.
Yeah.
So not financial advice, but personally, I don't want to trade through these high expected volatility days, right? And we've got a couple of examples on screen of what some of those days might look like. So for us at PeakBot, we have several option selling strategies that we just turn off for certain days. So we're building out an Iron Condor, we're building out a 0DT SPX strategy that we're going to automate, and it won't trade on FOMC days, for example. So like a day like today, just won't trade. Actually, this feature might already be built into our Iron Condor strategy. So it just won't trade on a day like today because, again, the upside just isn't there for us. It's too risky. We want to keep these high probability trades repeating themselves over and over and over because that's our winning formula, as we believe. And by exposing ourselves to additional risk, you could kind of mess up that formula. So there are three examples that, I wanted to take a look through, and we just covered FOMC, how we kind of made adjustments for FOMC days. I want to point out this top chart here, and this is this event will be burned into my brain forever. So this is about a year after PeakBot launched our commercial product, and when we started bringing in public users to automate with our algorithms. And this was specifically for our wheel strategy. And prior to this date on screen here, the wheel strategy was simply selling a cash secured put, and if assigned, selling a covered call. Plain and simple, right? People loved it. We loved it. As we can see, this chart on Upstart was fantastic. All the way from what we can see on screen up until the middle of August, we were just in a complete bull run, and then bam, earnings hits. And in a matter of less than a week, Upstart's price had dropped like 60% and then continued to fizzle down. So if you were selling cash secured puts, oh man, you got caught holding the bag. I got caught holding the bag there.
Yeah.
We just didn't have any mechanism for support and to cut our losses there, right? So what we did was we interviewed a lot of our users, and we interviewed some people that weren't our users and that were market experts, right? And ultimately we concluded, okay, well, we need to make a change here if we want to keep people happy and protect capital, right? We want to make sure that when people are trading with the bot, capital is protected. So what we did and what we concluded here was we should set up spreads. We should sell spreads instead of just selling a cash secured put or a covered call. So that way we've got a hedge built in, and we can only lose so much based on the size of the spread. So that was a change that we made. That was something that we wanted to build in because earnings happen, right? And people will trade through earnings. Dylan and I like to avoid that, but people will trade through earnings, and we want to make sure you don't lose your shirt when trading through earnings. And then finally, the bottom chart here, this is the last election, and we can see crazy movement, huge gap up overnight. And then the price dropped back down throughout the entire day. I believe that was the day the election results were announced. And we can see a high volume spike there. It looks like double the trading volume from the previous day. So who knows what to expect really with elections. But we do know that there is likely going to be higher volatility there. So Dylan, anything I missed?
No, nothing you missed. I mean, we're going to get more into the changes that we, as the bot provider, PeakBot, makes along the way here. And Ben gave a great example of our initial wheel strategy. The traditional wheel cash secured puts, covered calls. We introduced that in January of 23. And on the right-hand side, this diagram here is, of course, something we created for our subscribers to explain those new to options and selling options and all that. We put this out there for them to understand, hey, this is why it's called the wheel. We're just in rotation here. Very simple. But to rewind, prior to us even creating the wheel, when PeakBot launched our subscriptions in August of 22, we were equities trading. We had momentum-based swing trading equity strategies that were getting you in and out of positions every 2 to 5 days. And that was great, for 2 years of beta testing prior while the market was pumped up. And we had a lot of bull runs. So we were doing well there, but that changed, right? And it's not talked about enough that, trading bots in general have a shelf life, right? If you're not going to make adjustments to the logic in this strategy, and maybe it's something you're purchasing or utilizing, or maybe you've built it yourself and you don't ever adjust the strategy to meet current market conditions, it will have a shelf life. It will perform great for 3 months, 6 months, a year, maybe even 2 years. But then there's going to be a lot of difference, a lot of shifts in the market and volatility, and things need a tune up. So we dropped equities trading. We got into the wheel strategy. That was our entry into selling options. And truth be told, Bubba, who presented earlier today, was in our ear as well. He was even saying, like, look, I'm trading the wheel strategy. This is a great strategy. And we talked more about it, and we were like, man, I think we can automate this. So that's where we started. Ben then told the story of, people trading stocks that were maybe on the watch list that were very volatile or low cost. And they were getting assigned shares on stocks like, Ben, I know you remember this one, Marathon Digital. Upstart was another one. Carvana, which you were on the right, I was on the right side of last year, but a lot of people, since it's a pretty turbulent stock. So what we needed to introduce credit spreads. We needed to define our loss. So what we did in August of 23, after listening to our customers, is adjusted to what we call the vertical wheel or the hedged wheel. So we're selling put credit spreads, selling the 30 delta, buying the 10, and then we were, if assigned, doing call credit spreads, selling the 50, buying the 20. We've actually, even since we made these slides, have adjusted the wheel strategy again to enter a combo spread, right? Correct me if my term is wrong.
Yeah, no, you're good.
A combo spread, if assigned, with a protective put in there. So we're constantly making changes. Of course, those who are familiar with the wheel strategy understand that it is a neutral to bullish strategy. And we were crushing it, and our subscribers and our traders were crushing it in the neutral to bullish markets. However, we had these pullbacks, like coming out of April 2024, where the market was pulling back. We needed to be fully directional, right? We had a lot of traders coming to us saying, hey, look, love the strategy when the market's doing well, but I'm exposed on the downside here. So how were we going to be able to react to that? Well, what we did was we built what's now called our trend spread bot, which is similar to the wheel in that it's selling weekly expiring options contracts on the credit side. But where it differs is it trades with the trend. So if you were to look at PeakBot's watch list, it's updating data every 5 minutes. If the trend is bullish, if our watch list is determining that the trend is bullish, it will sell a bullish trade, a put credit spread. If it's bearish, it'll sell a call credit spread, and etc. So we make these changes to make sure that our customers are protected. As the algo provider, we want to play defense, right? It's all about securing your capital. Of course, we want to make gains, and we will by collecting rent and premium over an extended period of time, but we want to play defense. And these are just a few examples of us as bot providers adjusting our strategies to match current market conditions. Ask yourself, is your bot provider doing that as well?
Cool. Great, Dylan. I know we're getting close on time here, so let's fly through these. By the way, can you see me still? Because I'm just drawing a blank screen for myself at the moment.
You are frozen. Luckily, you're not making like a funny face or anything. It looks
all right. I'll stay frozen for a second. So Dylan, here's the game plan. We're going to quickly go through these next couple slides. We'll go over this question here. So we want to bring back some trader trivia. And then Dylan, for the next slide, just read through it like a bullet list, and then I'll close us out on the last slide. How's that sound? So before we get into the question, we want you to text us the answer to this question, not the phone number on screen. That's our business line. Anybody that answers this question correctly is going to get a free quarter of PeakBot. So if you're curious about trying out different trading bots, you could try ours out for free for a full quarter. Just text us the answer at 973-888-1166. So the question is, what percentage of options volume is traded by an algorithm? And if you were tuned into our show a couple weeks ago, we talked about what's the percentage for equities? What's the total percentage of the market that's traded by an algorithm, or total equities market that's traded by an algorithm? And Dylan, what are you thinking?
Yeah, what's funny is we've rehearsed this presentation. You being frozen right now is hilarious. I don't know how you're going to fix it without knocking us out of the slides and everything else, but we'll try it. So now it's a black screen, by the way. Your frozen picture's gone. I'm also killing time. You're back.
I'm back.
Killing time for people to be able to text us their thoughts on the question here. We've rehearsed this, and I still don't know. I think I know the answer, but I don't know the answer. What I do know is that for equities trading, roughly speaking, there's a lot of different statistics out there, but roughly speaking, for equities trading, at least here in the U.S. markets, 3 out of 4 trades, 75% of equities trades are traded by an algorithm automatically, right? So options, I don't believe it's that popular. I don't think it's at 70%, but I also don't think it's as low as 25. I don't know. I'm never right, but I'm gonna go with C, 40%.
Awesome.
And we'll see if whoever texted us. Oh, there it is.
Yeah, I put hey, when in doubt, see it out, right? That's what they taught us in school.
That's kind of the logic I was following. It was a good guess.
Yeah, data that was compiled by Goldman shows that 60 to 70% of equities trades are executed via algorithms, 40 to 50% of futures, 35 to 50% of commodities, and then just about 40% of options trading was done via algorithms. So whoever sent us a text message with the answer C will get your information a little bit later today and get you a free quarter of PeakBot. All right.
Really quick, Ben, I know there was a question in the comment a few minutes ago, from Anjan. Are the bots, do the bots include specific trading logic, or do we have to provide our own logic? Very good question. And that depends upon your bot provider. It depends upon what strategy, who you're working with. With PeakBot, logic is built out for you. We have all the details of the logic for you to see, so you know what your bot's doing, but the logic is pre-built. We select the deltas, which normally are between the 25 and 30 delta on the selling side to collect premium. That way you have a nice enough win rate and you're still collecting enough premium. So with PeakBot, yes. With other bot providers, not always the case.
But by the way, our business line is blowing up right now. Please text us. Don't call us.
We're getting calls. Hopefully one of our
text
teammates.
Us. Please just text us. No calls.
Shoot us a text.
So Dylan, get through this. Treat this as a checklist for automations.
So managing your automated portfolio. These are questions you should ask yourself when, and we'll get to that question there, Wayne, in just a second. Managing your automated portfolio. Ask yourself these questions before activating any trades. Number 1, form your opinion on market conditions and upcoming events. How do you feel about the market? At PeakBot, our customers make a lot of weekly trades. So Ben and I, on our live show, we like looking at the SPY, the technical analysis tool on Tradier, what direction it's headed, how do we want to balance our portfolio? Once you know that, what strategy fits with this market? If you're really bullish on it, maybe the wheel's a great strategy. If you think it's flat, iron condor, whatever it might be. Now determine what's your risk tolerance, right? How much, how risky are you trying to be here? You trying to roll the dice, right? Or are you trying to be more of an investor and just collect your premium on some well-known stocks? And then finally, how much are you willing to trade, right? How much cash are you willing to invest in this market with this strategy and these stocks, right? And at that point, if you have all these questions answered and you feel good about it, which one of these bots fits all those conditions, and activate it, right? So this is a great checklist to use. Ben and I spend about 45 minutes a week adjusting our portfolio, give or take. So this is the process we follow. We do it live on our show.
Yep. Tune into that show and you'll see the process yourself. And then yes, transparently, we do take a little bit of extra time off of the show. Okay, so to round this out, because again, we are getting up on time here. Do trading bots work during major market events? That's the question that we started out with, and that's the question that we wanted to answer. And the answer is yes, and there's a caveat, of course, right? Yes, the right bots can work during major market or economic events, right? There are unexpected events. There are expected events. Bots can handle both, either from a risk management perspective or anticipating a certain movement. You have to find a good bot provider. Find a bot provider that's going to update strategies for you, tell you about them, tell you why they made the updates, and constantly monitor market conditions and make updates accordingly, right? If your bot provider isn't doing that, as Dylan mentioned, the bot's going to become stale. There's only so long of a shelf life for these bots before they need to be adjusted. Know your outlook on the market and what strategy you want to trade. Go through that checklist that Dylan just showed. When we post this replay, pause that on the pause the screen on that slide and then screenshot it, and then use that as the 4-step process, 5-step process that you go through when you want to make a trade and when you want to automate a strategy. And then once you have your overall thesis on the market, once you listen to what the market's telling you, right, find the bot to match it, so that way you don't have to trade it yourself. You can go along with your day. You could focus on building your career. You could focus on spending time with your family. You could focus on working on your golf swing, whatever it might be. Bots are great in the sense that they provide time back to you during your day, and they also eliminate a lot of human error. You're not going to fat finger any trades. You're not going to enter the wrong tickers. I've done that before. Yeah. And you're not going to enter wrong quantities. I've done that too, and that gets scary when you enter 100 contracts instead of just one, and you didn't expect that could get pretty scary. So overall, again, the right bots can work during the right market events. So perfect. Hope this was informative. Again, everybody that texted us the correct answer, which was C, will get a free quarter of PeakBot. We'll be reaching out to you before the end of the day today.
And if there's questions, continue to ask us in the chat. We'll monitor, of course, for a little while here. Appreciate Tradier having us. And any more questions, contact us. Go to usepeakbot.com.
Perfect.
Hey.
Hi, guys. Hey. Nice job. I love when Ben got frozen there. That was awesome.
Yeah, that was the best part.
Hey, we roll all the punches.
Great job. Really great stuff. Real quick, your show on the Hub, I would like people to know when to see you guys on a regular basis, right? During the week. Yep. So you guys are on which days? Tell the audience.
So Monday mornings, 8:30 a.m. Eastern, because we're Eastern. We're not in Chicago like everyone else. Jersey boys. Monday, 8:30 a.m. Eastern, and Friday at 11:55 a.m. Eastern, just before noon, so you can catch our live trades being made completely hands-free.
Okay, good. Couple questions that we got to run. Okay, how's that sound?
Yes, great.
I think you answered everything. You were hitting the chat up too, so that was awesome. Do you find there's a minimum dollar amount that is perfect for this sort of offering, or does it not matter?
So I'll take this real quick, Dylan. So the minimum, because of FINRA requirements for margin and trading spreads, you need margin, is $2,000, right? Okay. Now we find that the sweet spot, and we see a lot of people getting started with $5,000 to $10,000 in their account. So you don't need too much capital, and that really allows you to trade with enough to see a decent return, right? You want to be able to pay for that subscription. Now we've lowered our subscriptions down so that way you can pay for your subscription with just small wins here and there. We're hitting base hits, right? We're not shooting for grand slams. But we do see our average subscriber automates with around $20,000. There's of course outliers on both ends, but We always see people start with between that $5,000 and $10,000 mark till they get into the swing of things. They start to feel it out. They start to feel more confident, and then they'll deposit more money, or they'll just automate with more money.
Right. Okay, good. One that hit my feed earlier was, what type of orders do the bots use to get in and out of the market? Or is that something that the user sets? Are you typically using market orders to get in and out, or is it pretty strong limit?
We are using limit orders, except for the emergency exit on our 1 DTE Iron Condor strategy, right? And we have that emergency exit set out of market order just because we want to eliminate the chances of anybody getting assigned, right? Especially people who are only trading with $20,000 in their account. If you get assigned on SPY, well, you're going to get a margin call, and that's not going to be fine.
Got it. And then finally, unless Molly has,
I do.
I know. So you mentioned a lot about you guys like to capture the premium, so your premium sellers more than premium buyers. Anyone using a premium buying bot at all? Does anyone ever do that one, do you think, or not so much?
So we are automating with a white label partner right now, a premium buying strategy. More details to come on that. But if you're just using peak bot strategies, we are strictly option selling right now.
Okay. Got it. Strictly options. Okay. And then real quick, Ma, hold on. She's dying to go. You said that if you have a bot, you have another bot you can use. I didn't understand that because I thought all the bots were internal to PeakBot. So it sounded like maybe you're indicating that people can bring outside bots from their party somewhere else and bring them to you. Am I asking that incorrectly?
Not asking it incorrectly at all. To answer it to the best of our ability, what we do is we partner. We're not just coding bots for anybody. We are very strategic about who we partner with call it a white label or a subdomain where we automate their existing strategy that they have been using with their trading audience or community. If we see that the strategy is successful and that there's a want for this to be automated in the market, we'll partner up with them. We'll automate their strategy. And those are called our premium bots, our premium strategies. Our peak bot strategies, Wheel, Iron Condor, credit spreads, those are almost, we don't want to call it basic. They're not, totally basic, but there's a good place to start. Then we work with specific other traders. Awesome.
Okay, Miss Molly, what do you got? What CT got for us? Be careful. Hold on to your chairs, guys. This could be from out. You never know.
All right,
we're ready.
This question is about a decade too early, but we'll ask it anyway. So, do algo traders, do you guys look at quantum computing yet? And I know there's error correction and it's very fragile, but when that comes online, which will be coming online, we use those in scenario tools, adaptation. Speak to it.
Yeah, as of right now, we're keeping things as simple as possible, right? The whole name of our game is we want to be transparent. We want to peel back the curtain and let people see behind the scenes and see what we do and how we're building things and what we're building them on. So in terms of leveraging quantum computing, we're barely leveraging AI at this point.
That was
and that's, in full transparency, we want to keep it that way because AI is harder for everybody to understand, for the average person to understand. It's much easier to understand if then logic. If this happens, then that will happen. So in regards to further improvements and deeper analysis using quantum computing in the future, we'll probably use that to some extent. But as of right now, we are not.
I think that's important to know because AI behind it currently has a couple biases. And so just to stay safe, it's really great. Bubba spoke about it. You said he was in your ear to really keep your tools and know how they function behind the scenes. So that's great to know. That's great.
Yep.
And I love your show. Great show.
Thank you.
Yes.
These two guys are rock stars. Love them. Great job, guys. Thanks so much for everything. We'll be in touch. Awesome job. And it's usepeakbot.com.
That's right.
All right, guys. Thank you very much.
Thanks, you guys.
Thanks a lot, guys.
Take care.
Bye now. Hi, Mal.
Hello.
It looks like the Fed cut 5 basis points. Is that right?
That looks like.
I'm gonna read it real fast. Okay. We'll get it. Maybe Steve knows this. Our next guest. He probably does. He's been around
He definitely does.
So moving along, our next guest, Mr. Steve Collegian. He is going to talk to us about strategies around trading for the upcoming life. He's a great analyst. I'm going to call it that. It's probably not the right word, but he is awesome with the charts. He probably trades a good bit of futures. I know he trades stocks, probably some options in there too. He's been around longer than anybody, 40 plus years now. So you add him to the equation with me and Bubba, it's 150, it seems like, in the business. But he's a great cat. Yeah.
And Steve is really dynamic. He's, one of his videos got 6 million views. He's speaking at Grant Cardone's event. I mean, this guy's big. So he's going to start doing live Q&As for Tradier Hub. Come over and see when those are going to be. But he is just really fun. So hold on to your seats.
Yes. And then he does a show too, Mal. When is that again?
Yeah. Back to the Futures. We're gonna announce it afterwards, so stay tuned because you really want to make sure that you watch this whole thing. He really knows his stuff. And by the way, don't be afraid of futures if you've never traded. It's actually easier. So he's gonna go into all of that. Yeah.
All right, cool. All right, good deal. Let's get Steve out here. We're running a little bit behind. We'll get him going. Steve, have at it.
Hey everyone, I'm Stephen Collegian, and I am so excited to be here at the Tradier Summit. And I get the unbelievable task of being able to speak during the FOMC interest rate decision. And Fed just cut 50 basis points. Again, in my 41 years in the industry, doing this near a political event like the election, the S&Ps pushed up above the 57.55, just dropped 35 handles. NASDAQ dropped roughly north of 100 handles here off the highs. Again, the market, this is what has fueled the 37% rally all this whole time, talking about interest rate cuts and more or less understanding the where the markets are going to go. However, with that being said, if you look back, it depends on how fast they cut rates. I would have faded this. You sell on the news. 50 basis points to me is the Fed's telling you that they're worried about a recession. Now, this is a big problem here. You're going to have what's called stagflation. Inflation is still relatively high across the board in food and in energy, electricity, insurance, et cetera, et cetera, et cetera. However, they're seeing an economic slowdown, especially in the jobs market. So they're at a no-win. I don't think they know what they're doing, but that's for another conversation, okay? So 50 basis points, everybody was betting a quarter. I think this 50 basis points, to me, is something that the markets didn't expect. And I think you sell on good news, and that you see what happened here. The S&Ps literally just dropped. If they tick at 15, they'll be down 40 handles off the high here. So I'd probably be looking to buy the S&Ps if they pull in to the 12.5, 18.5 range for a trade. Gold's making new highs. The 30-year bonds are down more than a half a point. The 30-year bonds are down more than a half a point. You're looking at stocks like Microsoft, Meta, everything just got absolutely crushed from the highs. I mean, the programs came in, they ran them up here. One of the things I'll show you is divergence patterns. And when we were making new highs, I was waiting in the studio to come on. You had non-confirmations. The MACDs on indicator 1 did not confirm the highs here. So again, when you get this big push up, okay, the first thing I look at is any sell divergences, and you had the sell divergences right there, right? You're making new highs on the price, but the MACDs did not confirm. And that was a clear indication of a non-confirmation. The way I look at the markets, each and every day, I have 5 conditions. I have a trend, a buy reversal, a sell reversal, a correlation, and a disconnect. And then of the 5 conditions, each condition has a strategy, a buy and a sell divergence, okay? For me, the most important thing is to be consistent each and every day. To see the S&Ps just dropped 42 handles here. NASDAQ just dropped about 140 just now. This to me here is clearly telling me that the markets are in trouble here. Okay, that the markets are in clear trouble. 50 basis points. You sell on good news. I'm doing this 41 years, and exactly what happens. You want to be able to look at the market, trade the market in a way that gives you the best and be consistent each and every day. All right. I mean, I couldn't wait to get on because I wanted to fade this rally in front of all of you, because I said you got the sell divergences on the 30, 60-minute time frames, and I'll bring them up right here. If I can bring up the bigger time frames here, you can see here on the hourly chart here, 1 hour, and this is the 30-minute. You can see here the push up, the MACDs did non-confirm here. The MACDs did non-confirm. Gold just dropped $7. I think we're headed down. I think this is a bearish indication of what just came out. S&P's just dropped over 50 handles off the high. And for me, the most important thing is to be able to look at the patterns and see the patterns for what they are. When you get a push up like this, right, you can see the MACDs, the non-confirm. Look at them, down 55, 57 handles here, okay? You should get maybe a pop here. But again, any rallies here, I would be looking for shorts, okay? Any rallies, I would be looking for shorts. 30-year bonds, this has all been priced in. This has all been priced in, okay? And being that it's priced in now you're looking at gold. Gold is up 21. The 30-year bonds are down 0.75 of a point. This, to me, here is not a good scenario for the market. I think a 0.25 point would have been good, okay? Remember, the Federal Reserve once said they're not going to cut interest rates unless the CPI gets to 2%. We're at 2.5, 2.6, whatever the number is. Again, it's not, I think this was more political, okay, on this front. But again, to me, the most important thing is I think the market's going down from this news. We've already had this big run up. It's everything's anticipated. And now in my opinion, you sell the news. Someone sent me today, right before the FOMC announcements, they said, look at this chart. If the Federal Reserve cuts in a very fast, aggressive way within 12 months, the markets are down average of 20%. If they do it in a slow, gradual way, I think the number was 8.8 to 9.5%. Either way, I don't think this is a good number for the markets. I think lower prices are to come. I think it's telling you that the markets are more or less everything has been priced in here. When I do look at the markets, I do look at multiple time frames, okay? And the multiple time frames that I look at, okay, gives me the ability to come up with my 5 conditions, right? So the conditions are off of the 15, the 30, and the 60-minute time frame. So when you get these time frames and you have these time frames, either they correlate or they disconnect, and that is exactly what we look at each and every day here. S&P futures are bouncing here now. I'd be exiting any longs on this here between the 12 and 16, 18 range right now. I would be looking for shorts on gold on another rally up. But here again, using multiple time frames, being able to pick up non-confirmations, whether you got buy divergences or sell divergences, this is a very, very key point in trading. If you can master the art of divergences, you've mastered the art of trading, okay? And for me, the most important thing is to be consistent. When I do my live stream every single day from 9 to 4, it's all about being consistent, understanding the pattern, and then going from there, okay? Gold is now trading right now. If you look at gold, I believe this gold, if it gets up to the 18 to 20, 21 range, I'd be looking to short in that range. You see right now I'm going to get buy reversals on the GLD on the 30-minute time frames. And, I think basically the highs are in for the day. If you look here, I just got a buy reversal on the spiders and diamonds on the 15, the Qs on the 15. Either way, I just think based upon the patterns, based upon what we're seeing here, I think the market in the next couple of days should start trading lower off of this news. The news here is now signaling that the Federal Reserve is being more aggressive, whether it's for political reasons and or for any reason to try to boost the market up. But I think the market now is already factored in. They know they're going to cut rates. They already signaled their hand here today. It's not just what they're doing, whether they cut again in November and or December. It's also signaling that the Federal Reserve is worried about an economic slowdown. Here they have an economic slowdown, but then on top of that, you still have higher inflation in prices in food and energy, insurance, electric. I mean, insurance is up over 20%. Some states 30, 35, 40%. So for me, I think that if I'm in this market, and whether you're trading futures or if you're, and that's another thing, whether you have positions, I would be looking to scale out of these and wait for lower prices. I think that this is a clear sign here that the Federal Reserve is very worried. I think the ratio was 85% on the Fed fund futures that they were going to cut 25%, and I think it was 50% is where they were going to cut 50 basis points here. S&Ps rallied here, gold's rallying. I'd be exiting longs here on S&Ps, rallied nicely here. I'd have been scaling in on that. Again, into the positive MACDs on the 15 and the 5. It was a nice pattern. Now just see if they can push up and see if the 15s can work off this oversold condition where I'd be looking for shorts. Gold pulled into the 08 level, just rallied 12 here. S&Ps pushing up here, just rallied about 25, 26 on that. All right, scaling into positions. Again, when you scale into a position, okay, depending on your account size, you want to be able to understand based upon whether you're trading micros or you're trading big ones, to be scaling in and scaling out of positions here. NASDAQ just ran 100 just now. Okay, gold just rallied from the 08 up. 30-year bonds just rallied about 10-30 seconds just now. Again, it's important to understand when you're these type of events, you got to keep your hand on the mouse. If you don't want to trade it, that's fine. But if you want to trade it, then you got to be able to be cognizant of fast markets, as they put the big F on the board. Whenever time I saw markets go to fast markets in Chicago on the board of trade or on the CME, you saw the big F on the board. That meant fast markets. That meant all the guys trading in the pits had to go and verify all their trades, not once but twice. Okay, so that's 41 years being in the game. A lot of people come to me and say, Steve, I really want to learn how to trade futures, but the most important thing is, I don't really know. I'm scared. What's a future? What's this? What's that? I'm nervous about using the ladder and execution. And I say, time out. Remove the word futures, right? They say, well, I know stocks, I know bonds. I know stocks, I know options. I'm like, okay, no problem. Take the word futures out. Now take the word water. We're going to trade water, okay? And so when you look to trade water, is it bring you back down to reality that you don't have to worry here? 30-year bonds making new highs here, 21.30 seconds last sale. Gold, I'd be looking to cover this gold here anywhere between the 14 and a half and 18 and a half. Here goes gold dropping now. Okay, again, you're looking at the GLDs here. Okay, you got sell divergences. Gold just dropped $2.50. S&P's rallied 30. NASDAQ futures just rallied 120. Again, on that pattern, you got the oversold condition on the, let me just switch it here. You can see the oversold condition into the positive MACDs. Now, if you look at the spiders here, the spiders just reversed the buy on the 15-minute time frame. So what am I going to look to do? I'll look to buy pullbacks on the 15-minute time frame. What I'm talking about going forward, looking for lower prices, not happening today. It could happen today, but I don't think it's going to happen with an hour and a half left to go in the day. My view is in the next several weeks, I think we're going to have a lot lower prices here. Okay. I think this is, again, a very negative tone, and the Federal Reserve is signaling that they're worrying about the overall jobs market. And I have a little thought that this was more politically motivated for the election. Okay. Here, what we're looking for right now is when you look at the markets, again, I talked about, using multiple time frames. And when you look at multiple time frames, it is important, based upon my research during the US session, to be looking at the continuous contracts and the underlying ETFs, right? And when they correlate, it's very, very powerful. Okay, but when the 5 time frames I look at when I look at the continuous contracts is the 3-minute, the 5-minute, the 15, the 30-minute, and the hourly charts. When you look at the underlying ETFs, I look at the 5, 15, 30, and hourly, and that's important. I want to show you the S&P futures here, if I can bring this back up here. Okay, so here we go again, right? We're pushing up here, and you can see when we pushed up how the MACDs on the 60-minute time frame on the Nasdaq and S&P futures, the 60-minute time frame did not confirm the high, and that is an absolute no-no here, right? If I draw my horizontal line right here, you can see how the MACDs did not confirm when the S&Ps were pushing up to what, 57, 55, 57, 58. I mean, literally, I was waiting in the green room because I just couldn't wait to get on to be able to say I'd be looking for shorts up here on the off of the non-confirmation on that. Gold, I'd be looking for pullbacks here on longs. The 5-minute time frame right now is $8 above my weighted moving average, so pullback should happen soon here. And when you get this pullback, it should set up some nice longs here. I would like to see a pullback. I don't know if we have enough time, but on the 15-minute time frame, but I don't know if we're going to have enough time for that. Okay, gold here, I'd be shorting again here, 23 and a half up to the 25.5, 26 range. Again, knowing this pattern, we should get a push down here, and this is a over an extended period. So normally my standard deviation right now is about 2. Right now we're at an 8. So hopefully this pattern should drop and then set up the long on gold. Those of you who are trading futures markets are to me, I think people have been trading very differently, whether you're trading short term, intermediate, or long, and whether you're trading stocks or options, it doesn't make a difference. For me, teaching, whether it's stocks, options, or futures, is something that has given me such great joy at this stage in my career. You know, the title of the show is pretty much trading in an election year, the volatility, right? And so what we're looking at here is, I remember back in 2020, I mean, the S&Ps were moving 25, 30 handles at a clip, because whether the president at the time was tweeting or someone else was tweeting something, the volatility just became insane from, I think, September 30th right before the election period. So again, it's important. Remember, I have the 5 key words. The way I look at the market is basically I look at my indicators, 1, 2, 3, 4. It's on I built this, and it's built on TradingView, and it gives me the ability to identify the patterns. So price leads, indicators lag, right? But the indicators set up the patterns. Okay. So indicators 1, 2, 3, 4, indicators 1, 3, and 4, I use 85% of the time. Indicators 1, 2, 3, 4, I'll use 15% of the time. I then look at these very important numbers to the right, and these numbers tell a tale, and they are very important as well. One is the price from the moving average. One is another price from where the algorithm reverses. I do look at buying pressure, which is indicator 2. Indicator 3 is my proprietary overbought, oversold oscillator, it dynamically. And the indicator 4 is my own proprietary trend algorithm, which gives me the ability to more or less see the market conditions, and gives me gold. I look to cover, I would lower your stops. I would cover gold 22.5 or lower here. And then basically indicator 4 gives me the ability to see which way the markets are going on pure mathematics. So again, you know, I am so honored to be here today, and especially given the segment right when the FOMC released the 0.5 point cut on the interest rate decision. But for me, I think it's just really important that the community of people that I speak to each and every day are just learning and guiding them and giving them the mentorship that they deserve each and every day to be able to help change their lives and to be able to trade the markets effectively. And when you start seeing results and gaining the confidence and hitting your goals every single day, well, for me, there's nothing better each and every day. Again, so many people, like I stated 5-10 minutes ago, have come to me and said, I think they're going to drop here, but I said to me, Steve, trading, futures, I'm not sure, and I was just discussing this with Molly about a week ago or so, or a couple of days ago. And I said, there goes gold, just dropped $4 here. Okay. On this deviation strategy I have. So again, I said, Molly, I said, if I told them they just removed the thought of trading futures, just trading water, would that help the mindset? And I have actually said that to people before. And I'm like, oh, that makes a lot of sense. I'm like, don't get wigged out because of the word futures. Even though you've never done it before, you can learn. There's a process and the ability to challenge yourself to the point is unbelievable. To be able to really conquer this in a way that gives you the best understanding of the markets, right? During the election year cycle, volatility does pick up, right? And knowing how to trade that, it's just amazing how the S&P's just stopped trading here right now. Where they're moving in very, very slowly here. But during election year cycles, you do get a very big bump in volatility. Like I said, in 2020, I remember I was standing and a tweet by the president, and they would go up and down, and they were pretty wild. And understanding volatility is what we all want. When you're trading the markets or day trading the markets in any capacity, you want the volatility. I just looked here on Coinbase, okay, on all these patterns: Nvidia, Meta, Apple, Microsoft. Everything had the identical same pattern. You got that push down into the buy divergence, and they ricocheted right back up. See, when I spent nearly 10 years of my life building this software, I started recognizing the power of divergence patterns. And divergence patterns, buy and or sell, are very, very powerful. I've taught this to some of the top hedge fund managers in the world, and I've said this to many of my community, people in my community, but more I've told this to people who are professional traders. If you can master the art of divergences, you've mastered the art of trading. And that is so true. To be able to recognize these patterns, to be able to recognize the divergences, the buy and sell divergences, is just remarkable. Yesterday, for example, we were hitting a high on the S&Ps of 57.36. And I had just an unbelievable sell signal. I said, I'd let them have them. Not me. I wouldn't let them have them. I think they're going down based upon the conditions, based upon the sell divergences. An hour and a half later, they were trading down 20, 25, 30, and ultimately hit the low of the 56.80, 56.78 level. So again, it's really understanding the patterns. And the one thing I can tell you is everything I do is based upon visualization and repetition. But the one thing I can jump up and down and say with confidence is that these patterns repeat themselves each and every day. All right. Each and every day, whether you're trading stocks, whether you're trading futures, whether you're trading these patterns and you're applying option strategies to this, it doesn't make a difference. These patterns repeat themselves each and every day. Again, I'm so honored to be here during the trading summit. Again, I got chosen to be here during the 2:00 session, during the Fed announcement. Like I said, 50 basis points to me is bearish. Okay, this is just from my 41 years experience. I don't think this is going to be a continuation of another leg up. I think the market needs to pull back, retrace, and then eventually, look for some deep oversold conditions for another leg up here. We've been in the weekly uptrend for many months, and for me, the significant jubilance of the markets right now are, if it was me and I had significant portfolio, I'd be selling into this. I think lower prices are to come in the next several months here, and that's just my opinion. All right. Again, trading the markets to me is the most important thing, is to be consistent. That's why I say my 5 key words: consistency, discipline, confidence, patience, and passion. When I first started trading, I met a gentleman. He taught me everything I knew about, everything I learned from him was regarding consistency in the markets. But I love the game of baseball, so you had to be consistent or else you're gone, right? And as a 3-hitter, I always had to be on base, but more so, I always wanted to be consistent. I always wanted to be on base, whether a walk, a single. If I went 0 for 3, 0 for 4, I was distraught, right? So again, I took the game of baseball, took it into the art of trading, right? And when I met this gentleman, he taught me. He said, "I'm going to go into the gold pit, and my goal is to make $100 a day, whether I make it in the first hour or the last hour of the day, and then I'm going to bump it up to 200, 300, 400, 500." And I can't even tell you what the guy's worth today. Okay, so I learned that once you hit your goal each and every day, that you stop. S&P's just rallied 37. NASDAQ futures just rallied about 180 just now in 25 minutes. Okay, so what we're seeing here is just a reaction, right? And again, you cannot ignore the pattern. So I got buy reversals on the spiders on the 15-minute time frame. I got buy reversals, which now have correlated on the 30 and 60-minute time frames. I got the QQQs, which have correlated to buy on the underlying ETFs on the 30 and 60-minute time frame. So what I do is what's called combination methodology, right? Using multiple time frames, using multiple indicators, and that gives me the ability to be on the right side of the market. So now with the spiders reversing to buy on the 15-minute, the Qs reversing to buy, the diamonds reversing to buy, guess what? Now I would be looking for pullbacks on smaller time frames, the 5 and the 15-minute time frame. With 2:30 left to go in the day, I don't know if we're really going to get that. Okay, gold pushing up here again, up 34. Gold's up 1.3%, deeply overbought. I would short this gold 6.5 to 29 on the gold futures. Again, using multiple time frames, I have opened up the eyes of so many people using multiple time frames. And when you're trading the index futures, whether you're trading the 30-year bond futures, you look at the TLT, the 20-year bond, the TLT is the 20-year bond ETF. If you're looking at the S&P futures, I'll look at the SPY and the STSs. If you're looking at the NASDAQ futures, I'll look at the QQQ and the SQQQs. If you're looking at the YM, the Dow futures, I then look at the diamonds and the SDAW. If you're looking at the RTYs, I'd be looking at the IWM and the TZAs. Very, very important, because my research has shown me that when you have these multiple time frames or these indexes, the math on the indexes trade 23 plus hours in a day, and the underlying ETFs, I do what's called RTH, real-time hours, and they go from I calculate the math on that from 9:30 to 4. Okay, gold just dropped 6. I would look to cover below 22. S30 S&P futures, if they get up to the 38 range, wow, look at them drop. Wow, S&Ps. I was just about to say short them at 38. Wow, look at them drop 18. NASDAQ Qs, everything just dropped here sharply. Wow. Look at the gold just dropped $8 on these sell divergences. S&P futures, I was just on the tip of my tongue to say look to short them at 38. Actually, one of my charts froze from the pencil down. So again, being able to pick up these divergence patterns, especially in gold and especially on the S&Ps on that push up to 38, you can see the sharp drop down to 20. and the Russell dropped, and everything pretty much dropped on this. When you have a Fed announcement, okay, a lot of people don't like trading them, and I get it. It's too fast. The volatility is there. Look at the S&Ps, 38 down to 13. Look at this, 25 handles. This is, I told you, I couldn't say that. Gold just was trading 26.5, just dropped $10 on gold off that sell divergence. Wow. You're talking, it's Christmas in September. That's how I look at it. I mean, when you're trading the markets the way I do and the way I've done in the past, you want volatility. You want to be able to identify these patterns in such a way that gives you the best opportunities. I don't fear. I've been doing this for so long. Like my brain, I don't know, maybe I'm just half crazy, but I don't even think of this stuff. Like it just comes natural to me, and that's how it should come to you when you're trading the markets, right? Again, I got 41 years experience. I've seen it all, was it many back in 2020? I remember I saw a negative 40 oil. I called my kids up. I said, I'm not filling the pool up. I'm filling the pool up with black gold. I said, I should be buying gold oil here. And you couldn't buy, you could only liquidate oil. When do you ever see a negative 40 oil? They're paying you to take oil if you were able to buy it, right? That's insane, right? So anyway, right back up, 10 down, dropped 25, just rallied 10. I mean, this is what the games become at times, especially during these type of announcements. The speed is why I always have a favorite saying, hand on the mouse. So if you're trading, click, 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 you got to have your hand on the mouse. I mean, gold was just trading above 26.5. It traded all the way down below 15, right back up 6. S&Ps were trading, down to the 15, 13.5, and right back up 16. So the volatility is really significant here, right? And if you really want to trade, then you can always switch to micros, right? You don't have to trade the big contracts on these, because obviously you're going the wrong way. If you bought the S&Ps, I'm saying at 35, and now they're trading, one S&P contract, and you're down 20, 25 handles. Well, ouch, that hurts, right? Ouch. All right. So again, what's really here important is how to trade the markets during election year and the volatility. I just say you wait for the right patterns, which I teach each and every day from 9 to 4. And when you really understand these patterns, and we don't, we get movement, right? We get some really great patterns today. We had a really great pattern. Apple ran about $1.50 on one of the trades, right? But what you really want to do is to be on the right side of the market, to be able to have technology in front of you to give you the confidence. You have a mentor like myself, okay, to help guide you along the way, but more so, take the ability to learn the technology, learn what I spent nearly 10 years of my life building, and I can show you how these patterns just tend to repeat themselves over and over and over again. We have about 5 minutes left to go here. It's such a great opportunity here. I love being my legacy depends on everyone's success, as I tell that to people each and every day. But the most important thing is that to learn where you want to be able to focus. It's like going to Harvard and Oxford twice, right? But be able to learn in such a way that you'll be able to change your life. That is why I do this each and every day. I love it. I wake up, nothing phases me. I just do what I do. I come in, I have a big community of traders around the world, and it's my goal, to be able to guide, to achieve each and every one of them, to learn, to hit their goals each and every day. And the number one thing is, when you hit your goal, boom, you stop. You can always increase your goal as the weeks and months later, but you hit your goal, boom, you stop. And then from there, you then watch, or you then go into pick. Look at this gold. The guy who bought 26 and a halves or higher, he jumped. It's down at almost $14 just now. S&P futures just dropped 20. So again, it's really important to be on the right side of the market, to be able to learn the patterns, learn the strategies, learning multiple time frames, learn indicators that whether you use my indicators, my chart overlay, and or be able to learn your own strategies and then apply them. But you need to maintain stops because it's important. I can't tell you how many times I've heard people, well, I didn't use a stop order. I said, okay, you have a car, you ever apply a brake? And they stop and they listen, and that then and there just changes. I do a segment every Tuesday and Thursday, Back to the Futures on Tradier Hub. Everybody, I welcome you to join me each and every Tuesday and Thursday from 1:30 to 2. And I'm glad to be here during this Fed announcement day. Hey, Molly. Hey,
Thank you. And by the way,
bravo.
may I just say you have never met anyone who's works harder than you.
Do you know do you know Steve doesn't sleep, right?
He does not sleep. He's on those
sleep.
Screens. He's a beast.
You can call me at 2:30 in the morning. I'm up.
Yeah,
yes,
I know.
Dedicated.
That's awesome. So I just want to make a comment, Steve, to the audience that when you're calling out these things on your presentation, I'm assuming that there's traders behind you somewhere. You're telling them what to do.
Yeah.
Those are real trades. And I want everyone to know that he's not the reason he was doing that is telling his staff to buy and sell stuff.
Yeah. So basically, during the live stream, So I'm going to be trading a lot of big pools of capital. Hopefully, God willing, in the next. I've been trading my whole life, but what I'm look at these S&Ps drop here. Basically, right now, what I do more guidance, and I'm working with the community. But I'll be doing a lot of significant live trading to the community in the next couple of weeks here. So
what's your do you have a website where people can sign up and subscribe and do all that stuff?
They could just reach out and call me, www.tradeeasy.com, or they could just call me at 914-500-7484. But this is such a privilege. I just thank you guys for being here. Molly, you're the best. And Lex, you know how long I've known you. Forget it. So
I'm second best. I know. I get it.
Well,
thank you.
You're all great. You're all great. But you know what? I wake up each and every morning. I just pinch myself because I just love the game. I love to be able to trade the markets. I love to be able to guide and teach people along the way. And that's at 61 years old, I just love doing this.
Awesome. And let me just say, you're humble. So just throw his name in, Google stock him, and you will see all the things he's involved in. It's wild. You don't sleep.
No, I don't sleep. And I don't read the newspaper. I don't watch TV. I don't do anything. I just watch sports. And people say to me, well, how do you just come in here each and every day? You know what? Because I'm just used to it. And I see things and I explain things. And you know what? There's nothing greater when people say, I got it, I see it. Wow, this is amazing, and that's the key for me.
But the things that you teach, though, and we got to get going here after this, but the things that you teach, though, if you're an options trader, you can use it. If you're a stock trader, you can use it. If you're a futures trader, you can use it. They're key levels, and it sounds like you do a lot of divergence. I think you use that word a lot.
100, yeah.
Do you do any trend sort of things where it's kind of a follow through, and you're going to go with the market, or is it not?
Yeah, when especially you're using the bigger time frames, like for example, the reason why I was calling that gold short, gold just dropped $20 just now.
Yeah.
The standard deviation on that strategy is 2. It was 13. Oh no, it was 8, almost 9.
Right.
So like right then and there, you could have sold calls on the GLDs or something like that. Right. And look what gold just did. Gold just literally dropped $20 just now. S&Ps were trading 38 to trading 05 or 03 or whatever they're trading now, 06, right? Mm-hmm. So so there is a lot of options. A lot of people do apply options, especially because they'll sell calls, especially at the money calls, or if they're trading the indexes, they'll apply the option strategies, the strategies that I have in the options market. So whether you're trading futures, stocks, or options, it doesn't make a difference. Divergence patterns, when you are able to recognize them, are very powerful, buy and or sell.
Got it. Okay. Well, Steve, thanks. Yeah, go ahead.
Yeah, let's clarify. It's trade easy as in the letter E and the letter Z.
Yeah, I threw it in the chat just now. It just went by. But it is trade and then easy.
Steve Kalajian. Be very happy to. And listen, I talk to the whole world, so I love it. I mean, my weekends, I get people from texting me or calling me from all over, and I love it. It's just this stage in my life. I just want people to be consistent and to learn, and that's why I'm doing Back to the Futures every Tuesday and Thursday. Mm-hmm. And awesome. And I'm happy to be here. And thanks for inviting me today, guys.
All right, Steve. Thanks so much. Have a great rest of the day. Trade them up, man. I know the feeling. Trade them up. All right, buddy.
Bye-bye, guys.
Hey, buddy. Thank you.
I love that too.
He's got a lot of energy.
Oh, he's the best.
That's
He's
a
the
lot
best.
of it. That's a guy. I've met a lot of them in my career. They are so passionate about the markets. He just can't get enough of it. Saturday comes, he's like so bummed that he can't be trading on Saturdays. Right?
By the way, I've gotten to know him, and he has the heart of just
he's
a
awesome.
golden heart.
Yep.
Such a good guy.
Great guy. All right. I see a lot of Spanish rolling in. That can only mean one thing. That can only mean one thing. Our next guest, oh my God, Mr. Luis Silva from Opción Sigma. Here he comes, Mal. He is going to talk about strategies designed to thrive in uncertainty. So, no further ado, we're going to get ourselves out of here and get him in here. And you're going to have to translate the messages. How's that sound?
All
right, let's get Luis out here. This is going to be awesome. Luis, here you go, buddy.
Thank you, Luis.
Hey, you guys, how you doing? You hear me? I don't know. You're listening to me? Cool. Yeah, everything is cool. I don't know. I don't know if you're listening to me. Everything. I'm mute. I don't know. Let me see.
Hey, Luis, it's Lex. Luisito.
You
You're
hear
good,
me?
baby. You're rocking it, and your crew has come.
What are we talking about today?
I hope you know, because I don't.
Well, I love the Back to the Future outro.
It was good. It was good. I'm a bow out. You get going.
But you're not fair, Lex.
Why?
Because you make me compete with Jerome Powell. He's on the other channel. Come on.
You're doing just fine. I can see
I'm pretty sure the rating over there is high. So how's everything doing? How's everyone doing today? Saludo a toda la familia de Opción Sigma que se conectaron aquí a este Summit de Tradier. Muchas gracias por venir acá. Un saludo muy especial a toda la gente de Tradier. Greetings from Opción Sigma to the English and Spanish community. I'm going to try. I don't know if I can present. Could you put my screen? There you go. There you go. All right. So we're going to talk about the state ahead of the unexpected strategies designed to thrive in uncertainty. Vamos a hablar de cómo estar adelante de lo inesperado y estrategias diseñadas para que nos vaya bien en esos tiempos de incertidumbre. Y para hoy he preparado un tema súper especial. I focus to talk about gamma exposure because it's becoming more and more relevant lately. And even if you don't trade options, inclusive si ustedes no operan opciones, this is a very important matter to know. Debería ser bastante importante que ustedes sepan acerca del gamma exposure and how the leaders are positioned. I remember I asked Lex in our last summit in Orlando to talk about this topic because it helps us to understand what's going on in the markets, because sometimes we don't see a huge influx of money or money coming out of the markets, but we can have an answer if we take a look what's happening on the options board, on the derivatives world, and especially how the options dealers are positioning their positions and how they are hedging their positions, how this is impacting the market. So I'm going to tell you guys a tale of two cities. Well, actually, it's a tale of options. So we always talk about the deltas, the thetas, the gamma. Well, not much about the gamma, the vega, the rose, but there are some weirdos around. So once upon a time, in a bustling marketplace, there are another legendary characters known as the Greeks. So probably you're very familiar with the most famous ones like Delta, Theta, and Vega. Ustedes están muy familiarizados en este mundo de las opciones con griegos como el Delta, el Theta y el Vega. Y pues esos se conocen como los griegos principales. They are known as the primary Greeks. But traders spoke of them mostly with reverence because they help to manage the movement like Delta, or the time decay like the Theta, or the volatility with Vega. So algunas personas están muy familiarizados con ellos porque les ayuda a entender qué es lo que pasa con el movimiento del precio, con el delta, el movimiento de la depreciación de los contratos con el teta y el movimiento de la volatilidad con el vega para entender cuál es el precio justo de las opciones. So the primary Greeks were simple to understand and they are very straightforward and they were enough for most traders. Esto era suficiente para la mayoría de los traders porque son bastante simples de entender. So with these tools in hand, people who is just starting in options or the most experienced ones could build strategies, hedge risks, make profitable trades. So the primary Greeks were very popular because they gave traders like insights or the information they needed to make like quickly and clearly decisions. However, hidden in the market, there are the second order of Greeks, often called the guardians of the galaxy, because in the galaxy of options, we know the galaxy is out there, but we don't know much about it. So my mission today is to let you guys to understand what's going on. Mi misión hoy es hablarle de estos raritos del mercado llamados el gamma, el vana, el charm, el VOMA, but we're going to concentrate in the gamma specifically, but not the gamma trying to price the movement of the delta, but how this is influencing the market overall when the dealer is exposed to certain amount of gamma. So then why, so if this is so important, why we talk few about the second order Greeks because there is a trap, because there probably are a little bit more complicated, because we can find comfort in the straightforward nature of delta, theta, and vega, but because they could predict how the stock will change its price if we pay attention to the volatility. So because of the complexity of the second order Greeks, like gamma, which measures the rate of change in the delta, or vana, which links volatility and prices changes. So this requires deeper understanding how these forces interact. So nosotros vamos a ver que también hay algunas afectaciones en cómo el gamma, que mide el cambio en los movimientos del delta, o el vana, que hace una conexión entre volatilidad y los movimientos de precios. Esto de repente nos hace pensar que hay un mundo más allá del que simplemente vemos, porque a veces pensamos, es que el delta tiene unos cambios en movimiento, pero ¿qué está haciendo cambiar el delta con respecto a la volatilidad? Y son esos griegos de los cuales nos hablamos, digamos, de manera frecuente. So most traders are short-term thinkers. We live in one expiration date to the next one, especially today when we are trying to make profits really quickly with the zero DTE. Hoy por hoy estamos prestando mucha atención, por ejemplo, a los 0 días para la expiración, tratando de hacer rápidos ganancias y tratando de sacar un profit casi que de la manga. Pero hay los otros griegos, digamos, entran en acción cuando necesitamos manejar esas posiciones a más largo plazo o cuando estamos en mercados de alta volatilidad. Entonces, si nosotros examinamos un portafolio, if we examine a portfolio, gamma is critical for manage large portfolios. So when a dealer by his nature, he's going to try to provide liquidity to the market. So if you're buying a call option contract, so the dealer is going to sell you the call option contract. But the dealer cannot expose indefinitely, de manera ilimitada. They can have like unlimited exposure, so they try to hedge the position. So for instance, if you buy a call of the 40 delta, y si ustedes compran un call del delta 40, so what's going to happen is the dealer is going to buy, let's say, 40 shares. So he's going to be delta neutral. But we know behind the scenes that they have to adjust this all the time. So deep in the shadows, the dealers are adjusting all the time, and this could provoke some movements on the market. So sometimes we think, okay, probably what's going on now is that the market is getting more buyers than sellers. That's essentially true. That's the way the markets work. But also we can try to say that there is a huge institution or a huge hedge fund trying to cover their positions, they don't necessarily are buying the stock per se, or they are selling because it's time to sell. No, they are adjusting their positions. So on the basics, we're trying to understand when the market is on positive gamma and when the markets are on the negative side. So I don't know if you have paid attention when the market is growing. No sé si han puesto atención que cuando el mercado está creciendo y estamos del lado del gamma positivo, estamos del lado del gamma negativo, hay ciertos movimientos que se producen. So the movements on the market are going to be different whether we are on the positive side or the negative side. So on the positive side, we are going to see the volatility shrinking. That means that the spectrum of movement is very, very short. So that means when the dealers are positive in gamma, what happens is they're selling when the market is like on the upside, and they're buying when the market goes downside. Lo que termina pasando es que cuando los dealers están positivos en gamma, el mercado, sube el mercado y ellos venden, y cuando baja el mercado, ellos compran. So that provides stability to the market. Eso provee estabilidad en el mercado y hace que de alguna manera los movimientos sean cortos. So therefore, the movements of the underlying asset they are gonna be much shorter. Have you seen that when the market is like growing steadily and they probably pull back a little bit and they steadily is growing, it's probably because the market makers, the dealers, are providing that stability to the market. So whenever they're trying to sell, they buy, and whenever they try to buy, they sell. So we'll see the small movements. But when we are on the other side, on the underworld, it happens the opposite. So when the market goes down, the dealers sell. So that causes pressure, a huge pressure. And then when the market goes up, the dealers buy. So that's why when we see, let's say, a bear market, the candles are this big. On a bull market, probably the candles are this big. They are short candles. But in the bear markets, we can see huge movements of the price. So that probably explains why the market is moving in some ways, and why we have those large movements. Especially, it doesn't matter whether they are bearish or bullish, but it happens within bear markets. I'm going to show you some strategies that you can take advantage of if we are on either side of the market, on the positive gamma, on the negative gamma. So there is one, I don't like it much, but when we're entering that unknown territory where we don't know where the market is going, we can use something like this, is the inverse item butterfly. I don't like this strategy much. Even it has a profit of 92% according to this tool that I'm working with. But the ratio, how much I'm going to make versus my risk exposure is too high. So that's why I don't like it much. This is basically a long straddle where I buy one call option at the money and I buy one put option at the money, and then I sell the wings. So I don't care where the market is going to. I just need that we have a huge movement. It has a 92% probability of profit, but like I said, the ratio, look how much you can lose and look how much you can make. All right. So there is another one. This is variation. Hay alguna más que es una variación que es el inverse iron condor. Basically the same thing, but this time is a strangle, a long strangle, and we're going to buy the wings, and we can expect like a large movement. It has also a large probability of profit, but also look at the ratio. I don't like it much. But there are a couple more strategies like the broken wing butterfly or long put butterfly. Well, we're going to break a wing. And if I'm thinking, my assumption is that the market is going down, si lo que estoy pensando es que el mercado se va a caer. Aquí, por ejemplo, my ratio is pretty different. Look, if I go with this type of strategy, so my probability of profit is way less than the other one, right? However, we can manage the risk if, I don't know, if we are on the positive side again, because this is going to benefit in an increase in volatility. So that's going to happen when we are in the negative gamma side. And on the other hand, so when we are on the positive gamma side, probably we can benefit from a strategy like this. If you see the relation risk versus reward is different. So my max loss is 575, max profit is 1425. However, you probably never get this max profit, but you can get very good profits into this zone. And you will have here around, I don't have it here, but around $700. So it will keep the ratio 1-to-1. Even it's even better. So you don't put much at risk. So those are those strategies I wanted to talk about, the broken wings butterflies. Also, there is another one that for people who'd like to trade equities, not options, or want to meet equities with options. And for instance, I took this example from NVIDIA. NVIDIA is a craze right now. Everyone is talking about NVIDIA. And I get this question every single day. Todo el mundo está operando NVIDIA, todo el mundo quiere NVIDIA, es un buen momento para entrar, it's a good, should I enter NVIDIA right now? Should I get into the position right now with NVIDIA? I'll say my first answer will be probably not. I will not enter a position with NVIDIA. However, if you want to do so, because I'm not trying to be right with the market. I just want to make money on the market. So probably NVIDIA is going to the moon again, and I want to take a position in NVIDIA. I can use options, and this is an example of a color. However, there is a variations. When I do a color, o cuando hago un collar, what I do is buy a put options, buy my shares, and also at the same time, what I'm trying to do is that I sell a call option that is gonna pay for the premium I have to pay for the put. However, when I buy the 110 put, like I did in this example, so I'm covering all the way down to zero. It's highly improbable that NVIDIA goes to zero in the next 58 days. Well, we've seen a lot in the stock market, but let's talk about chances. It's not gonna happen. So I don't have to cover my whole way down to zero. Probably I'll say, okay, maybe NVIDIA is gonna pull back 30%. So what I'm trying to do here, this is basically a put vertical spread debit or a put debit spread. Esto es un vertical débito put. Lo que voy a hacer es, I'm going to cover my ass off till 90, the 90 strike. So this is going to create a debit less than the credit that I'm getting paid. So how much can I make in this position is $1,000 if NVIDIA goes above $125. But if NVIDIA doesn't go above $25, the maximum I'm gonna lose is around $400 up to the $90 mark. But if NVIDIA goes down, guess what? I could roll to the next expiration date and create a cover call who is gonna offset whatever loss I have taken until probably this point. Or I can just roll the position. I might And my hedge also, I can put it down, just try to play a little bit with it. So try to understand a little bit what's happening on the other side, what's happening on the side of the dealers. Traten de entender un poco lo que está sucediendo del lado de los dealers para saber cómo posicionarse en un mercado que en definitiva no sabemos para dónde va. Cuando estamos llenos de incertidumbre, lo mejor es obrar con mucha precaución y mucha certidumbre. Go back to you, Lex. Where is Lexito? Or Molly? You see?
Here we come.
Well, you left me for Powell, right?
No. I was eating salad. But well, that was great, Luis. Awesome. It's familiar to me, as you know, right?
Yeah. You're pretty good at it, right? I love it.
Awesome. Well, thanks for that, Luis. We're running a little bit behind, so we're gonna keep rolling if that's okay.
Yeah, that's
Gracias
fine.
por todo. Cuando hablas,
I'm waiting for the boss here, actually.
That's right. Go ahead, Molly. Go ahead. You can speak your Spanish. Go ahead.
Yeah, gracias por todo. Cuando hablas siempre está sencillo, cosas complicadas. Muchísimas gracias. It's a really great honor that you're here.
No, yeah. The honor is mine. El honor es mío. Muchas gracias a toda la comunidad que se conectó.
Say hi to Dan and Brian for me.
I will.
I know they're visiting.
We're gonna have some drinks for you.
All right. See you, buddy. I'll talk soon.
Take care.
Thank you. All right. Tradier now has futures. Trade S&P futures and options nearly 24/7. We have low margin requirements, no pattern day trading rules, and preferential tax treatment. Day trade margin is incredible at just $1,000 for the E-minis and $100 for the micro S&P futures. Trade on your favorite Tradier platform as well as your favorite third-party platform. And with commissions as low as 75 cents for E-minis and 35 cents for the micros, you can't afford to miss it. Tradier futures. Sign up today. I'm not going to take much time because you got to get busy.
All right. We have Titans coming up. We have time to stay out of their way.
I know. So next, the final panel. It's a panel. So Molly is going to host the panel. I'm going to disappear. We've got Bobby Iancino, Tony Nash, and Eric Hale. And who knows what you're going to talk about, but I'm going to let you take it.
All right. Let's go.
You ready? Do it.
Let's go.
Let's go.
Hey guys, what an incredible team this is. Got a little bit of Mafia, got a little bit of CT here. Correlation.
Got quite a bit of echo going on, Molly.
Yeah, I had a little bit of feedback. Anyone over there? Good?
I saw Lex's Irish hat, so I figured I'd start with my Italian-American flag hat.
I love it. All right, we're going to get going. So today we are going to talk about, in these crazy times, there's just crazy times. So what can we do to uncrazy them? So how do we hedge with big tech? What are they really up to? What are some correlative stocks that we can kind of address? So why don't we just quickly go and introduce ourselves? Tony Nash, really an honor. And Eric, karate, kung fu master. I know I got that one wrong, and Bobby. This is Bobby. All right, so just a quick elevator of who you guys are. That'd be great.
Well, I'll start. I've been around in virtually every role possible in this industry since about 1993. I know I look great, but I'm older than I look. So started out in the futures market, started out in FX, went to bonds, went to short-term interest rates, S&P, went to commodities, traded gold. Biggest thing I've traded over the last, say, 10 years has been crude oil and individual equities, including equity options. So I've done everything. I've been a CIO at a fund of hedge funds. I've been a risk manager at a prop firm. And now I do a lot of content and just kind of trade my own stuff, friends and family, and hang around with Jimmy Ariorio way too much.
All right, Tony, you go ahead.
Great, thanks. I'm Tony Nash. I'm the CEO of Complete Intelligence, It's an artificial intelligence platform for forecasting markets and corporate finance. So we forecast 1,800 items in public markets once a week. We do monthly interval forecasts. We disclose our error rates on everything we do. We also do corporate finance. So we'll do budgeting and supply chain forecasts and automate that stuff for CFOs and supply chain heads globally.
All right. And Eric.
Awesome. I'm Eric Hale. So I've been partners in a couple different businesses. So I'm the CEO of Trader Oasis, and we're one of Tradier's partners. So we have a trading platform. I'm also partners in a business called Options Animal. We teach people how to trade stocks and options. I've been there for 20 years. My background is in engineering, and you made an allusion to math. I think you were making an allusion to math. So I'm passionate about models. I participate in several different forums involved in economics, including the Chicago Federal Reserve's annual economic outlook. I've been recognized 4 times for excellence in economic forecasting from them. So it's my passion to try and take, which I know Bobby and Tony were both looking at Chair Powell earlier as we were in the green room talking about what's happening with Chair Powell. Are you looking up at me? Is this like the Brady Bunch?
You talking to me? Because I've still got my screen on because Paul is still talking, so I've got my screen on. I'm
Molly.
Yeah, I'm reading the closed caption here. I've still got it up there.
The more he talks, the worse it gets.
To you, though. I'll point to you. I point to Tony. He's over here. I can't really figure it out.
So, anyways, I talked to a lot of different people, different economists, money managers. I actually meet with Fed representatives pretty frequently. My motto is to try and drink as close to the source as possible, and I share that information. We've got a community of about 10,000 people that I share sort of economic analysis and insight and trading ideas with. And I'm really interested in this tech sector too, so I'm excited for this panel.
This is great. So we just came out, we just got some great big giant news. We weren't expecting that big of a swing. So, Tony, you talk about a lag between policy implementation and economic effect. So what is that window, and how do we handle that? And what would be your go-to right on today?
Well, I think Bobby said it before we started here. He said the first response is probably not the right response, and we see that the longer Powell talks, the more the market comes down, right? And so we see this every Fed meeting. Powell talks. People misunderstand it, either overly optimistic or overly pessimistic. And then other presidents have to go out over the following 2 weeks to correct and adjust the message that's intended. So I was just tweeting, I would love to play poker against Powell because he's such a terrible liar. He basically said, there's nothing to see here, but then this is quote, downside risks have increased. So he's trying to tell people that, everything's okay in the economy, but downside risks have increased. And those things don't happen. So the other thing when Powell talks, and I used to lead research for a company called The Economist magazine, all that stuff. So I've been doing this for a long, long time. When Fed talk or when Powell talks, we always have to wait for a week or so before we really understand what they mean. In my view, if I look at the economic data, now I don't believe the economic data. Okay, I don't believe economic data for any country. Macro data releases are always revised. They're terrible. People talk about China data as if it's awful, but every piece of macroeconomic data you see, you can trade on it because that's the reaction. But do you believe it? That's another story, right? And so if you believe the macroeconomic data that's out there, then you would have to look at it and go, hey, everything's fine. I'm going to take Powell at face value, right? But then you have to wait for the revisions to really see what the true direction of the economy is. And when we saw those job revisions last month in August, when they revised them down to 868,000 or something, that tells us the true direction of the economy, right? And so not saying it's not a great trading environment. We've obviously seen some sector rotation, those sorts of things. There's always an opportunity. But when we're looking at the macroeconomic environment and we're hearing Powell tell us everything's fine, we're just covering downside risks, but things are revised down again and again and again. Nobody's economic forecast is credible. We do economic forecasts more for fun than anything else, because what are you correct against? The first revision, the preliminary, the third revision? Like, what are you benchmarking yourself against when you're correct or you're not correct, right? So at Complete Intelligence, we do just a very quick overview of what we do. For $25 a month, you can see 1,800 items traded in public markets, right? And so we disclose our error. So if you want to know how wrong we were on NVIDIA or Walmart or the S&P 500 index or anything, it's all there for everyone to see every month, right? And so and we use that error to calibrate our models on a go-forward basis. And so that risk element of what we're doing is in there. Now, something like NVIDIA, your question that came is about tech, right? Something like NVIDIA, I don't think it's possible to forecast something like NVIDIA beyond, say, a few days. Because there's so much sentiment and so much emotion involved in it. We do forecast it on a long-term basis, but I caution people to look at error rates before they use our forecasts for placing any positions, because that error rate equates to the risk that you accept when you make that placement.
And that goes to what you're saying is, any kind of static forecasting is just archaic at this point. It has to move quickly to be relevant anymore. So we're talking really about data integrity. Also, if you just span all the way out to data integrity, and we see, BRICS kind of skirting SWIFT, seeing if they can get around that for sovereign reasons or what might, other things, like CBDC, whether they're trying to push out, all of those are going to create a huge compute power weight. And when we look behind, if we're looking at data integrity, if you look behind that, they're all going to be sitting on AWS, which is very centralized. So if one of those cats go down, it might be a bit sticky. So in that regard, it would be interesting to hear. First, I want to hear what Bobby thinks about today, because I always like to hear what he says, but also correlative stocks that, despite data integrity, which you're talking about, there's a great question that what is going to change in 10 years, but what are the things that will stay the same in 10 years? And I think that's a really important question. So, Eric, after Bobby, we'll talk about what stocks kind of to diversify and hedge and things that are a bit safe bets as we go through these stormy days. But Bobby, what do you think about Powell? What's on your mind? I can feel it.
Well, I like his hair. That's one thing I've always liked about Powell. I don't. So first of all, full disclosure, we do analysis for individual firms who want their own research arm, but don't want to hire a research team. So a lot of you watching may have actually read our research and not know it, because there's a handful of firms out there that stamp their names on our research. Now, one of the things we don't do is we don't predict Fed moves. And I am a client of Complete Intelligence, full disclosure. Like, I pay that fee and I like the product. So I don't like when I disagree with Tony. But here's where I disagree with Tony. I don't think Powell's a liar. To steal a quote from George Costanza from Seinfeld, not a lie if you believe it. And I do believe one of the things that I thought was a little silly, and as you were saying, I'm looking up like the Brady Bunch here because I'm watching the comments, and Powell said a 50 basis point rate cut should not be looked at a change in pace. And I thought, that's insane. That's like looking at me and saying you shouldn't think I'm Italian when you look at my face. I mean, I'm obviously Italian. This is obviously a change of pace. And when you look at the SEP, the Summary of Economic Projections, there's basically anywhere from 150 to 300 basis points of cuts priced in with the Summary of Economic Projections. But there's varied levels of it. 10 of the Fed governors in the SEP, or I should say Fed officials, so not all governors, but 10 of them put more than 200 basis points of rate cuts, and 9 of them put less than 75. So it's nuts what's going on here to me. And I'll steal something from Bob Elliott from Unlimited Funds that he said on our show. He actually said, if you just came out of space and were dropped into an economy that had 4.2% unemployment, GDP growing at trend or maybe even above trend, inflation still at anywhere from 2.2 to 2.8% annualized, depending on which metric you're looking at, would you change the rate trajectory? And I think you'd say no. So I think the market's weakness that we're seeing right now, which could change, right, is a function of people saying, well, I mean, why are they pricing in this much? Are they that worried? Now, in terms of the AI story, that 10-year duration that you brought up, I think is pretty critical, because I think at the spot we're in right now, you're looking, and I'll defer to Eric kind of dial down to this, whether I'm right or wrong, because this is more of a theory of mine, not necessarily a statement. I think you're looking at infrastructure of AI now. So I wouldn't even include copper in that, right? Because the grid has to be secured, and a lot of build outs, anywhere from 6 to 7% demand increase in copper at least a year, just to build out the infrastructure for AI, not to mention shoring up the grid and the like, and then of course electrification if it were to continue. So I think you're looking at sort of the picks and shovels of AI now, and then in about 10 years, the beneficiaries. Because right now, and I'll leave Complete Intelligence out of this because I think they do a great job, you got a lot of people just putting AI in their names, just like they did in the internet boom. And remember, NVIDIA is the Oracle of now. And if you looked at Oracle during the internet bubble, everybody thought Oracle is going to be the company you need because you need their routers. Pretty sure that was Oracle. I might have the stock wrong.
Cisco.
Thank you. It was Cisco, right? And NVIDIA is the Cisco now. They're just way ahead of everybody else. And that's not me saying that Oracle's or NVIDIA is going to go the way of Cisco, because there are people who bought Cisco at the high in 2000, 2001 are still waiting to get back to that price. They never got back to that price. So I'm not saying that NVIDIA is necessarily that, but I'm saying right now, I think you want to be in NVIDIA, in ARM, in Qualcomm to a certain degree, and some of these other stocks that are the actual infrastructure of AI. And then 10 years from now, you want to be looking at the companies that actually achieve productivity with AI.
Right. Eric.
Sure. Let me throw in 30 seconds just with what happened today with Chair Powell. And the real question is, are we in a recession or not? I think that we just talked on that a little bit, that potentially we are in a recession or not. If you look at the summary of economic projections, what you do see is unemployment, everybody forecasting unemployment up and GDP down. Those are the makings of a recession. I was a little shocked to see that. Michelle Bowman dissented, which kind of is a big deal to have a Fed governor dissent. But if you look at the last 9 times that we've had a rate cutting cycle, there are 2 very distinct paths that the market takes. 3 of the times it has been incredibly bullish. Now, normally within the first 4 to 6 weeks after a rate cut, the market is almost always up. So we've got some jitters going on today. But those other 6 times when we've been in recession, the market goes down. And this data is out there. Bank of America and UBS, Goldman Sachs have shared this report, and I'm sure you've seen the charts. But there's a discrete bifurcation as to which way the market goes. And so the real question that you retail traders should be asking and looking at here is, what does this mean to my portfolio? Are we in a recession or not? And Powell came out with the right words that things are strong, but the summary of economic projections does, I would say, is an increase in potentially lower GDP and more unemployment. So we're not there yet. Keep an eye on it, and I think things are going to be okay. The other bigger picture, of course, is the election, and my thoughts on rate cuts is that. And I think Nash mentioned this earlier, is that we're going to see sort of a rebalancing in focus. We're not going to have everything red. It's not going to be the Mag 7 necessarily. Some companies are going to do well and some companies are going to do poorly. I look at the IWM today was up initially more than anything because ostensibly the smaller cap companies do better in a lower interest rate environment. And that's been the argument as to why the Russell 2000 hasn't done so well. So that's something to keep an eye on. And then, of course, there's the other thing going on in November, which we probably spend an hour talking about just that. And there's going to be more sector rotation based on that. There's different policies. And I think either one is going to be okay for the market. And of course, it depends on what happens with Congress. But going back to the question you did throw at me as to how to play this. And, Bobby was talking about this sort of the knock-on effects, and you touched on something that I've been watching near and dear to my heart is the electric utility industry. And I would implore anybody to pick up a chart of XLU. So this is the ETF that trades the majority of publicly traded utilities, electric utilities out there. So your NextEra, Southern Companies, Constellation are all in there. Big holdings. If you look at a chart of XLU, this is AI. The reason why that chart is doing what it is the incredible demand for AI. When you do a search on Google, it uses watts. There's a certain amount of power that are used. If you do a search on ChatGPT, it's anywhere up to 10 times as much electricity. And so the demand for electricity is through the roof. So this is a play that I've been talking to my community about for a couple of months here, is that electricity should do well. We're trying to figure out who's going to do well. I think I saw a report that there are 4,000 individual companies raising equity in the private equity markets that have AI in their name. 4,000 companies. We don't need 4,000. We don't need 1,000. And maybe 250 of those companies are going to survive. I'm not looking at the private equity markets myself, but I do look at the big names that are out there, and NVIDIA, of course, is still up there. And I think there's an argument to be made for NVIDIA being a value, even at the current price that it is. There's a world where you can say that it's fairly priced or maybe even underpriced.
And how do you guys think? We have elections coming up, but if we just pull the Oz curtain aside and we look at the monetary shifts happening, how there are tons of experiments going on with CBDC currently, and how do you think that's going to go through? How does the U.S. Constitution handle that, from privacy to Congress being able to manage and set monetary policy? And furthermore, how is that load that you're talking about? If we shift over there, how is that load going to be handled, and where do these data centers go? And does that correlate into the upcoming commercial real estate issues and the maturity dates that were happening? Can those be converted into data centers?
You want to go first?
Question too.
Go ahead. Go ahead.
I want to jump on the CBDC thing, because you and I talked about this offline. And I'll give you some inside baseball here. So the CBDC project by the United States that was run by the Federal Reserve, Eric Rosengren was running that program. Eric ran the Boston Fed. He's an MIT guy. There was an MIT project going on. Eric found out that you can't trade your own private account before Fed announcements. And so he got to spend more time with his family. When he left, Lael Brainerd took this over. That's a euphemism, by the way. Lael Brainerd took it over, and now Lael's left the Fed. She's hoping that, depending on the next administration, she might be the next Secretary of Treasury after Janet Yellen. And now it got taken over by Chris Waller. So Chris is somebody that I know fairly well. And as far as anybody who's concerned about the United States doing central bank digital currency, just read any of the reports by Chris Waller, because he'll say it ain't freaking happening on my watch, because it doesn't solve anything that we don't already have. Everything that you need to do with CBDC, the arguments for it, we have mechanisms to do that. Essentially, what would happen is the Federal Reserve would give everybody in America a checking account. We don't need to compete with Bank of America, JP Morgan, Chase. They all have, that business is good. And as far as instant payments of transfers, we have ways of doing it. As far as getting money to people, there are these other sort of big brother things that some people want to push. And I can tell you that Waller's not going to let it happen as long as he's on the committee.
Right. All right. So we have things out. So we have geopolitics, and how does this affect? So you've written some great things on this, Tony. So as far as supply chain issues, how is AI going to, sorry, we have some, I think it might be on yours, don't worry. How is AI going to affect or improve supply chain, and how do geopolitics kind of feed into that, and what are we going to see in the next couple months?
Sure. Thanks for mentioning that. I do have a geopolitics website called Cloak and Dagger that I write with somebody named Albert Marco. And we talk about China, we talk about supply chains all the time. With respect to the geopolitics around supply chains, I think people are still, whether they're talking about it every day or not, they're still a little bit stung from the supply chain lockups in China through COVID. And I think companies are still looking for alternative routing, alternative locations. We lived this in 2007, 8, 9, when Japan started and U.S. companies and European companies followed this kind of China plus one, China plus two strategy, where they figured, they wanted to de-risk from China and have other manufacturing locations. With ZERP and NERP, people figured there's no risk. Let's just put it all in China and not worry about it. I think it's different now. There was a question to Powell about kind of, are we going back to ZERP? And he said no, in a roundabout way. He said no. So there is a cost of money. I think the COVID supply chain issues are very fresh in people's minds. So, we are looking at regionalization, which is a kind of a thesis I put forward since about 2014, 2012, something like that. And so how is AI helping? Well, we have a product called Cost Flow where we help major manufacturing companies understand their cost basis from each location using actual bill of material costs. And so that type of optimization and forecasting, it's just not possible for humans to do that. We do trillions of calculations when we look at those possibilities and options. So there's that. There's we don't factor in regulatory risk. We don't factor in sanctions, that sort of thing. But those things are kind of one-off events. They're very discrete events, so if they're coming or not. But I think things like optimization of loads, that sort of stuff, that from a software perspective has happened for a couple decades, but it's only getting better, right? And it's only getting more toward the edge. So rather than being controlled by a centralized piece of software, it's being controlled by individual users now. So I think AI in terms of supply chains is really helping them be more dynamic and really helping things like inventories optimized with regionalization of supply chains and regionalizations and localization of warehousing. A lot of that localization of warehousing has already happened, but I think it will happen even more as we have regionalization of manufacturing.
And it'll be interesting. Quantum computing is just around the corner. And just to explain the difference between classic computation and quantum. So classic will go to each scenario and try to find an answer. A quantum computer will go to all scenarios and pick the one. The problem is that it's very expensive. It's not efficient yet. There's a lot of error corrections. It's unstable. But we'll see that progress as we go. And that will definitely change the landscape. But we talk about this in this crazy, I'm in a generation where I was alive before the personal computer. So I will just say, I'd like to know, commodities could be considered analog. So Bobby, where do you see that is it inverse? Where do you see that traveling as AI and quantum computation comes on?
Well, first of all, in terms of the supply chain, it's interesting. The New York Fed has a supply chain index. And they kind of measure the tightness or looseness of the supply chain. And it's actually been getting tighter since about May 2023. So it's certainly nowhere near any sort of fear level. As a matter of fact, if you take kind of COVID out of the equation, you really haven't had any problems in the supply chain until you go back to about, 2013, 2012, somewhere in that range. So it's not a very typical problem. So I'm not trying to point it out as if people should worry about it. I'm just saying the supply chains have been getting a little bit tighter. Yeah. In terms of quantum computing, that's why a lot of people don't believe Bitcoin is sustainable, because they believe that quantum computing can advance the sort of theft of Bitcoin down the road.
I believe there's also a 51% rule where if they can sequester the majority, you can start to change the rules. So I do keep an eye on that.
Yeah, which is part of the reason that I still prefer gold, although I own both. Which, now that I've said all that, I forgot your question.
So how do commodities perform in this environment?
I love commodities in this environment. First of all, I especially love gold because I don't think there's any scenario where we become more responsible with our currency. You could put different levels on the irresponsibility. For example, I think adjusting interest rates here was appropriate. I think 50 and then implying another 50 and possibly another 100 after that was irresponsible. I think no matter who wins the election, they're both going to spend. The one thing I'll point to, and this is not a comment of favoritism, is that Trump never had a budget deficit relative to GDP higher than 5%. Biden has never had it lower than 6%. But the way Trump is talking, he's going to get it to like 7 or 8. So it doesn't really matter. I know a lot of this is campaign rhetoric. They're both talking. All of a sudden, it's a race to cut taxes in specific areas when all we just want is less taxes. Like, let's just collect fewer taxes and spend less. Of course, that would be too easy. And I can't really point to where they should cut spending. So I'm kind of talking out of my ass here. Can I say I just did.
You say whatever you want.
Yeah.
You know, Molly, I don't think we need quantum computing for AI to really take off. In fact, the reason why AI has taken off has been the massive improvement in computational power that we have now.
I think quantum will trump AI. I think quantum is that next. I mean, they'll work together, but I think AI.
I think it'll be incredibly revolutionary, but we've got steps before we get there. And if we don't even need to get there, because right now we're deploying 3 nanometer chips, which are just way beyond where we were just 2 or 3 years ago. 2-3 generations from now, we're not going to use nanometers. We're going to be in angstroms, and that's already known. That's planned. We're going to get to angstrom level, and we're start talking about the diameter of atoms here. When you're laying down, and just the massive density that we're able to put on CPUs allows us to be more efficient, and we're still using a lot more power, but being able to do more computations faster. And there's a lot of innovation that's out there. Unfortunately, Intel can't get out of its own way. I wish they could do better. I mean, they have some good technology, but NVIDIA is already working on the chips that are going to replace what are being deployed now. And in 2 years, what's used right now will be like 50%. So state of the art in 2 years is different. I think it's really interesting. Another area that I think is interesting is data center REITs, because they're the ones that are going to be spending a ton of money and buying a lot of capital, or putting a lot of capital, because you can only add more. We can only add more compute and more space, and we're going to need power. We're going to need real estate. We're going to need places to do it.
Which also was a copper, as Bobby was saying. Big deal.
I think I like FCX as a copper play. So Freeport McMoran as a copper play hasn't done that well, but I'm there. I'm also a battery person as well, and Albemarle came off my watch list because lithium as well. That's another area that's been phenomenal. That in the past 8 years we've reduced. This is an Elon Musk kind of thing. We've reduced the cost of stationary batteries by a factor of 8 in the past 8 years. So it's just been incredible what's happening in that space. I think it's an interesting area that people probably aren't giving credit to Tesla for, is their innovation in the power sector, which is way bigger than the automotive sector. And getting the battery storage model is pretty incredible. I don't know if people understand how the electricity market works. Utilities who have power plants get paid for capacity. What that means is they get paid to not run, just to be able to run. So investors are building these battery storage facilities. So first of all, they buy the electricity at night when it's negative. I don't know if you know this. People don't know this. Wholesale price of electricity in a lot of places like PJM through Maryland and Pennsylvania, parts of Illinois, at night, often the price of electricity is negative because they can't shut down the power plant. So these battery storage get paid to take the electricity, and then they sell it back during the day. But they also make money for not even running. And when we talk about the transition to renewables, battery storage is the key. And this is, the thing. You can't. I'll take Peter Thiel's. Never underestimate Elon Musk. I don't think he's not getting any credit for this in Tesla. And of course, he's an AI company as well.
So to your point about commodities, this is part what Eric just said and what Tony said earlier is part of why I like commodities just almost in general, where I can invest directly in the commodity. That's always my preference, which is why the bottom drawer of my desk here is very heavy with gold coins. Feel like you can't even pick it up. By the way,
your address down below.
Oh, I have guns and dogs, and I'm not weak either. So I think this is a multi-generational commodity bull market, but at some point it is going to be about I love lithium, I love palladium, I love uranium, and I love copper.
So, is Tesla a car company? Is it a robotics company? And so if it's a robotics company, where do we see robotics? And is Optimus going to be pouring me a coffee pretty soon? In which case, are they backable?
Can I just say something about this real quick? I'm one of those people that I cannot wait for self-driving cars. I can't wait. A lot of people are like, oh, I don't trust them. I don't trust me. Right? I mean, I drive too fast when I haven't had any drinks, and I don't drive when I drink. So why wouldn't I want a car that drives itself? Either way, it's less dangerous. That's number one. Number two, I'm the person who has conversations with AI on my cell phone just because I think it's funny. So
Right.
I actually got ChatGPT to apologize to me recently because I said it wasn't answering my question. I actually printed it out, put it up on my wall over here, the ChatGPT apology. So I can't wait for robots to bring me my coffee where I can actually treat them, you know,
Right.
in a comical way, the way that maybe people treated their servants in the 1800s, and it could just be funny. So I kind of can't wait for all this, but this has nothing to do with markets. But.
I do that. You bring up a really good point, though. Is that how I think we're going to see as far as jobs data that comes out? It's looking at companies and how they can pivot. So anything that when automation comes, which it is coming, it is here. How do we pivot, and what kind of jobs are we going to see as far as, you know, data specialists and those who can drive AI and work symbiotically with AI? Where do you see that headed?
So if you don't mind, I'll take this one. I put kind of during COVID, I put together a transition plan of what's likely going to happen with, it had to do with work from home and the automation of jobs in the post work from home environment, because a lot of companies realized with a lot of these work from home jobs that they don't need the people in the office, and it's questionable whether some of the people who weren't in the office actually added value. So I think it forced people to think more about the necessity of certain jobs. And the first place that people go is to contract it out, either offshore it or contract it out somehow at a lower cost. But then looking at how you can automate it. And with all of the AI and quantum discussions that you've had and that has been had by everyone else, I think that processing power is so powerful. We work with finance people both on the trading side and in corporate finance whose jobs are largely looking at data and Excel. Okay. So if your job is largely looking at data and Excel, you need to get more skills because your job is ending in 5 years. Okay.
Yes.
There's people who make really good money programming Excel and sourcing data and manipulating data. That stuff with a $25 a month ChatGPT account, I can do most of that stuff myself. I don't need an $80,000 analyst working with me.
That is so important. That fact, just rewind and listen to that again. That is a big deal. And so really protect, you know, anyone out there, whatever your jobs might be, make sure that you're thinking just a bit ahead and start to go educate yourself to pivot your job for self-preservation, because it's not going away and it's just going to get bigger. So thank you for saying that.
If 40% or more of your time is spent in Excel, first, you need to learn a little bit of coding. I don't think coding is going to be your full-time job, but you have to understand how it works.
Python being a good one. Yeah.
Right. And then you have to understand how you can apply that in other ways. But again, if your job is Excel, it's going to be gone in 5 to 10 years. It's just going to happen.
Yeah, you're like a turkey living on a turkey farm.
Not that bad.
It's pretty good for a while, and then all of a sudden, we get to about November and things change.
Right, but don't worry, you guys. You have skills. You can figure out archaic Excel. You can do anything.
It's true. We spoke to Lou Groman a while ago, and the way that he described it was plumbers and electricians are going to make more than general partners at Goldman Sachs. I think that's the direction that we're going in, and I thought that was a brilliant way to put it as well.
Gosh, guys, thank you so much for this. Any last comments?
Well, I thought you were going to ask me how to hedge.
Well, I did want to ask. Can we squeeze that in? Sorry, team. We're just going to squeeze that in.
I'll throw out one thing to get people's minds thinking. One trade idea. I know that's been the theme all day. People have been sharing trade ideas, and I was looking at a trade on Tesla specifically. Here's one that blow your mind: is people don't understand covered calls. You make the most money when you get assigned. So I was looking at it in the money covered call that you could do on Tesla right now. You could end up bringing in 12% annualized return, which is about 12% return between now and December by selling an in the money call at what strike was that? So 220. Sell a 220 in the money call. You make $1,100. The probability of profit on that trade is about 70%. It's in the money. If it gets assigned, you make the most money. It is a low probability trade. Annualized return works out to be about 23% annualized. it's a heck of a good strategy if you don't mind getting assigned.
Yeah. Just wrap up. So tell us where to find everyone, and just thank you. I just cannot thank you enough for coming on. Bobby, I know we're the same age, but I just look up to you, and you're just such a powerhouse. I really appreciate you. Tony, you're always exciting to watch, and really, I go check his articles out because they're really well written. And Eric, I just signed up for martial arts, so we'll be talking.
There we go.
Yes, you convinced me. All right, so where do we find you guys?
Oh, you could find me. Easiest place to find me is on Twitter, which is Bob_Iacchino. That is right there. That's right there. Okay. That's an I, not an L. That gets confused all the time. So it's Bob_Iacchino. Also, we have a podcast. It's the Futures Edge podcast. You can find that on any podcast platform, YouTube, Rumble. That's getting pretty popular. And we have the Trader's Edge show here on Tradier, which, by the way, Tony's partner, Albert Marco, is going to be on our show tomorrow.
He's great.
So, yeah, he's going to be our show
Always
tomorrow.
exciting.
Brilliant.
Yes, if you want to hear a lot about, he's got great views, and he's just entertaining as hell to talk to, smart as hell. So you check us out on that on the Trader's Edge show, which is 4 p.m. Eastern time here on the Tradier Hub.
Brilliant.
Adults only on that show, right?
Yeah.
With Albert there, you got to be really
PG-13 plus.
Yeah.
Right.
But well worth listening to. It's good
It's
stuff.
really good. It's really good.
Yeah. So I can be found on Twitter at Tony Nash Nerd.
He is a
and you
nerd.
can find my company is completeintel.com.
Okay, great.
And on Twitter, Eric714 and The Everyday Trader on YouTube.
And I just do want to do a quick shout out to Jimmy. Jimmy, we miss you. We're going to see you on the show. I know you're in transit, but we missed you. So thank you, everyone. And thank you so much for coming over and joining us on the summit. And we're going to bring Lex on now. So thanks, you guys. Really appreciate it. You're geniuses.
Cheers, guys.
You know, the inspiration behind the hub, I think, it came from the great traders of our time. Now, there's the great traders of my time on the floor are totally different from the great traders of this time. Again, coming from the floor to coming off floor is completely different environment, and the skill set is very different. So we're bringing together the great traders of the off-floor retail world who know how to teach this community and can give kernels of wisdom to the community, because it's very difficult, first of all. I mean, it really, really is tough. So the inspiration is really about those people who may have adapted from a floor life to the current off-floor life and can teach it. And we have some great, great talent who are going to be able to talk about their transition and talk about their trading abilities from an off-floor retail perspective.
All right. So come on in, Lex.
Here I am. I think we're going to bring Dan on. Great job, Mal. That was an awesome panel. I think Dan's ready to close this up, and then we're going to close it down. How's that sound?
Okay. I love it. I had a great time. I had a great time.
You did great. Fantastic. Those guys are real sharp. That was a great panel. Loved it.
Yeah.
All right. Let's bring Dan on to close us down.
Great.
Reuven and the gang, let's do it.
Hey, guys. Hey, Molly. Hey, Lex. How are you guys doing?
Good.
Wow, that was an interesting and fascinating panel. I think Bobby, Tony, and Eric really did a good job. That was fun to watch, actually. I think what was funny was, I think one of the panelists said, "What do you like about the Fed, and what do you like about what happened with the Fed today?" And they said, "I like the hair." I mean, it's interesting, because that shows the amount of skepticism that's there with the 50 basis point cut. I mean, to be very honest, I had two minds on this. I was not totally sure, because I'm just following with what I was told. They're saying till the CPI is 2%, you would not see a major cut. And so going by that, what they had said, 50 basis points sounds a little different from what was being said. So that being said, the last time we did a 50 basis point cut was during the 2000 the brim of the financial crisis. So, I think what will be interesting to see over the next couple of weeks is there really a slowdown in the market? I think so. That's most important. Putting that aside, I think all of us know, and that was a purpose. The teams at Lex's team, Molly, the marketing team, the product team, the ops team, the technology team all put this show together. We are about to enter a phase of high volatility, right? Elections create volatile markets, and we wanted to drive and empower people to understand that volatility, right? And so we tried our best to basically, and we tried to do that for the last couple of shows, and even the programming on the hub is trying to bring experts that understand the volatility, understand patterns, and like my dear friend Steve said, understand the divergences, right? So I think we were trying to get traders to be consistent, in a way, basically be educated and be disciplined all at the same time, right? The idea was to bring people for whom you as a trader is more important than anything all of us do, right? Great. I wanted to also thank some great shows today. My dear friend Todd Horwitz, you always rock. I can't say that enough. Ed, Tom, Scott, Martin, and Dylan and Ben, you guys did a great job of trying to not only bring the perspective of the technology that can be used in these volatile markets. And my friend Luis, I mean, Luis is just a straight rock star, right? I think I was so impressed. I mean, we as Tradier love people who are actually working on a mission that's beyond themselves. I love the fact that he's trying to bring the Spanish-speaking community, education and empowerment to get into the financial markets with his great platform and great content. I mean, when he comes, everything changes. I think the seriousness of when missions are above us comes into play. And so we're so glad to be a partner in his story, right? To be very honest, each one on the show, each panelist on the show, and also everybody at Tradier do this because they enjoy this, right? And you cannot do it day in and day out if you just don't enjoy it, right? So the idea of always coming together and basically doing something that's always do the right thing by the retail customers, that's beyond the economics of your platform, your preferences, your whatever you call it, your schedules, is what actually brings Tradier and this amazing set of hundreds and hundreds of partners and great education community and tens and thousands of traders who come to Tradier all across the globe and want to engage with it. I hope you guys had a great time today. I hope you enjoyed the content. I hope you're walking away better equipped than before. The team has done an amazing job trying to do the best it can. And so super thankful. Thanks again for joining the show. I initially prepared 2 slides. I said, this is not the time for slides. I think people want me to get off and people want to jump into the market. Before I go, one more time, I wanted to thank CBOE, without whom the show would not have been possible. So once again, thank you, CBOE, for being a partner in our mission. And thanks everyone for great shows. And all the traders, I hope we're doing right by you by getting you great content. Thank you so much.
Thank you, Dan. We should thank him for all he does for us as well. So that was awesome. Mal, how you feeling? I can't hear you. Are you on mute again? See? Unmute Molly.
I just want to say that the part that I love about Tradier the most is that brokerages are a bit closed doors and they really do open things up, and anyone can connect with APIs and have that power behind them. So that's the real differentiator. And I feel so lucky to be a part of this.
Yeah, no, it's great. I was just thrilled. I want to echo a couple things that Dan said. Again, thanks to all our presenters and panelists. Sponsor CBOE, or CBO. I got to call them CBO now. My day it was CBOE. Now it's CBO. They are fantastic. Great friends and just great to work with. To all of you, our guests, and all the people who participated in this event, thank you so much for coming. We're going to do more of this in the future. We probably would love to send out some sort of survey to get your ideas as to what you want to see and the type of things that might be outside the box that we're not thinking of. And this whole thing is not possible without the hours and hours of work from our whole Tradier team.
Oh, wow.
And Dan mentioned
you guys only knew.
Marketing, production, design, ops, everyone was involved. And I hope I didn't miss anyone, but everyone was involved. Just a fantastic, fantastic job. I mean, we were working till the 11th hour last night on a couple things. It was just a lot of fun. You winners who won, I noticed there's a couple emails out there. That's terrific. We'll take care of that. I think we have your emails anyhow. Send us one anyway. I got a lot of feedback on the quiz. Too fast, too hard. We'll work on that for next time. Don't worry. And what else, Ma? And of course, thanks to the co-hostess with the most,
Lex.
My pal Molly. Come see us on what is it? Wednesday, Thursday, Friday, 9 a.m. Central Time, 10 a.m. Eastern. We're live on a couple of those days. It's always kind of fun on the hub.tradier.com. Don't forget to register. It's free. All kinds of cool stuff coming up in the hub. I'm trying to think of everything, Mal. Help me out.
I have to tell you, a quick shout out to Max. I've seen him just work hours and hours and hours and hours, and all the marketing team and all the artwork. So I just want to say thank you again as well from me. And I wanted to thank everyone out there because you took the time today to better yourself, and that's a really big, big deal. So pat yourself on the back because not everyone does that. And
if you want to contact us, you know how to do that with service. But just for the kind of the hub team, you can contact me. I'm going to give my email. It's lex@tradier.com. What a secret. Holy cow. No one would ever figure that out. That's
and also, 1-800 Trading Hotties. So we'll put that down below too.
So give me an email. Give me a line if you have some suggestions or just anything, any kind of feedback. I do demos. So, send me a line. I'll show you how to do that. All kinds of good stuff, right? With that, we're going to shut her down right here. Thank you again, everybody.
Until next time.
See you next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.